Paramount deal is a better deal. And I can't imagine that there aren't others who agree with them in the sense of just a value perspective and the fact that at least in Pentwater they believe that the antitrust investigation in Europe is going to be very problematic for Netflix. Aren't you concerned that you're going to have a lot more shareholders like that, given the change that's taken place in your shareholder base in the last couple of months?
The shareholder base has changed, but not as dramatically as you're suggesting yet. And so there are a lot of ARBs and others that have entered into the stock, but a lot of our longs have stayed with us, and the indexes have stayed with us. And so in our view, we have to make that case, and that's what this 14D9 is about. What transaction? We got a signed deal with an investment grade $400 billion company, $27.75, large majority in cash, with a path to closing and a $5.8 billion break fee that, frankly, has no challenge against it. And we have to compare that to a acquisition that is highly levered, that is a much smaller company, that basically operates below investment grade today. Amazing step by Barry Ellison to guarantee. But we then have to look at what will happen to our company over the next 18 months. We can't do affiliate agreements the way we did before. We can't refinance our debt. We have a bridge loan, junior lien loans. There's billions of dollars at risk there. And they have reasons for their limiting us, and we respect them because they're levered. Netflix doesn't have that problem. Each of these transactions, in one case, the operating issues, you have problems on the P Sky, you don't have it on Netflix. The financing issues, problems on the P Sky, not on Netflix. So our view is...
You've made that point, you make it again, obviously shareholders will read it. And finally, real quickly, I mean, to those who just say, you just won't do a Paramount deal, you just won't do it, you don't like them, it has nothing to do with economics, you say...
That's nothing further from the truth. We have talked to them now since September.
Yeah.
We've given them lots of input on what they needed to do to change. At the last minute, they went to $30, and then it was after the last minute
I know we talked
that they
about
guaranteed.
that, but you haven't talked to them since, obviously.
We cannot talk to them.
Sam, thank you for being here, and again, giving us some senses to the rejection as well. I don't know that whether we'll be doing this again, but I certainly hope you'll join us.
It's going to become a habit.
It may be, but I enjoy it, and I appreciate you being here. Sam DiPiazza is the chairman of Warner Brothers. Joe, I'll send it over to you.
Thank you, David. I think people are watching all over the place. But is it just like 400 people total that are really enwrapped, transfixed with? Because we were watching.
The entire industry.
It's the industry.
The entire industry that's watching.
And are we part of it? So we're kind of part of it. So it seems like it's really important.
Look, it's not just us. Everyone in Hollywood. We just had Jacob Sobroff. The entire, industry in Los Angeles is transfixed.
You know what I mean about the Hollywood's like, oh my God, Netflix, and then they're like, oh my God, the Ellisons. I mean, it's like.
I think there's a fascination.
There's a fascination, but there are people that think Netflix is going to destroy Hollywood, obviously, and then there's people that think that NAGA.
But the reason that there's such fascination with this, though, too, is because it is indicative of the changes that are taking place in this industry. The entire industry is undergoing some serious change.
Right.
When really some of the movies are better than ever. I still like seeing them in theaters, too, so, but that's... I'll be gone at some point. Coming up.
You know what Leo says? Leo says the movie theaters are going the way of jazz clubs. That's what he said a movie theater will be like a jazz club.
I love jazz clubs. Is that bad?
It's a niche business at this point.
Okay. Coming up, Palantir co-founder Joe Lonsdale on the proposed billionaire tax in California. Squawk Box returns in just a minute.
Time now for today's Aflac Trivia question. In honor of National Bobblehead Day, what city is home to the National Bobblehead Hall of Fame Museum? The answer when Squawk Box returns. answer to today's Aflac trivia question. In honor of National Bobblehead Day, what city is home to the National Bobblehead Hall of Fame Museum? The answer? Milwaukee, Wisconsin.
We do have ADP and private payroll numbers due later, and as you can see, we've got a mixed picture for the futures this morning, but the Dow continues, or would continue to add to those big gains from the last two sessions. We're not far from 50,000. Joining us now, Anastasia Amoroso, Chief Investment Strategist for Private Wealth at Partners Group, and it's good to see you. Your forecasts and your feelings about the S&P are, it's like deja vu all over again. A lot of people, 76 to 7,700.
That's right.
Not quite double-digit return, 9% return. So back to a decent year, but not like the last couple years.
That's right, but to be fair, I feel like that was a forecast, 8 or 9% or 10% for the S&P for the last few years, and we've managed to surpass those forecasts because multiples kept expanding and also earnings kept
Is it a
overshooting
safe forecast, Anastasia, or do you have
Based on the numbers, I feel like it is a reasonable forecast because we're assuming that multiple is going to stay where it is today. The Fed is going to continue to deliver some support for the labor market and the economy, and at the same time, the earnings growth is going to come through at 12% this year and about 10% the following year. So you square all of that, and that's how you get to that 7,700. Look, other than the endpoint estimate itself, I will say there are a lot of positives that are lining up for the market and for the economy. I mean, on the earnings growth front, I want to bring up one point, which is around AI and productivity. We get the new productivity print on Thursday, and the estimates are looking for a 5% quarter-over-quarter increase, which I think is like the best in 20 years. So we are seeing material increases in productivity, which in turn are driving corporate margins. And one thing, Joe, that's interesting for this year, corporate margins are projected to expand to 13.9%. So that is very positive and perhaps not fully reflected in that forecast. And then the other side of that is, of course, the midterms agenda and the fact that affordability is front and center. I think a lot will be done this year to try to shore up the consumer. So, how can you not be positive looking at that?
I like your view on AI as, it's stretched, and that is a risk to the market for valuations. At the same time, the payoff is going to start more than just trickling in for everybody else.
Yeah.
So it almost balances out. So the risk of a little bit of air coming out of the bubble
Right.
is
Look, there are pockets that you have to watch, right? And when you look at, for example, late-stage AI valuations in private markets relative to earlier stages, for example, or non-AI valuations, there's a huge premium, something like 200% that we're seeing. So maybe you have to be watchful of those valuations. But at the same time, Joe, I think any of us around the table, we're likely using more AI this year than we did this time last year, and we're using it in more facets of our personal and professional lives. So as long as the adoption curve is rising, and as long as we're seeing tangible kind of productivity increases and therefore cost savings, I think there's this virtuous cycle that is playing out in AI. I will say for us at Partners Group, implementing artificial intelligence is a big focus across our portfolio companies. And again, depending on the company, the industry, the vertical, infrastructure, private equity, we are seeing 20, 30, 40% productivity increases. That is tangible because that accrues to the bottom line, even if it doesn't drive the top line just yet. But I think that is still to come.
You mentioned the multiples stay the same and earnings rise 12%, but you're still only looking for 9%. So I don't know why you're not looking for 12%. And you also talk about margins improving, which could mean 12% it could end up being low for earnings per share growth.
Right.
So I just think you're still kind of safe at 9%. Are you not?
Well, it is a baseline.
So multiples do come down a little bit.
I don't think multiples necessarily come down. The reason why we're looking for 7,600, 7,700 on the S&P is because it's not really the next year's earnings that are going to matter at the end of next year, but it's the year after that. So if you assume that 309, which is what we're projecting for this year earnings, that actually ends up growing another 10% in 2027, that's where you assign the multiples to. So that's what gets us to around 7,700.
When do we have a down year?
When AI disappoints. I think that's probably the biggest risk in the market today, because how much CapEx is related to artificial intelligence, how many efforts, across the economy are related to it. So I think if we do hit a hiccup, if we hit a disappointment, if we end up overspending and perhaps that we don't need as many semiconductors as we thought we did, or we don't need as much data center capacity. Perhaps there's a technology breakthrough. So that is probably the biggest identifiable potential catalyst for a down year. And of course, there's the unpredictable stuff.
Could we have a 10% move down, 15% move down, and still end up at 76? Is that Tom?
I think so. I think so. I mean, take a look at last year, right?
Yeah.
We had, a significant move to the downside, which ended up being a tremendous buying opportunity. But look, the stats are that every quarter, just about, you should have a 5% correction. Every year, you're likely to have a 10% correction. So we don't rule it out, but it's, and this is why, by the way, Joe, we've titled our outlook for this year, Investing at High Altitude. We're looking at high valuations, we're looking at tight credit spreads, so it feels a little, up there. But what do you do in that case? Maybe you have some dry powder, you're prepared to take advantage of some of those valuations. And I think, much like maybe our geopolitical approach these days, you want to be surgical and you want to be precise as far as what kind of opportunities you're deploying capital to. We're finding plenty of those across sectors of private equity, infrastructure, et cetera.
Anastasia, thank you.
Thanks so much.
Pleased to meet you. Hope you don't mind it.
Coming up, California's proposed billionaire tax creating a political firestorm, especially in the heart of Silicon Valley. Palantir's co-founder, Joe Lonsdale, is fired up about it. He's going to join us with his thoughts on that and so much more when Squawk Box comes right back. Welcome back to Squawk. California's techie elite have been fired up on X and elsewhere, railing against the state's proposed wealth tax. Silicon Valley Representative O'Connor has supported that policy, while San Francisco's mayor, Matt Mahan, has opposed it. Joining us right now is Joe Lonsdale, co-founder of Palantir and founding partner of 8VC. Good morning to you.
Good morning.
This is a big issue. Peter Thiel appears to have potentially, I don't know if he's moved to Miami yet or not, but he put out a press release about an office there. So maybe positioning himself so that he can.
It looks like he has to me.
I mean, for the auditors, purposes, that's where he's
I think the
going.
law is written in a really crazy way. I think one of the things people don't talk about is it says it's going to treat control shares as if you own the thing. And you know, Peter and Stefan and Alex own Palantir. I don't think anyone would want to be charged the 5% of the full value. I mean, the whole thing is just crazy.
And so, how many people do you know, and what are you doing? I mean, you're a Texas man now.
I
So
moved to Texas 6 years ago.
you're out of
I'm
this.
welcoming my friends. We're gonna come fight for the country in a free state.
Okay, so let me ask you this though. Jensen from NVIDIA, I don't know if you saw what he said.
Yeah, no.
He put out a statement, he said, look, I don't know if he put out a statement, he was quoted effectively saying, we decided to do this in California, we built this company in California, whatever the people choose is what we're
You
gonna
know,
accept.
I think you could be really good in business. You can get a really goofy politics, so I'm not going to judge him for disagreeing with me on politics. He also said it's bad if you're a China hawk, which I strongly disagreed with. So listen, I think he's a very talented businessman, and I completely disagree with his view of the world, as do probably like 99% of the people who work really hard. Like
Who got the Roe? Because Roe previously said that he was not in favor of this.
Rose very clearly. I mean, he helped Bernie run. He's progressive. He wants to be in power. He said
He's saying the right
He's
thing.
not even, listen, here's what really bothers me. It's not even about the substance of the matter. I think the substance of the matter is one thing. He's looking at the polling, and when people talk to me, he cites polling to them.
Right.
Which to me is not how leaders should lead. They should lead based on what is ethical, what is the
You
right
think
thing.
this is the leaning of the Democratic Party then?
I really don't think so. I think that the majority of Democrats understand that it's un-American to expropriate, and that we're going to go down a dark path
Right.
towards Venezuela if we go that way. I think there are some of them that want power that are very sketchy. They're going to try to push it, and I don't think it's what Democrats are
You know,
doing.
crazy rhetoric in New York right now about home ownership is white supremacy, and you should be able to actually.
I mean, she literally said that here in New York that she
It's
wants to crush the
unbelievable.
white middle class. She
Right.
wants to take.
But what I was saying, yesterday we were contrasting what Roe kind of said with what the mayor said, this Matt Mahan guy, and we were acting like he was reasonable, but his whole statement was, sure, up front it would feel good to get rid of all the billionaires, and I pushed back and I said, what does that mean? And I was told that because of income inequality, the billionaires highlight that problem, which makes to me sound like the entire pie. But can I just finish with that? I know, but just because it's populist doesn't mean it's not flawed. It's not a zero-sum game. Billionaires don't take from people that don't have anything. They grow the pie. They grow the
What
pie.
he said is this is the.
I'm not saying you said
it. I did say this, you know.
I think that's a generally competent mayor. He's one of our better mayors.
Why would you look at a
The reason he
billionaire?
was saying that, though, was as a way of trying, not to placate, trying to resonate his argument with those who actually are on the populist left, who actually believe that. He was making that as, not as a sop to them, but to say, look, this is what you think, and it's not right, effectively. He was not
He's speaking to their
suggesting.
language, which is a language of crazy people, which you and I don't understand. But
So appeasing the crazy people.
But listen, I mean, here's the irony of this whole thing, Andrew,
Otherwise known as voters.
is that they're talking. We have this $18 billion gap in the California budget. It's mostly from giving healthcare to illegals. This whole thing's being put forward by a healthcare union. Here's the great irony here: is that AI is about to make healthcare much cheaper, much better for everyone. We're going to make it affordable for everyone, and that's what we should be focused on now.
No,
Is
I
innovating
love
with
that
AI.
idea, but is that real? I mean, I hope that's the case. I hope we're going to get massive medical advances because of AI, but we've thrown everything at trying to fix this horrible increase in healthcare prices over the years. You still have hospitals that, for the most part, operate at margins of 1% to 2%.
I'd argue we haven't thrown everything at it. I think we've allowed hospitals to consolidate. We've not used the FTC on any health system. We've set up horrible
But it's not like
incentives.
hospitals have fat margins.
No, because they have tons of administrators. This is the thing. Like the incentives are all wrong. They block competition. They stop you from competing with them. I mean, Utah just passed something in the last few days that's going to let AI help you with chronic disease prescriptions to so you get the prescription again. There's like 40 areas of primary care like this that we see that works, that we see AI is going to allow us to do. It's going to be a massive scope of practice battle in the states of the special interests who are against poor people versus what's good for everyone. And so we have to be fighting the special interests, and instead of special interests, we're trying to pass the wealth tax. It's like the opposite of what should be happening.
What do you think the wealth creation in California and Silicon Valley, in terms of shareholder equity taxes that are paid by the people that have accrued a lot of this wealth, doesn't that give you the money to spend to try to equalize opportunity, to try to solve
if you didn't steal $70 billion of it, as the state auditor just said, to fraud, then yes, we could be helping everyone. There's just massive
But
fraud
you got to
in
generate.
this country
You
right
got
now.
to you got to try to equalize opportunity to solve wealth inequality. To do that, you need to have these wealth builders. That I mean, think about how much market cap has grown from these billionaires in Silicon Valley. What is the total market cap addition to the U.S. economy because of that?
Well, a lot of my friends who make a lot of money, what they do is they hire more people and they build things. And
That's what I mean.
want. And they're now going to be building things in Austin, Texas with me, and in Miami.
Bono learned 20 years ago. You look at the rich guy up on the hill. You say I want to be him, not I want to get him. And we still haven't learned this.
I think the majority of our country is on the right side. It's un-American to expropriate assets. So I don't think this is where our country is going. I think California is in a bad spot there right now.
But it's
Let me ask you a different question, but it relates to all of this. I don't know if you saw, there was a op-ed by Mitt Romney, of all people, about 2 or 3 weeks ago.
remember, he didn't pay any taxes.
Well, no, he
according to
didn't.
Harry Reid. No, he did pay.
And then effectively said, look, and he was, against, by the way, ending carried interest originally. He was against a lot of
They
this.
say close some of the loopholes is what he's saying.
He said close some of the loopholes around things like at death, for example, in terms of step up for the wealthiest, especially.
Yeah.
He talked a little bit about, he talked about carried interest. He talked about the idea of potentially around capital gains, not necessarily across the board, but maybe at the very high end. I don't know if you think, when people do talk about affordability and the tax system and scheme, whether someone who's in your position says, you know what, actually there's some low-hanging fruit that maybe makes sense, and if you solve some of that, maybe it shifts some of the dialogue around some of these things.
You know, one of my mentors was Secretary Schultz, who in the 80s went to Tip O'Neill when he was working for President Reagan, and he made it Reagan's idea and Tip's idea, and they got over 95 votes in the Senate for a tax bill. And what the tax bill did is it closed loopholes while lowering the top rate, equalized revenue. Really great bill, because I don't think we should have as many loopholes. I pay a lot of taxes, and a lot of people, especially a lot of people here in New York who are financially savvy, have all sorts of crazy structures set up not to pay. So I am completely on the side of closing loopholes. That is the right thing to do. We should make sure everyone's paying taxes when they should be paying taxes. Now, that said, we should not be demonizing people for being successful.
Okay, separately,
That's totally sound.
we have not touched, and you're in the defense space, we have not touched Venezuela, we have not touched
Exciting start.
Greenland. I want to know where you really stand on both of these things and how you see them.
You know, I got woken up by text in the middle of the night Saturday, like, what is going on? Is someone hurt? And it was just all my friends celebrating, texting me from around the world and what's happening as the news came out of Venezuela. And listen, I think it's a very exciting start to the year. This is a really, really bad guy. And I'll tell you what I think tripped it off, because obviously he's involved with cartels. Obviously he has Iran and Hezbollah there. I knew the former president of Colombia, who was on the right, and that he was showing us how Venezuela, Russia, and Cuba were helping the leftists rally inside their country to try to help the left and the communists win. And so lots of other bad things. But what tripped it off is obviously the deals with China. You can't allow China to get a foothold there. And so this is a guy that both administrations previously, said is a bad guy, so we should get. I really admire how they executed that. I think it's very well done.
Let me ask you a separate question, which is, there is a view, a critique, or a worry that potentially by approaching Venezuela this way, that it gives license to a China, for example, to go and take a Taiwan, or Russia to do more with Ukraine. I don't know if you think it does. I don't know. Look, the other view is China's going to be China. China's going to do whatever it wants anyway.
I think what
And maybe it doesn't matter. But I ask it because I do think in the sort of global diplomacy world, that is the question.
I think what restrains China is not a lawyer sitting next to Xi Jinping telling him what's appropriate or not. And I think it's very clear to everyone that this was a bad guy who we already had a reward out on. So for me, it's a very different situation.
But taken
morally, and,
taken in total with the Greenland rhetoric, it's raising some eyebrows across both sides of the aisle on whether we're returning to some weird imperialistic. Or a lot of the conventions of the last 100 years are being thrown out the window, the way the world operates.
Well, I think we're back to the Monroe Doctrine, which we're calling the Monroe Doctrine. That's right. But Greenland is something you buy, you don't take by force. Obviously, that'd be it. And then
So do you think that the president and the White House should stop with that kind of language? around how they,
Or is it helping buy? Or is it helping
I think
buy?
Rubio is very clear.
Rubio made it clear, but by the way, the spokesman for President Trump was not. I mean, or I don't. Maybe she
She was
was.
just saying leaving it on the table.
But she said she was leaving that on the table, and I'm curious, as somebody who supports this president and supports what he's doing, whether you support that.
I support Venezuela. We did 100%. I would not support conquering Greenland if that's what you're asking me.
Do you need to buy Greenland, or can you just make deals with Greenland?
It seems like it's something where you could invest a lot to help them make a deal. Right now, the problem with Greenland and the resources is that none of the things add up because you don't have a port and you have to pay for the port. So I think making a deal with them, building their infrastructure, allowing them to access their minerals would be good for everyone. It's very good for the whole world.
We'll make them an offer they can't refuse.
I think Ambassador Howery he's an old friend and a confident guy. He has his work cut out for him there in Denmark.
Where do you think China stands or sits as it relates to Taiwan right now?
Listen, I think it's really clear that America is back and that our Defense Department, or now our Department of War, is actually much more confident than they realize. I think I love the meme on the S-300s that they had supposedly defending them in Venezuela, where you see the Amazon, responses from Khomeini and from Maduro. They're very unhappy with these things, 1 star, and it's not clear China knows what they're doing. And I think they're scared that they don't actually have a strong military as they think.
How activist would you be in "We Own the Hemisphere"? I mean, I can see we should want everyone to have the prosperity. But what if China and Russia say we should be really active about how we control regimes over there? We want everyone communist.
So this is our hemisphere. It should be a free hemisphere. It should not have communists. I got attacked by lots of communist parties around the world when I mentioned that for me, founding Palantir was about stopping the communists and Islamists from destroying our civilization. That is 100% the role of a strong government. We should not be allowing them anywhere here.
Final thought, we have not talked AI, since we're going around the sort of room on different topics. One of the things that's been fascinating to watch even the last couple of weeks is just how Gemini from Google has come on hot.
Yeah.
And you've seen some, at least it appears, slow down in terms of at least growth out of OpenAI and ChatGPT. Do you see a tectonic shift happening here, or is this just a momentary situation?
I think XAI and Gemini are both doing extremely impressive things. And you're seeing, I think a friend of mine who runs Vercel did a chess match on his computer between X and ChatGPT, and X just won 19 of the last 20 games he had to play last night. It's really clear these guys are coming up fast. And Andrew, the progress is actually still really impressive. I'll tell you one scary thing is on the cyber side, it turns out that the agents are now extremely good hackers. Of course, we don't let them do that through the companies, but really smart people are figuring it out. There's just going to be a wild world that I
But if you were to look at sort of where OpenAI is, so you have OpenAI and you have Claude. Those are the two that are effectively independent.
Yes.
And so they require continued new capital, and that's a huge issue, especially when they're competing against Meta, Amazon, Microsoft, I mean the whole gamut. So, and Google, importantly. So do you see a shift happening there where people at some point say, we're not going to necessarily continue to send you more money? I mean, AI, by the way, XAI, similarly, I think needs more capital.
Well, actually, it's announced a $20 billion round. I think Elon with Tesla and SpaceX is a huge advantage. I think that's really important. I think you're right. You want to be tied to capital sources. Listen, Anthropic and OpenAI are executing very well. They have amazing talent. I think the whole space is doing very, very well. I think we're set up for a year of massive productivity.
Does it all converge though?
I think Elon's converge. I think
Does it all become commoditized in some way?
For the stuff I'm doing, a lot of it is more commoditized in the sense that our apps will use like 8 different models and we'll switch between them depending on their cost. That said, I think there's like very specific things each of these companies has to try to own in order to get their $1 trillion valuation. They're each trying to do it. Listen, they're doing very well. There's a lot of value to be captured here.
Joe Lonsdale, thank you, sir. It's great to see you. Nice to meet you soon.
Take your billion to get the hell out of here.
All right, when we come back, we're going to talk media strategy with Comcast co-CEO Mike Kavanagh. This is his first week in his new position with another big year ahead for the company, and obviously a lot happening in this industry right now. We're going to talk all about it when Squawk Box comes right back. everybody. It is 8 a.m. on the East Coast, and you're watching Squawk Box right here on CNBC. I'm Becky Quick, along with Joe Kernan and Andrew Ross Sorkin. And among our top stories this morning, the White House says that the U.S. is considering a range of options, including military force, to acquire Greenland. This follows the president's comments on Sunday that the Arctic island is a critical asset to consider for U.S. national security, citing growing Russian and Chinese activity in the region. In the meantime, President Trump says that Washington and interim leaders in Venezuela have reached a deal to export between 30 and 50 million barrels of crude, worth somewhere between $2 and $3 billion, to the United States. The president says the U.S. will then sell the oil on the open market. If you check out oil prices this morning, WTI is sitting right at $57 a barrel. And Discord, the chat platform used by more than 200 million people per month, has reportedly confidentially filed for an IPO, marking a major milestone for the Tencent-backed company. According to PitchBook, that platform is valued at about $15 billion. Other big news this week, Comcast completing the spinoff of CNBC's new parent Versant. That's just one of the many topics that we want to get to with our next guest. Mike Cavanaugh is the co-CEO of Comcast. It's a new title that he's picked up just this week. Mike, obviously an old friend of ours too, but Mike, welcome.
Thank you very much. Happy New Year, guys.
Happy New
Happy
Year.
on the spin. I'm very excited for you guys.
Thank you.
Sorry to see you go in many
Seems
ways.
like you
but
guys. It's already
I'll
you
be-
guys
Do
at
you
this
miss us
point.
I'll be back. Well, you know, I've not been on in a long time. I was saying I think I backstage was first on Squawk 20 years ago, believe it or not. So it'll be good to be coming back as an outsider, so you can rough me up whenever you want.
Wow.
It's trickier when
In
you're
right
inside. When you're an insider, it's a little different.
I don't know how rough it's gonna be.
First of all, I do want to say congratulations on this
Yeah.
new title
Thank
of
you.
co-CEO.
Thank
You
you.
were the first person not named Roberts to take the position of CEO or co-CEO, and congratulations.
It's an honor. It's a great company. Brian and I are great partners. We've been at it together for more than 10 years. So it's just an evolution of how we work together. And the company is one where we've got many things going on. I mean, we connect, 65 million homes passed on the broadband side, big in wireless business now, biggest service provider to small businesses for connectivity. And then obviously everything on the media side from, one of two global parks businesses, our studio, number 2 global studio, and obviously now our media businesses, which with this week's news is now squarely focused on bringing Peacock to profitability alongside the power of NBC broadcast and everything we do live. So it's an exciting time. Actually here in New York today, which we're 1 month out from the Olympic Games, so we're having an event later on to announce that. And that's always fun when you're getting to the moment of 1 month out, the anticipation and excitement. But we did a great job. The team is sold out all inventory for the Olympic Games, all ad inventory 1 month in advance. The Super Bowl we have as well next month, and NBA All-Star Game, all sold out. So it's a great portfolio of sports and events that we've got coming up. So excited to be here later today for that as well.
What do you think of the Versant spin? The stock has been under pressure.
Mhm.
I think it's probably not a surprise to a lot of people given the forced selling from indexes and others that are there, but what did you make of the stock action?
That's exactly right. I think the thin trading in the when issued market in the days leading up to the end of the year, it set the stage. This week is the real week where it's just going to find a level over the next a couple of weeks, I think. But the early days is technical turnover of the shareholder base that's getting distributed shares, repositioning against their own criteria, indexes they're in. And how
When
they-
you sat with the bankers to make this decision
Yep.
and looked at the various sort of outcomes, what did you think the stock should be worth? What did they say to you on both ends?
Well, I think we're trading a little bit below where we'd expect to be ultimately,
Okay.
given the early day turnover, which was expected. This is exactly what the bankers would have told us.
But did the bankers say that 45 was the number, or did they say 40 was the number? Are you saying a little bit below where it is?
Well, you look at the multiples of the business. The business could trade anywhere in the 4 to 5 times range.
Right.
I think Mark did a great job the other day here with you guys articulating the vision for what the business is going to be, and I think as that becomes evident with the team that we've put on the field, I think Mark's fantastic. On Kinney, it's an unbelievable team, and you heard Mark go through the strategies of just driving verticals like CNBC, like MS, like Golf Channel. There's plenty of room. I think it's resonated with investors as they've been on their roadshow. I haven't been part of that leading up to things. So I think I'm optimistic and excited for everybody involved in Versant. I'm really happy for Comcast shareholders, because I think you guys are going to drive more value for these businesses
That's what I was gonna say.
than would have been the case sitting inside
As a
Comcast.
long-time Comcast employee, one Versant share per 25 Comcast shares, Versant's not my problem. Comcast is my problem.
I hear you.
And I'm just wondering,
Yep.
what turns that story around in terms of growth, and how did,
Mhm.
I mean, I remember it at 60, I'm a long,
60
I'm a
bucks.
long-term
Yeah,
holder,
me
and I
too.
remember at 60, and I still got it.
No one
I loved it at
cares.
60, do I love it more at 30?
We love it more where it is now.
Where's the
I mean,
growth gonna-
opportunity for us, and the reason I'm so excited to be in the job is I think we have plenty of opportunity ahead. There's a lot of urgency. I mean, no one in the company doesn't feel it, the need to, it's not so much prove the critics wrong, but prove the case for why the long-term value we believe is there.
Someone doesn't understand.
The dominant, well, I think the dynamics that are affecting us really are that where my greatest focus is, we'll talk about media, but that's not where my focus is. My focus is on the connectivity side, broadband and wireless. And that is where we've seen an intense level of competitive pickup. You're seeing it across all sectors in the space. And it's a game trying to get towards an end game. And I think we see the end game world where we're in very good shape. That's a world where the whole country is wired with high-speed internet. We're already there across 65 million homes, can deliver gig speeds. We have a very capital-efficient roadmap. We'll continue to invest $10 billion a year in our network, bring it to multi-gig symmetrical, so it'll be as good as anything out there. Nothing will be better. And we're already there and just are in constant upgrade mode.
What do you mean?
We already have the best wireless through our MVNO agreement with, so we can deliver convert service now and later. And so, but what's happening now is the wireless guys rather are doing two things. They're finishing out their own fiber builds,
Right.
but see, all of them together have less high-speed data footprint than we do today.
Right.
And because it doesn't make sense for them to overbuild each other. So we're going to end up basically in a world where, I believe anyway, where there's ourselves or Charter, one of the big wireless providers, fixed wireless, which is any wireless provider that doesn't have the wire into the home, and then satellites coming along one day. So there's plenty of competition. So what we've done, to Joe, your question, is we've installed a new leader, Steve Croney. It's more important than this being my first week, is it's actually Steve's first week as CEO of that business. He's instituted a big reorg that just happened in the fourth quarter of last year, eliminating a whole layer in the field, putting us in a position to be more nimble, more reactive, quicker as we see our competitors changing their pricing and strategy. And middle of last year, we did the biggest change in Comcast history in terms of how we go to market, meaning pricing and packaging. We've taken away the weak underbelly, I would say, of the cable strategy was promo pricing, much like credit cards from 20 years ago, where you're in at one price and then you step up. Creates a lot of churn. I think the competitors figured that out. We've responded by simple tiers of service, everything included from your router to your data, 5-year, 1-year price locks, things that no one ever thought we would do. So we're in a pivot mode in that business. Take a couple more quarters, but as we look ahead into 27 and beyond, we'll have a much more stable revenue base on the customer
Comcast
side.
will never be totally free of media. will it?
No. That's but my focus right now to your question of how do we get the stock, moving? I think we want to get the stock moving by answering questions about long-term of the broadband side.
But you still like the media.
I love the media business. I think we've got a phenomenal parks business.
There's a big
phenomenal
bidding war going on.
I just want to go back to the cable, because that is the, I mean, when you talk about the stock price, that's the business.
That's the answer.
And the question is long-term margin, right? So for a long time, Comcast, and actually Charter too, effectively owned the railroad tracks. And there really wasn't, I mean, you could argue there wasn't the same kind of competition. Between wireless, between satellite, it's now, it's a Wild West again in terms of pricing. And so the question in terms of holding margin, right? There's the churn issue.
Yep.
There's the promotion pricing. But what does the ultimate margin look like on the marginal customer today? I think that when I talk to analysts about the site, that's what they say. We're never going back to some of the sort of top tier prices again.
Well, when you look at connectivity together, the broadband market is, given size, and then mobile is 2.5 times the size of that market. The ability when you roll forward, the value to the consumer is going to keep going up. We now have 800 gigs of usage on average by a customer versus, call it 20 on a mobile phone. So as time passes, what's your bet on whether there's more demand for data in and out of people's homes or over Wi-Fi out of homes? And that is the big strong backdrop. If you believe that the Joe Lonsdales and others are going to be driving more things that we don't even understand, that there's going to be more sports streaming, there's going to be more entertainment streaming, that it's going to be richer and deeper, as well as new applications and in-home uses for medicine and the like. That's a very strong backdrop to say that there will be value difference.
But does that assume then that the wireless guys don't get to a 6G and that the satellite guys don't get faster connectivity?
No, they'll continue to be tough competition, but like I said, the wireless guys have to continue to buy spectrum. So the more time, the more amount of spectrum they're dedicating to transmitting data that could be done over a wire, it's going to cause the actual mobile business that they are in, which is for them, 40 times the value of a unit of spectrum. If you could sell another mobile plan, you get 40 times the revenue. So it's the fixed wireless, and Charter's spoken about this. It is a good enough product for now, and we hope that there's a push, more data, more need, more value out of the best broadband Wi-Fi in the home that we have, that push people in our direction, and that we win the fight really over the long term, or we sort of share the market between a fiber provider, whether it's AT&T, Verizon, T-Mobile, in a given market, or ourselves.
Competitively, do you care whether it's Netflix or Paramount? Netflix is going to turn into a black hole where it's just everything. That would not be good for the rest of us.
All I have to say about that is that it is going to be great for CNBC. Because listening to Senator Piazza earlier, this is going to be a long-running story. I don't think the answer is this is over. You seem to have two very committed parties in Paramount and Netflix that have determination. So I think it will continue to play on. I don't know how to handicap any better than anyone else does who is the ultimate winner. And furthermore, your question, which thought about. Do I care who wins? Do I think it shapes the industry? I think the industry is changing. I think, Becky, you said it earlier. These industries are changing without regard to any particular event. This will be an event, but it's one of many. And so I think focusing on our own strategy, which we're very committed to theatrical, we think our studios, we have an incredible slate this year with Steven Spielberg's new movie, Disclosure Day, with Christopher Nolan, The Odyssey, Super Mario, and the next Minions. So just speaks to what we're all about. And I think seeing that flow through later windows and drive good economics, we'd like to see the theatrical business do well. And so I think that is
some that say Netflix is going to kill
I think that's important to the industry. So I hope.
Any AMC theater stuff with Netflix.
I've been to the theaters a couple of times.
I have too.
And it's a great experience. Used to do it all the time. Did it a little less, but I think we need to try to keep getting people back to the theaters for the good of society.
Genuine artificial
It's a different experience when you're sitting in the theater and with other people.
Do you think in this regulatory environment, if at some point you wanted to buy another entertainment business to bolt on to the entertainment business you have, because some people would argue that the current entertainment business is subscale, do you think you could?
So let me tackle the second part first. What's subscale? Our media business is three parts. It's parks. We're one of two. There's no lack of scale. We have opportunities around the globe. We just opened Epic Universe, as you guys know. We're opening smaller parks. We've got land and now approved plan in outside London, and more beyond that, and can do cruise ships if we want. We've got no lack of scale in that business. In the studio business that I just discussed, we've been, on average, the number 2 player for the last 3-5 years. I think talent comes our way. Hollywood loves working with us. We've got great leadership in Donna Langley, so I don't think we lack scale there either. So it really comes to, and nor do we lack scale in NBC, the broadcast side. That is, one of the greatest broadcasters celebrating 100 years. You look at what we do in sports, live events. The Macy's Day Parade was the most watched in its history. So it's really figuring out the streaming strategy that complements everything else I just described, and that is Peacock, which is fundamentally it's a domestic service that very much leverages what makes NBC great, which is sports, entertainment, reality through Bravo, and our news organization. And so I think that speaks to fundamentally being a domestic strategy, because were we to take it global, you'd have to be in the sports rights business in other markets.
Right.
And so we're just running a different play. So when people say we're subscale, in what way, right? For what we're trying to do, I don't see it that way.
Mike, we want to thank you very much for being here.
The
We hope to
toffee
see
continues.
more of you.
The toffee continues at
Absolutely.
Christmas.
Absolutely.
He said.
And one final question for you. You own a lot of Comcast shares, which means
I
you
do.
got a lot of Versant shares that
Mhm.
came through. Are you?
I'm not selling.
Thank you. That's what I wanted to
No,
know.
absolutely. I'm looking for, well, I expect you guys to do well, as we've done, going back to, the expectation is you guys perform really well. So go get them.
Thank you.
Thank you,
Appreciate it.
guys.
Thank you, Mike.
Appreciate it.
We appreciate it.
Meantime, news just out, literally as we've been speaking, ADP's monthly employment report, private payroll is rebounding in December, added 41,000 jobs led by education, healthcare, and leisure and hospitality sectors. Joining us right now is Nella Richardson. She's ADP's chief economist. Tell us what's going on.
Well, we did see a rebound, and we saw it pretty firmly across the sectors that have been the stalwarts, still leading healthcare services and leisure and hospitality. Goods down, but those losses narrowed in December. So basically every sector that lost jobs in November lost fewer jobs in December, so that's kind of good news. And we also saw a rebound in small businesses. It's not a strong push, but it was a increase in hiring in the last month of the year, and I think that's a great sign going into 2026.
So the thing, we saw some of the GDP numbers that I think surprised people earlier last December. If you look at these numbers now, we're going to see the jobs number on Friday. What do you think this portends, and how closely correlated do you think they're going to be?
Well, I'll take that second question first. Remember, these numbers have been benchmarked. So ADP benchmarked the numbers with the QCW, the formal census, in August. And so when those people who were looking at Chair Powell's remarks, talking about perhaps the BLS numbers being biased towards the upside, you won't see that in the ADP numbers, and both series will be re-benchmarked for the full year in 2025 in February. That means that there's not going to be a lot of comparison between the full number ADP and the full number BLS on Friday. One's been benchmarked, one hasn't. But you'll still see, I think, the strong sectors stay strong. Health services and leisure and hospitality. Now, turning to the first part of your question, it's not lost on me that the strong sectors have been the sectors where there's been a benefit from this K-shaped economy. Health services is an expensive sector, and leisure and hospitality is an optional, discretionary sector. And so that is reflective of what we've seen in the overall economy, where high-income consumers are really driving spending.
Okay, Neil, we're going to leave the conversation there. We appreciate it, and we look forward to what we hear on Friday and see how things match up. Thanks.
Thanks.
Coming up, just one after another. This is a good interview. Former St. Louis Fed President Jim Bullard is going to join us on what we were just talking about, the labor market, the economy, and the Fed's position on rates. Squawk Box will be right back. All right, here are the futures. Now the Dow indicated up almost 80 points. Take a look at treasuries, because we probably will talk a little bit more about them. 413, been there in that range for a while. For more on the markets, let's get to Mike Santoli at the New York Stock Exchange. What's going on, Mike? Nearly 50,000. When are we going to hit that?
We're going to get, I mean, what? It's like a 1% move from here, right? My suggestion is that 50,000 be the last 1,000-point threshold of the Dow we really make a fuss over until, let's call it, I don't know, 60 after that, because every 1,000-point move from 50 is only 2%. But we could get there. It's obviously within sight. New records for the Dow and the S&P 500 as of yesterday. S&P 500, we're going to have to confirm this breakout. It first got above 6,900 on October 28th. We've been kind of churning in a sideways range. Cyclical stocks outperforming. The market definitely positioned for a reacceleration in the economy with the Fed cutting rates and that happy story. S&P also up almost 1.5% year to date. That's 3 trading days. So not a bad start, but obviously want to see if there's any follow-up. The AI trade has been kind of hot and cold, both kind of offsetting one another. Take a look at emerging markets. The global rally continues intact. This is a 6-month chart of the emerging markets ETF against the NASDAQ. And you see very, very close linkage and then this acceleration higher by the emerging markets ETF just in the last little bit. The EM is more than 60% China, Taiwan, and South Korea at this point. China, Taiwan, and South Korea are trading like AI proxies. You know, the Korea index itself is more, it's like half Samsung and SK Hynix. And then today, Hyundai is up huge as well on AI stuff. So that's an AI index. Finally, take a look at these individual excitable AI trades that have happened. This is NVIDIA right here. That's Supermicro. We got Oracle in there. We got CoreWeave in there. Now SanDisk. Everyone kind of surfs to the latest way to play this in a leveraged fashion. We'll see if this one lasts. They tend to roll over after the sprint, guys.
Okay, Mike, thank you. See you a little bit later throughout the day, obviously. Thank you.
We do have some breaking news on the Venezuela oil numbers. Brian Sullivan joins us for more on that. Brian, good morning.
Yeah, good morning. Here we are at the Goldman Sachs Energy, Clean Tech, and Utilities Conference in Miami, Florida. And I've got some breaking news from sources close to the White House. You saw the news maybe last night that the president put out on his social media that Venezuela would sell the United States 30 to 50 million barrels of oil. Well, I'm here to report that is only the first tranche, that it will continue indefinitely. So oil sales from Venezuela to the U.S. and the Western world will be more than 50 million barrels of oil. That was not a one-time thing. That was not a one-time announcement. That the sales from Venezuela to the United States and other Western nations will continue indefinitely. So 30 to 50 million barrels, which is roughly 15 to 25 super tankers worth of oil, that will continue indefinitely. Here's some other breaking news. As part of that deal, Venezuelan sanctions will be rolled back. They will be dialed back, kind of a carrot, if you will, according to my sources, over that. So in other words, Venezuela will sell the United States and the Western world sanctioned oil that would have normally gone to, say, China, is now going to be sold or rerouted to the United States or other Western refiners that can handle the heavy sour crude that is Venezuela. The proceeds from those sales will largely go back to Venezuela or the United States. But the breaking news is that we're going to have more than 50 million barrels of Venezuelan oil by far sold. That oil will be sold to the United States and Western nations, and some of that money will be paid back to Venezuela.
We're confused. I mean, that's a different story than we thought to this point, where it was going to be oil that was given to the United States.
Given to us, and then we were going to sell
the
money.
What do you know? So this is they'll just sell it to us instead of China.
This is all happening real time. This is breaking news. I don't believe it's out anywhere else. I'm here to report it. Sources close to the White House, I just off the phone minutes ago, are telling me that the United States is going to acquire more than 50 million barrels of oil. That is the first tranche as part of that deal, long-term deal. Venezuelan sanctions, it's not out anywhere else. Venezuelan sanctions will be rolled back. This is happening right now.
Brian, what I'm trying to understand is this is part of a negotiation. Who has negotiated this deal on the Venezuelan side? Are we? How is this even
I thought
working?
they said we were getting this. The president said they were giving this oil to us, and we were going to sell it, and then the proceeds were going to be used to help Venezuela and the United States. This is them selling to the United States and other countries sanctioned oil. This is completely different. Are they fixing that story, Brian? Because it was a weird story. We were talking about it earlier. Why is it? Was it blackmail that they're giving us? Was there
Or was
quid
it to
pro
make up
quo?
for assets that have been
I
seized
don't
from
wanna
those
use
companies?
Yeah, I've got all three of my good friends talking at the same time. Hold on, let me take one question at a time. First to Joe. The story is evolving. I don't want to say fixing the story. What we saw from the president last night, 30 to 50 million barrels of oil, that sort of implied maybe a one-time assumption of that Venezuelan oil. What I'm reporting right now from the White House is that that will be a continued source of Venezuelan oil. I don't know the price at which we will acquire that oil, whether it will be given to us or whether we will simply buy it at a discount. There's not many refineries that can accommodate this heavy crude sour oil, but this is oil, and I think Becky mentioned this is oil that would have normally been rerouted to, say, a China. This is previously sanctioned oil. Remember, about 1/3 of Venezuelan oil, not all Venezuelan oil, about 1/3 is sanctioned. This is the sanctioned oil that would have gone to China or another nation that is now going to be rerouted to the U.S. or the Western world. The proceeds will be put largely back into Venezuela for the benefit of the Venezuelan people and help rebuild some of their capital infrastructure.
So, Brian, here's what I'm kind of reading on this. If this is the case, if they are now saying that we're going to be getting all the oil that used to go to China, this almost sounds like it's a tit for tat with China saying we're not going to give you any more access to rare material or rare earths, and now we're trying to fix that. But this is a global play for major resources and commodities that are here as part of all of this. But it sounds like from what you're hearing is those sales will simply be made to us and to other of our allies versus going to China. And we don't know exactly what the price is for those, but this is not something like getting our money back for anything that's been taken from U.S. assets in the past when they nationalized all those assets.
Yes, I'm gonna give you some more details because I want to get it right here on what sources close to the White House just sent to me. The United States is selectively rolling back sanctions to enable the transport and sale of Venezuelan crude and oil products to global markets. Those funds will be dispersed for the benefit of the Venezuelan people. The sales begin immediately with the anticipated sale of 30 to 50 million barrels. They will continue indefinitely. There is no mention of price. What price that oil, whether it's to Joe's point, sort of given to us.
Free. We thought
apologies for the noise behind us.
The implication initially was that for some reason they were giving the United States 30 to 50, and Andrew rightly pointed out that's impossible. This makes no sense. It would have to be in repayment for something, or
That's what we
to
thought.
stay in power. It brought up all kinds of quid pro quo with whether Delcy made the deal so she could remain in power. I mean, it brought up all kinds of. It's totally different if they're just freeing up what they used to sell to China and now selling it to us and to other Western nations. That's totally different than getting 50 million barrels of free oil and using $3 billion.
I will say this, 100%. You asked me for specific names on who the U.S. is making this deal with. I do not have Adelcy Rodriguez. What I do have are interim Venezuelan authorities. This deal is being made between the United States Department of Energy and interim Venezuelan authorities. The breaking news, we're going to reroute that sanctioned, that's key, sanctioned oil.
Right.
And it will be more than 50 million barrels a day.
Real quick, by the way, Brent down marginally right now, but more importantly, you think about the companies that can refine this oil, and to the extent this is an opportunity for them, maybe we can put some of the big energy stocks up on the screen.
Valero would probably pop on this news. Again, this
That's
is
what I was
all
gonna ask. If
happening
you were
real
to-
time.
if you were to
I
think
don't
about
have
the-
any computers or anything around me.
All right, let's just take an intraday of Valero real quickly. Take a look at.
You're looking at Valero, it is
You're right,
popping
Brian,
up.
it's up by 3.6%.
3%. Marathon Petroleum up about 1%. If I remember, Elliott
66
Management
and
had bought
Valero
part of
would be the
Citgo,
two
which I do think
names.
was one of the companies that actually can refine some of this stuff. The
Correct.
subsidiary of Citgo.
Elliott Management's in a proxy fight with Phillips 66, but Valero, PSX, Phillips 66, to a lesser extent, some of the other refiners would be. I'm going to have more. Listen, Chris Wright's about ready to speak here at the Goldman Sachs Energy, Clean Tech, and Utilities Conference. I'll get more headlines when we have them. This is breaking news. And we're going to be interviewing the Secretary of Energy exclusively in Power Lunch live today in the 2 o'clock hour, although maybe it'll happen earlier now. I don't know.
Okay.
Brian, this is fantastic. Thank you for bringing all of this to you, and we look forward to hearing that interview later and getting more details on this. Again, Brian Sullivan, who is live at the Goldman Sachs Energy Conference, and will be talking to the Energy Secretary later today. Squawk Box, we'll be right back. Welcome back, everybody. A huge milestone in corporate America over the course of the last week, and that would be Warren Buffett stepping down as the CEO of Berkshire Hathaway. We've got a programming note for you in honor of all this. We have a special program coming up next week for you. You can tune in to Warren Buffett, A Life and Legacy. It's a new primetime special that you can see right here on CNBC next Tuesday at 7 p.m. Eastern Time. In a series of never-before-seen interviews, we spoke to Buffett about his views on business, philanthropy, and life, and Berkshire Hathaway's historic cash pile, which is now worth about $358 billion.
I'm willing to spend $100 billion this afternoon. Yeah.
Glad I'm here today.
No, I'd rather have $100 billion in a really good business bought at a sensible price than have $100 billion in cash. I know the cash, I mean, it's certain levels necessary, but cash is not a good asset.
Yeah. There are a lot of people who have wondered if Berkshire is going to continue to build up that cash pile, if they eventually will give it away in dividends to the shareholders, or what they'll do with it. But his point is yet that, yes, he and Greg Abel, the new CEO, are both looking for a deal to do at any point. If they see one, they will deploy that cash at will. Buffett's three children, Susie, Howie, and Peter, also join us to discuss the monumental task that their father has given them to eventually give away his entire fortune. Tune in January 13th and you can see all about it.
Okay. We're looking forward to that. We've got some more breaking news literally as we speak. When we get back to Brian Sullivan, who just broke that story about what's taking place between the White House and Venezuela as it relates to this oil situation. Brian?
Yeah, because the White House, watching our reporting just a minute ago, and sources close to the White House letting me know that they wanted to not clarify anything, but just add some color to some of the questions that you had. I'm going to take my phone, you forgive me here, and throw it across the room. There we go. The oil will be given, to Joe's point, given to the United States. We will not buy the oil, but we will sell the oil. The proceeds of that money will then be kept in various American banks. I do not know which banks they will be kept in. Maybe it will be dispersed around a bunch of American banks. The proceeds of those sales, which as I just reported will be over 50 million barrels, the proceeds will be kept in American banks. And then when the president and his team deem that the Venezuelan government and infrastructure is ready and stable and secure enough to receive some of those funds, they will receive those funds back into Venezuela for the benefit of the Venezuelan people. So in other words, it's kind of the carrot. We're going to get oil from Venezuela. We will sell it, market it is the term, around the world. Those funds will be kept by the United States, held in various American banks, and then dispersed largely or entirely back to the Venezuelan people for their use once it is deemed that the country is stable and safe enough. And as part of that, as I reported earlier, the sanctions will be rolled back. Part of
Brian,
Yeah, and it goes back to Venezuela. It doesn't go for it doesn't. It's not for the American people, but I guess indirectly it's good for commerce. But
it will sit in American banks.
Right, but the proceeds go back to Venezuela.
But it sounds like they are working on a way to try and root out the corruption and make sure that it's being
Right.
spent on infrastructure projects going
Yeah,
back
you
in
don't want to
and
send, you don't
potentially
want to
being
send
held.
$1 billion.
Potentially being held
Back to
to say
Venezuela
we want to
because
make
they'll
sure we
always be
approve
pilfered.
of this government.
Yeah.
But the thing that I'm trying to understand, Brian, and maybe you can help us with this, this is ongoing, so it's not just a one-time scenario. We will be getting effectively free oil from Venezuela. How much free oil are we going to be getting for the foreseeable future? And then how's it priced?
30 to 50 million. 30 to 50 million. So it's going to be priced on the global market price. So let's just do some very rough math. The first tranche, which is happening now, 30 to 50 million barrels, as the president put up last night. Call that $50 a barrel. I'm making the number up roughly on the wholesale market. That's $2 billion. Okay, $2 billion. We will continue 30 to 50 million barrels in perpetuity. There is no end date, so it could be 100 million or 200 million or 1 billion barrels of oil. Whatever that oil is sold for on the market will come into American banks. American banks will sit on that money until the Venezuelan government is deemed to be secure enough, stable enough, safe enough, and to Becky's point, sort of free from fraud enough that some of that money can be put back into Venezuela for the benefit of the Venezuelan people. And as part of this deal, sanctions on that Venezuelan oil will be rolled back, kind of the carrot.
Well, lift the
versus
sanctions if
the
you let us
stick.
sell it and hold on to the proceeds until we deem the government as one that will safely use.
Brian, does it go to the Treasury first? It would have to go to the Treasury first, I think, and then go to the banks. That's what I'm hearing from budget type. You get a finder's fee?
I don't know the answer to that.
Do we get anything out of it, a finder's fee, or do we
Oh,
get?
we don't know that's.
Yeah, I know that wouldn't work. This would work.
Well, we're getting the oil. To your, yeah, to your point, we're getting the oil. So the finder's fee effectively would be the sale of the price of oil. Now, whatever price that would deem, I assume it's going to be the fair market value around the world.
But then it goes
A lot of, again, you're asking all the right questions. This is why you guys are the best in the business. There are some unanswered questions at this point. Obviously, throughout the day here, I will do my best to acquire said answers. But
And you've got
there's
the
your
energy
news.
secretary coming up, and he can clarify all of that as
So
well.
the Truth Social post is actually, but it's. We didn't realize it meant most of the proceeds eventually go back to Venezuela. We're not gonna.
And that makes more sense.
Yeah.
I hope it does.
It's, yes, some. I don't know if it's all or some of the proceeds, but I appreciate our entire team for letting me hop on a plane last night and come down here, guys. Thank you.
Brian, thank you. And we'll be watching later.
Okay, coming up next, a busy jobs data-driven week for the market's former St. Louis Fed President James Bullard is going to join us on his outlook for the labor market, the economy, and so much more. We got all this breaking news. We're coming right back.
Joining us now, former St. Louis Fed President Jim Bullard. He is now James Bullard. He is now Dean of Purdue University's Mitch Daniels School of Business. Now I can call you. I introduce you as James and then call you Jim. Welcome. It's good to have you on. I'll just put this out there. So the Dow's almost at 50,000. The labor market might be showing signs of weakening a little, but for every bad number we get some numbers that say, no, it's not that bad, and it's 4.6%. Inflation may be stubborn, but it looks kind of like it might be anchored. It could eventually come down. Is this the greatest Federal Reserve in history in terms of managing things that you were part of?
I think the committee's in pretty good shape right now. They've got, on the labor side, I would just stress, Joe, that you've got to take the immigration policy into effect. Some of the estimates that I've seen around the Fed and elsewhere suggest that the run rate with the new immigration policy that the U.S. has starting last year, the new run rate for non-farm payrolls would only be 30 to 50,000 or something like that. So when you get a number like 70,000 or, you're actually above the run rate. I don't think that the market has completely brought that online in their thinking. We're used to thinking 150,000 jobs or like that. So I think that's been tough. And we didn't have this immigration policy before, so it's all different. So I think that's why the labor market actually, on other indicators, seems fine. You've got unemployment insurance claims, for instance, very, very stable and very low. So So there doesn't seem to be any problem on that side, and even the 4.6% unemployment rate, that's close to what most people would say is the neutral rate, or the natural rate of unemployment, mid 4% range. So pretty good outcomes there. And then inflation's hanging up a little bit high, and so the committee wants to stay up a little bit above neutral, the neutral policy rate, to try to continue to push inflation down. And if inflation does continue to come down during 2026 here, then they'll have a little room to maneuver a little bit farther, not a lot farther, I think. But right now, I think they're in a good place, and they're probably reluctant to move too much from here without seeing more data.
And some of it might be AI related on both sides of the dual mandate. Some of the, the reason that companies may not be hiring as much, but aren't really laying people off as much, that could be AI related. And then, obviously productivity and inflation. Remember what happened to inflation the first time around with the internet? I mean, how long did that tamp down inflation? Just the long-term effects of the new world.
There's a famous episode in U.S. monetary policy, and Alan Greenspan called it. He said, I think we've got a productivity boom going on, and we could be on the cusp of that once more here. And I think the late 90s is a good benchmark. We're not exactly like that, but it's a good benchmark to think about and to look at. And when you think about how the internet, sort of permeated through the whole economy, it did drive productivity, even though you couldn't really point to, particular examples where all of a sudden it did something, that's really noticeable. But it permeates the whole economy, and that's where the productivity gains come from. And the productivity numbers have been good for the last 2 years, and look like they'll probably be good for this year too. So that's pretty good news for the U.S. economy.
And people that want to criticize the current economy say, have you ever seen the unemployment rate rise 0.5 point and not indicate either a recession or a slowdown? And I hate to say it's different this time, but this way you said 4.6 is not far in this economy. That's probably not far from full employment. But
I think the way to think about this, it's great to look at macroeconomic history and try to infer things, but this time was a little bit different. You had this gigantic pandemic, and then you had that, very rapid recovery from that pandemic, and that drove the unemployment rate way down into the 3% range. It's the 3% numbers that are kind of abnormal for the U.S. economy. And then that kind of all settled down, and now you're in the 4% range, and that maybe is closer to the natural rate.
I mean, Jay Powell, suffers the slings and arrows of the president, but deep down, a lot of the things the president says are bluster. He's always going to want lower interest rates. He's always going to, want it his way. But things are in the stock market, job market, inflation. Things are pretty good. I think deep down he knows that, President Trump.
Yeah, it's a bit of a mixed message. I think that this pro-business administration's done a lot of good things, and we're looking pretty good for growth. They don't really need the lower interest rates, and they don't need to take the risk that inflation would reignite here. That would be very troublesome for the economy, for markets, and politically, I think. So that's what you want to be guarding against here, and let the economy run, because it's running pretty well.
What does that indicate to you on who the president picks? That he doesn't need to pick a rubber stamp, and I'm not going to name names, but he could pick someone that is really good at this and would raise rates when you have to, and not raise them and not cut them when you shouldn't. Who do you think he's going to pick when it's all set? You think he'll make the right choice?
I think he's got a good set of candidates in front of him, so there's not really a wrong answer, I think, from the president's point of view. All of these people have skills that they can bring to the table and would do, I think, a good job. I don't think that you really need to have this story about driving nominal interest rates, really, really low. I think if you get to a really low nominal interest rate or zero interest rates or something, that probably is not a good day for the U.S. economy. It probably means that something has gone badly wrong, and that's why you're at this super low rate. So I think, I don't think you really, the White House probably doesn't need to press so hard on that issue, and you really want competent management, and you want reform at the Fed, which is something that Secretary Bessent has emphasized.
This year and next, bell curve for GDP, what's it right in the center? You think, I mean, 4% would be on the right side of the bell curve, would 2% be on the left side, or is 3 in the middle, or is it 1 and then 3 and 2 in the middle? Where are we? Have we moved on?
I'd put down a 3 for this year, 3% growth. You know, acknowledging that there are risks out there, but I think there is some upside even to that.
Even to
we
3.
could get faster growth this year, so I think it will be a good year for the U.S. economy.
That'd be amazing. That'd help with that'd help with that 40 trillion. It's gonna be 40 trillion, like next month or something, or like in 4 months.
Yeah, I mean, one thing that happened in the second half of the 90s, you did get rapid growth, rapid productivity growth, and that did help a lot. I mean, I don't want to take Congress off the hook. They do have to control.
Don't say that.
Yeah.
It's me on, yeah, okay. Jim Bullard, James Bullard, thank you, as always.
All right, take care.
Meantime, other big issue we were talking about all morning, California's billionaire tax has a hidden feature. Here's a hint, you can check out anytime you like, but you can never leave. Robert Frank is at the table this morning with the details on that hidden feature.
Yeah, I call it
It's a
the
hidden feature, some people call it a bug.
It's a bug. It's
You're talking about roaches.
I call it the Hotel California provision. So we've all heard these reports. Peter Thiel, Larry Page, and other California billionaires threatening to leave the state over this possible billionaires tax, but they may be too late. And here's why. A ballot measure that could come up for vote in November would impose a wealth tax of 5% on California residents worth at least $1 billion. We know all that. But proponents say it would raise $100 billion to offset federal cuts for health care. To ensure that billionaires don't rush for the exit, the tax would actually be retroactive to January 1st, 2026. So that is last week, and 11 months before the tax could actually pass with voters. California has strict tests for proving a new tax domicile. You have to have moved your home, your doctors, your bank accounts, your pets, your family photos, your cars. Even your country clubs have to have moved. It also helps if you move your business. So doing all of that in the final weeks of 2025 would have been difficult. Lawyers say the wealth tax may also be illegal, especially since it would be retroactive. And even if it passes, billionaires would likely challenge it in court. Now, for more on what it takes to actually change your tax residency in California and the potential impact of this billionaires tax, you can sign up for the new Inside Wealth newsletter out tomorrow at cbc.com/insidewealth.
I mean, there's so many questions about whether this is even legal, whether they'd be allowed to do that. I guess this will be challenged.
The legal challenge is, did you allow due process? So did people really have a chance to follow the law if the law is passed 11 months after the deadline for the tax? Now, what's interesting, I found out the union that's sponsoring this actually initially provided the start date in 2025. And then even they decided, well, that's a little bit of an overreach, so we're going to go for January 1st, 2026. So most people in California first heard about this in December, so it means they would have only had a few weeks to do all these things and actually get out in time. So that's when you see these reports, Peter Thiel could leave. Well, if this passes in the way it's structured, they probably ran out of time.
Even though they put out this press release on December 30th.
And that's why they did that. I think that especially Peter Thiel did this. He put out a release explicitly saying, I have established a history of a presence in Miami with my house, with my business, so therefore auditors, it's out there.
What's the polling suggest in terms of just whether this will pass?
Tax increases in California have a very mixed history on the ballot. And so I think the thinking is, especially since there's a lot of mobilization on the opposition side of this, that I haven't seen any good polls yet, because this is brand new. The thinking is it probably won't pass, but we're, as you pointed out, we're in a very populist age right now. We see what's happening in New York, the politics here. This could be different.
Robert Frank, thank you.
Thank you, guys.
Thank you. All right, folks. We're going to take a look at the futures right now. It looks like the Dow futures are up another 100 points after the Dow closed at a record level yesterday, above 49,000 for the first time ever. We're also seeing the S&P futures up by another 3.5 points after it also closed at an all-time high. Folks, that does it for us today. Make sure you join us tomorrow. Squawk on the Street will be here after this break.
Welcome to Squawk on the Street. I'm Carl Quintanilla with Jim Cramer, David Faber at Post 9 of the New York Stock Exchange. Coming off the S&P's first record high of the year, there is plenty to monitor today between geopolitics, Venezuela, Greenland, oil, and the employment picture starting to fill in. ADP mostly in line at 41K, ahead of the jobs number on Friday. We do have the 10-year down to 412. Our roadmap begins with this recent rally. S&P and Dow at record highs. Dow getting closer to that 50K mark.
President Trump is saying Venezuela will give up to 50 million barrels of oil to the U.S. And we have new reporting that oil sales from Venezuela will continue indefinitely and U.S. sanctions will be reduced. And Warner Brothers Discovery once again rejecting Paramount's latest offer to buy the company, continuing to prefer the merger agreement it has in place with Netflix.
Let's begin with some breaking news this morning. For that, we're going to get to Phil LeBeau in Seattle. Morning, Phil.
Take a look at shares of Alaska Airlines. Why are we showing you Alaska? Alaska placing a huge, and I mean huge, order with Boeing for 120 new airplanes. The order breaks down like this: 105 737 MAX-10s. That's the stretch version of the 737 MAX that is expected to be certified this year. First delivery is likely in 2027. They're also ordering 5 Boeing 787 Dreamliners as they continue to expand their international route network. When you look at Alaska's order, now airlines never pay list price for a new aircraft, but if you look at the list prices for these 110 aircraft plus another 35 options, comes out to approximately $17 billion. Not a bad order if you are Kelly Ortberg, CEO of Boeing. By the way, Boeing ended 25 with more orders than Airbus. That is the expectation when the final numbers are announced within the next couple of days. That would be the first time in several years that Boeing outpaced Airbus in terms of orders. Ben Minicucci, CEO of Alaska Airlines, will be joining us exclusively coming up later on this morning on Money Movers. We'll talk with Ben about this order, guys. And what's most interesting is that it's almost 2 years to the day from when Ben Minicucci was giving interviews after the door plug blowout. He was furious. He was fed up with Boeing. He was close to saying, you know what? We're not going to take your planes if you can't improve. 2 years later, they're going to be spending list price value approximately $17 billion on another 110 Boeing airplanes. Don't want to miss that interview. Guys, send it back to you.
Okay, that's fantastic news. Full disclosure, my top is a big position in Boeing. I had John Holmes last night from AAR Corp. I mean, they do a lot of servicing for aerospace, and he was saying, listen, Jim, don't get ahead of yourself. There really aren't any planes available until 2030, but when I listen to this order, I think that the 787s are available, right? It's not 737s may be in tight supply, but Boeing may actually see some of these earnings this year.
And they're ramping up production, Jim. I don't know the exact cadence on the deliveries of the Alaska 787 Dreamliners, but this is an important part of this order. Yes, the 110 aircraft will get the headlines, but these 5 787 Dreamliners, a little bit later on today, we're going to be seeing what they plan to do with these aircraft. It's for expanding internationally. And I know a lot of people who watch this in the United States on the eastern half of the U.S. They're not familiar with Alaska, and they think, well, that's a nice little airline out there on the west side, on the west coast. They're growing. They're growing. And Ben Minicucci is adamant that this is crucial to their future. We'll talk with him at 11.
Phil, appreciate that. Big news to start the morning on the aviation front. That's what Phil LeBeau.
He's like nailed it.
A little bit. Boeing is the third best Dow name of the year so far, Jim, behind Cat and Goldman.
Well, look, I think the short supply, that's been the theme, by the way. Whenever it's Micron, short supply, SanDisk, short supply. Short supply and high demand equals higher price in this market. Some of these stocks have had parabolic moves. I don't trust the SanDisk anymore. It's too strong, Western Digital. The Boeing, I think, is really just recovering from a real mistaken sale. At the end of last year, Kelly Ortberg has always taught you free cash flow, free cash flow, free cash flow. The stock, they had great free cash flow. The stock still went down very big. That was just a mistake, and the stock has bounced all the way back. The market is being done, it's equal weight. I was listening to Frank Collin this morning, it's show at 5. It's the S&P equal weight, which I love, because that means this thing is not being done by David's non-favorite, NVIDIA, which you have killed by saying to me every day, Jim, if it's so good, why is it doing nothing?
Oh, it's my fault.
Kind of. The only person.
By the way, it did do something. Look, it's up 1.48% in the last 3 months.
Well, don't make fun of me.
That was not making fun.
I'll make fun of your interview with Warner Brothers Discovery.
You will?
Nah, I thought it was really good.
Oh, thank you.
I was trying to find things to say that were not good about it.
We'll talk about that later. But you want to talk about NVIDIA now? Or
I think you have to talk about what's going on. The lower end chips are doing very well. The high intellectual property are not. Happiest article, by the way, about Google this morning in the journal about how Code Red, talk about Code Red. They heard the call. I thought that was terrific.
It was an interesting blow by blow in terms of how over the last year, Google really it turned it around, so to speak, in terms of taking the lead potentially, some would say.
Right. Well, I do want to point out that Jensen is adamant. Jensen Huang, CEO of NVIDIA, did say, listen, 90% of these guys are good, 10% bad. We all seem to have stories. I was on Gemini yesterday. I've been praising Gemini David. I had found an error that was so bad that it apologized profusely. I don't like that. It still can't be used on our show. It's too dicey. It isn't strong enough to be used on Squawk Street.
And you saw the comments from the Dell executive at CES saying that maybe some of these AI features are driving people away on PC purchases.
Look, what they're doing is they're taking all, they compile, that's Jensen's word, they compile. And they tend to compile from some really sketchy sources. We would never, I don't want to single out any particular source that they get wrong with, but they're wrong so often that it's just simply, sure, maybe you can use it to be able to evaluate proxy forms if you're JP Morgan, but it's not good enough to use on the show. It's embarrassing.
And we won't.
You shouldn't. Yesterday I was asking how W.K. Kellogg is doing. He says, oh, it's doing fine. It's really terrific.
And then you said, are you sure?
Well, deal closed. It got bought. It was completely wrong. But
Kellogg's
everyone has those.
Separate company that was bought by Ferrero.
Yeah, exactly. So I just point out that we can't use it. It's just not. It's just not acceptable.
My own AI right there.
That's all you need.
Yeah.
Well, you had AI this morning when you drilled down on Warner Brothers Discovery.
Yes.
I say 34-0. I know we're all over the place. David hates that linear stuff.
We're gonna come back to it. We have a whole block devoted to
I've got
it.
the RSUs. I'm trying to figure out how much Waldron. I think Waldron's up because they.
Oh, that was yesterday.
Oh, that was yesterday.
To your point though, Jim, NDX is up almost 2%. A lot of it is semi-cap and memory, to your earlier point. NVIDIA's red or flat year to date. Apple, Tesla, Apple Oven, CoreWeave. Does this thing get broader on a pro-cyclical trade or the AI trade?
I think that everything is extended that has got lower, that has historical lower price earnings multiple in that chart. Lamb is really good and they have a lot of orders, but Western Digital short squeeze.
It's the best S&P name of the year.
It's a short squeeze. I own 5% of Western Digital. I own 5% of them. When I thought that it was going to do this, and it did. And a lot of people want to bet against these companies because the moment you get that one extra drive or one extra NAND, this Flash is doing very well, SanDisk, then it's just over. And a lot of hedge funds came in and said, you know what, this can't last. The problem is the demand is so much stronger and pricing is so firm that you have to raise numbers endlessly. We're back into the 94, 95 micron cycle, which was just one of these incredible cycles. But I did hear yesterday someone use the term super cycle. We've had 3 super cycles in the last 15 years. Coal, fracking sand, and this. Be very careful.
Yeah. Goldman yesterday, desk note, said it feels to them like January of '99.
I like that analysis.
They went hot.
I like that
analysis. It would have been too early if you wanted to top it out.
It was a great year.
It was an unstoppable year. That was the Qualcomm 1000. Remember?
That was GE hitting all-time highs, market cap all-time highs. Well, until
I don't want people to get hurt. Those stocks have had a monster move, and at this point, you have to wonder: do you really want to come in? Micron's got some good stuff happening. Okay, there's definitely. But when you look at the lower quality multiples, historically SanDisk, Western Digital, and you're paying. As if this shortage is going to last forever, and they never last forever. One day, Lam Research will produce the additional one widget, and you will see equilibrium, and that's the end. So I want people to be very careful that a lot of people made their year in the first 3 days. Made their year, hedge funds, and they're going to go.
And move to?
Okay, I think that the companies that are very reasonable are the non-data center industrials. Those are terrific. I was going to say the banks, but they had another big move yesterday. Healthcare ahead of the JP Morgan conference, where there's still money to be made. You had a double upgrade today of Regeneron. I mean, that thing's been just okay. I see those stocks as having historically lower multiples, and I want to look at retail, which has been stalled. And I think that there was a recommendation of lows today ahead of what's going to be, I think, a Fed ease, another Fed easing cycle.
Barclays ups to overweight, ups Wayfair to overweight.
Excellent calls. I can get behind those because we're going to have rate cuts. And how do I know that? Because we have a new Fed chair coming, and I don't think any of those Fed chairs are all. I mean, everyone's independent of everyone, except for when it comes to cutting rates.
So we get a rate cut, yeah. We get with the new Fed chair. It's all good.
He asked me which ones you would buy.
No, I heard the answer. It's good.
Right.
I liked it.
And I just think that I'm looking for stuff that hasn't moved. I mean, do I want to buy Target with the new CEO? I don't know. I'll give you another group that if they're creative, the reason I looked up to Kellogg was I wanted to see what the new CEO, Kraft Heinz. Holy, I mean, he has lots. Kelly, Kelly's got a chance.
Used to run Kelly.
He brought it huge value. Could he do it again, Kraft Heinz? Conceivably. But I think this group led by Colgate, The non-GLP-1 consumer packaged goods stocks are at historic lows. They're very intriguing.
Well, to your point on that, got an upgrade of Hershey today over at Piper. Got an upgrade of McDonald's and Oppie. So you're not the only one looking for things that have been ignored.
The McDonald's piece was a very good piece. Again, unfortunately, cattle's up again at the beginning of the year. Cattle, and that's so people are going to say, listen, beef is going to make it so you can't pay $3.60 for McDonald's, and that's true. And you can't, as much as Shake Shack, I love it, is up 6 or shit. That's late. I don't want to be in something that I'm late to the move.
Because but how late are you to the move? I mean, maybe we're in a momentum market right now, and you just want to, keep going. Own the banks.
You're right. You know what? Everything I said I want to take back because I think it was fatuous and I don't believe it. What do you want me to say?
So focused on
really? No, next slide. What do you want me to say?
You used to be from the church of what's working now. What happened? Well, now you're about the church of what's going to work.
I became much more Jeffersonian and Gandhi. I try to be a little more. I was asking to stocks that haven't moved. It's a Costco versus Western Digital.
All right.
Do you know what Western Digital does? You think it's a company, it's a West Coast company that does digital work?
Do I do what they do?
SanDisk is like Sandbox. What are you going to say? What are you saying? What are you saying to me?
I'm not saying that move is
Seagate,
justified.
what you bought a place in Delray in the Seagate. It's very good. It's walk off the beach. A lot of younger people there. Seagate.
I get it. It's in Jersey, isn't it? Yeah.
No, it's in Delray, Florida.
I thought it's in southern. Oh yeah, all right. I thought Seagate.
I'm gonna put you in Seagate. That's a sunrise senior living place. I'll put you in Seagate. It'll be very nice for you. Good
I'm headed there, I'm sure. You and I are going to be playing.
Not me.
What do we do? Shuffle?
Not me.
Partner? Something? Not you, never?
I'm going to be launched by SpaceX, go to Mars, turn into a 30-year-old.
Oh, you're going to be on the thing on the Starship with Musk and all his descendants.
I'm the second. I'm going to take some of his trillions.
Jim Cramer
turn back my age, because that's what it does. When you're a trillionaire, don't you get to turn back your age?
You do. You can just have to go faster than the speed of light, and suddenly you're younger.
Yeah, $34. There. That's everything you need to know about your Warner Brothers discovery.
We'll get to Warner in the news that David brought us earlier today. We'll get to a bunch of other names: GME, Albertsons, JPM, Strategy. When we come right back.
Welcome back. Keeping an eye on shares of Warner Brothers Discovery this morning. As expected, the company's board of directors has rejected the latest iteration of Paramount's offer to acquire the company. $30 all cash, but remember, they now added that guarantee, personal guarantee of Larry Ellison for the $40.4 billion in equity as a part of the transaction. Not enough to sway the Warner Brothers board, which in its 14D9 filing, which details in voluminous fashion many of its concerns, and then in a shareholder letter, it goes on as well to sort of really focus on a few. Some new, in fact, and one in particular that I would focus on here, because there is that question as to whether it makes it almost seem as though no matter what Paramount might try to do, there's nothing it can do, because in its shareholder letter on 14D9, the company raises the idea of simply the leverage at Paramount when it would acquire Warner Brothers Discovery, and the decline in the overall business of Warner Brothers Discovery's global networks, perhaps, the onerous conditions associated with a Paramount deal, bringing that business to a level in which you might even be able to declare a material adverse change. It's a number of different areas here, but that one got my attention perhaps the most, saying the operating restrictions between signing and closing imposed on Warner Brothers by the offer could damage our business, allowing it to abandon the offer, onerous covenants, restricting Warner Brothers' ability to modify, renew, terminate affiliation agreements, and they go on to say, as I said, enabling Peace Kindness financing partners to terminate the transaction or renegotiate the terms of the transaction. That's a key question here, and the one I put to Sam DiPiazza, the company's chairman, basically asking, well, it would seem to imply that no matter what Paramount does, it's not going to be enough.
So aren't you kind of saying you've got no chance here, Paramount?
No, there are paths. But let's start with, we have a compelling offer from Netflix that is a $400 billion investment grade company, and with a clear record-setting termination date. Now,
I get all that, but what are these paths that you're discussing then if you continue to say, well, leverage buyouts are risky in their nature?
I'm not going to do their deal for them, and in fact, we have a deal with Netflix, but the questions that they have to deal with is how can they give us certainty that they will close?
They haven't done that with a personal guarantee from Larry Ellison?
That gets the equity to the table, but the entire sector is under stress. And remember, we're 18 months, 15 to 18 months from closing. Financial markets can change, the market conditions generally can change, and the media business, particularly the linear business, is under stress. So what happens if at that point they decide, you know, we're just not going to close?
It's an interesting defense, and it does raise a lot of questions, guys. They do seem to be saying that they want Larry Ellison, and they didn't say it specifically, but I think you can read between the lines, to step up and guarantee the entire thing. Not just the equity financing, but the debt as well, to conceivably be there. I mean, it's also interesting to hear a company comment on the state of its own business in terms of it being somehow dislocated even more as a result of signing this deal in that 15 to 18 months and what it would mean for global networks, which, by the way, right now on the Versant multiple, global networks is worth probably 20 cents a share.
And that's on EBITDA. Whatever the future.
3.8 times is where Versant's trading right now. Now, they will argue that global networks is a different business, a lot more free to air, sports in Europe, CNN itself worth so much more. But if you do it on a pure multiple basis, enterprise value over EBITDA, 3.8, you get basically no value given the debt load at global networks. I do think it's interesting to hear them talk about the debt load of the combined Paramount Warner Brothers. Meanwhile, they've got an incredibly highly levered entity as well. Not as highly levered, to be fair, as Paramount would be. But why is that an issue for shareholders of Warner Brothers? Once they get the cash, who cares?
Okay, so let me ask you. I listened to that. It was a great interview. And I come back, I say, why didn't he say, for $34, done?
He said, we're not going to do their deal for them.
I know.
And he did say they didn't raise their price. He mentioned that earlier.
Right. But I did find it, I thought it was very cogent, and I did say to myself, look, is David going to ask whether they have an animus against?
And he
And your question was the most important question.
And he says they don't. They continue to seemingly have these concerns, though, and I raise these because they are different than the ones we'd heard, some of the ones we'd heard previously. Now, there's plenty of math we can do here around what they feel is a liability they would inherit should a Paramount deal not happen, the $2.8 billion break fee they owe Netflix, the $1.5 billion associated with having to refinance their bridge loan that they wouldn't be able to do. So those add up, and that's important. And it is unclear as to why Paramount hasn't just made it clear what it's willing to do about that.
What was great about the interview when you made the book, ultimate takeaway was, okay, listen, are you watching, Ellison? Here's the deal. This is what you have to do. There is a path that they laid out, David.
There is, but I do wonder with this objection to the overall, just saying, listen, it's the largest leverage buyout of all time, and sometimes your lenders can get a little squishy on you.
Yeah.
I don't see how you cure for that.
No.
And by going up, you're only increasing the concern.
Which is why Andrew asked you whether or not there was the possibility. They say, you know what, this isn't worth the trouble.
I don't think they're going to.
You said no.
Carl, I fully believe that Paramount will continue to fight this, and in all sorts of ways. They're almost undertaking now more of an activist campaign. It wouldn't shock me if they were to sue them in some way at some point and try and take some things to the courts. They're going to use shareholders, and in fact, we're going to have one of the largest shareholders of Warner Brothers join us in the next hour Squawk on the Street, Matt Halbauer from Pentwater, who believes the Paramount deal is the better deal. They're going to try and pressure that way, and then we'll see what happens when we get closer to a shareholder vote, which, guys, is months and months away.
Let me conflate a topical issue and let you opine on it. This is a deal that you might have had, say, an ISS or Glass-Steagall have had.
Yes.
If you put these through the rigor of the new J.P. Morgan method of AI, which deal would be pure AI?
I don't know how the AI is going to rule here,
But
Jim.
isn't it interesting to see whether, I'd love to know what the asset managers at JP Morgan are going to be relying on.
And you're raising a good point. The proxy advisory firms and their power continuing to potentially be curtailed, the influence they have over index funds, which prove very important in potential votes like the one we're discussing.
Mary Erdos, how would you do it?
Depends on which model you use, I guess.
Well, it does. I just hope they don't use.
Should we do it now? Should we ask Gemini and Chat and Grok
Do
for
it.
their
I'm
opinion
going to do
on?
it. Perplexity. Don't forget.
Put it in there.
Grok's got lots of people who are undressed. That I don't get.
Let's do
Yeah, I
that.
think we know what Grok would say.
Yeah.
What would Grok say?
He'd say Paramount.
Yeah. Right. Anything goes.
Yeah.
He'd say, I want to buy CNN.
Yes.
Can you imagine Elon Musk owning CNN?
I just think it's a very interesting thing what they're doing at
Yeah,
JP
well,
Morgan. So they're going to
it is.
save a lot of money,
We'll
but
get
is
to
it
that.
accurate?
Earnings coming Tuesday. We'll get Kramer's Mad Dash and the opening bell in 5 minutes.
La 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 la. Oh boy. No giving up.
picking the phone up during breaks, getting yelled at. What do you got? What do you got for the Mad Dash? I know. Thank you.
All right. I'm going back to the point that we raised at the top of the show, which is what's still inexpensive. And it's what's hated, and that's the problem. This morning, Citizens downgrades Lennar. Now, if you take a look at Lennar happened to be as high as 140, right? Now it's at 106. Do you want to buy Lennar? Well, the fact is, Lennar's got too much inventory. Remember the days when home builders used to have too much inventory? And prices are going to come down. Now, Lennar happens to be great. This is Stuart Miller. He's one of the greatest home builders in the country. So he's not, there's nothing here that's like, oh, wait. But do you want to buy a quality home company builder ahead of a couple of rate cuts, but you also have to deal with maybe a strong employment number? And the answer is, it's too hard.
It's too hard.
7 times earnings.
You're trying to sort of think about rotating the safer stuff in a way, but it's hard to do.
$7 is 14. Yeah, it is. I mean, last night I had this. I really this company too. I had this company, AAR, okay, and their numbers are explosive, and they had an amazing quarter. So do I want to come on today and say it is time to buy air when it's at all-time high and it's got a big valuation now? The answer is that if you come in now, you better have a darn good reason ahead, not before. Air already reported. Sanders has already raised prices. We already know what's going on at Seagate. You have to have something so
Let's get the opening bell on the CNBC Real-Time Exchange for the big one. It's Postal South Ventures celebrating a recent IPO at the NASDAQ. Lyra Health, provider of mental health services. We did keep a close eye on the XLV yesterday, Jim, and health in general.
Well, look, I think you have to. I mean, we had a double Educator general on something that there may be new life. We had
Well, getting ready to short it.
obviously Eli Lilly about to do a deal, and I think somehow seems
I really thought about it.
that deal was going to come next week. This is a deal, a very small deal, $1 billion, but I thought they would be announced. Ventix, it's TYX, a lot of buying ahead of that, by the way, just want to put that out. Not like Poly Market in Venezuela. That was a DK trade.
Oh, the $400,000 that was made by somebody on Poly Market who was betting on Maduro's capture? Yeah.
I spent a lot of time on a recent trip with talking to some really high-level bankers who said the biggest problem they're going to have with the poly markets and the calciums is, okay, is a overthrow considered to be just Maduro? Is an overthrow?
Yeah, who's the arbiter of all that stuff? Who makes the book?
It's kind of like at that moment in Apocalypse Now when you're going up the river and Martin Sheen says, "Who's in charge?" and the guy says, "You."
The horror.
Great movie.
Yeah, but I do think that we're searching. I think we're all looking to get into this issue. I was looking at PepsiCo yesterday. And I said,
really?
Yes, because it's got an activist. It's got the possibility of, we can go back and do maybe a Kellogg to it, split it up. It's at 4%. It sells at 17 times earnings. Historically, you got a 23 mobile. But then I come back and I say, okay, Eli Lilly's.
I was going to say, leads you right into a discussion about GLP-1s.
I just don't see a way around it.
You don't?
Is Mars going to buy? I mean, Mars bought Pringles. I mean, maybe you combine that with Frito-Lay. I don't know. Look, I'm just saying it's fraud.
See what happens here at the 200.
I mean, Costco not fraud. They're going to do the numbers. I think the re-ups are going to do that.
Yeah, I was going to. I really thought about sitting here and buying that put, but I didn't.
I see some.
Goodbye, Kramer. Lucy's nice little pop. That's a penny stock. Ooh, AMD knife. Ooh, man, AMD. Watch AMD today. Ooh! Ow! Ow! Wow. I hit a sore spot there. I hit a sore spot. And we had coin with that upgrade and Mister along with it. And I alerted Mister yesterday with that upgrade. Mister. Not really doing much. Apple moving up a little bit. Jeffries downgrades First Solar. Huh. Oracle. They were pumping Baba yesterday. Google's up today. It was down yesterday. PLTR. Well, they got some very volatile mornings. Same tickers up every day. I go over them every single day. QQQ breakout. SPX double topping. We're at resistance on SPX. Prepare ye. We broke resistance. My resistance is about $3 lower. $694789. kind of watching here. Little Tesla hammer. $69.51. Oh, there it goes.
Fixed index annuity. And so essentially the way that works is we're buying the S&P 500.
Oh, yeah.
People think that all annuities have a lot of fees. The very best ones, the ones we're buying right now have no fees at all. None. And the way it works is if the market goes down, you lose nothing. If the market goes down 50%, God forbid, you get 0 for the year. If the market goes up 10, and the best accounts have caps of 10 right now, you make 10 for the year. No fees. Right, and you can, your gains lock in on an annual basis. Market goes down,
you can't beat that.
The very best products, the sweet spot of the market right now, is about a 5-year account. That's how we're buying the market. So we're optimistic, but we're covering the downside. I mean, the Fed's got a tough job to do this year because they've got to do the balancing act between unemployment and inflation.
We got to clean a mess up.
If prices get too low, we're optimistic energy's down. But if it's too far down, then the suppliers stop supplying. They can't make money anymore. And then there's the housing issue as well. So all those things we're watching closely. This product, that's fixed index annuity, that 5-year account allows you to go up with the market, lock in your gains. Market goes down, you don't lose anything. So that's how we're buying the market, but covering the downside at the same time. And I tell that story. I've been telling that same story as long as I've been in business, which is close to 30 years now, and it works very well for our sector of clients that are almost in retirement, 50, 55 years old, 60 years old, that's the average. They don't want the downside, but they have to have the upside for growth so their bottom line goes up so they can start their income when they retire and have it last the rest of their lives. That's the name of the game. We just can't go backwards, and that product allows us to do that.
There are a lot
lot of expectations for a pullback, maybe even a 10% pullback because we've had such an incredible run. Not to say that we won't have a winning year on Wall Street, but that there may be volatility. Are you expecting volatility? Are you expecting a 10% pullback? And what will you tell your clients at that time?
Well, I mean, most of our clients are in the products with the downside protection, so I'm going to tell them not to worry about it. We're in good shape. We thought, the fact is, Nicole, we get paid to worry when there's nothing to worry about, right? And there is something to worry about this year because we think that there could be a pullback. I mean, historically, markets go up and markets go down. Sometimes there's crashes, sometimes there's pullback. So we're in a position where they don't get hurt by that. So we're telling them not to worry about that. On the upside, what we're saying is you're not going to make as much in these products when the market goes screaming up, but you never lose when you go down. And you don't have to make as much when the market goes up if you never lose anything when the market goes down to earn a reasonable rate of return. It's about having a steady, smooth growth throughout retirement. So that's kind of where we're positioned. And you know, the reality is, if the market's going up 20% every year like it seems like it has been, it's a hard story to tell, but when you get volatility, and we expect, to answer your question, volatility and a lot of it, it makes the ride a lot smoother. That's why we like it. That's why we manage money that way.
Yeah, and what have you been your thoughts on the metals overall, and where are we headed?
Well, you know, gold historically has been a tremendous hedge against inflation. We don't typically recommend gold to our clients. And only because, and the gold guys will argue with me this, they always do, but the gold, to me, is not, and this is an opinion, is not an efficient market. It is hard to sell gold. We have clients that try to get out of gold, and with the markdown, the markdown in gold, and the markup in gold, it can be sometimes double-digit percentages, and it's hard to make money if you're paying that much to get in and out. So we're not big fans of those, although, that said, gold historically has been a tremendous hedge against inflation. So I would say we're neutral there, but those are hard to buy and sell for trade. They have to be long-term holds.
Yeah. Ty J. Young, CEO of Ty J. Young Wealth Management. Always great to see you. Happy New Year. Best to you and your loved ones. Really appreciate it. Thank you. All right, coming up, folks. Record day on Wall Street. You like how that sounds for your 401k or IRA? Maybe you do. Maybe not if you didn't think it was going higher. Let's take a look at the key levels to watch, the charts to watch. Kevin Green is back. He'll take a look. Opening bell. We will be right back.
Sometimes, you know, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Boom, boom.
We go beyond the headlines, tracking the trends, sector moves, and fundamentals shaping the markets in real time. This is Schwab Network. Subscribe at schwabnetwork.com. Live from Chicago, this is Trading 360. I'm Marley Caden. We track macro forces, market trends, and company news that shape investor decisions, all with expert analysis and actionable context. From inflation data to sector rotations, earnings to policy, it's a comprehensive view of the market every trading day. Trading 360, in-depth market coverage straight from Chicago. Weekdays at 11 a.m. Eastern on Schwab Network.
All right, get ready, get set, go. The opening bell is rung. We have hit new records again. We're watching for 50,000 on the Dow, 7,000 on the S&P. Pretty exciting. And joining me right now, lead markets technician, Rick Ducat is with us. And we're so thankful you're here, Rick. Take a look here at, you're looking at the S&P equal weight. What is it telling us?
Well, that's the interesting thing here. So first of all, just to kind of give a big picture look, S&P up almost 18% on the year. The NASDAQ.
There goes Google. Google really looked good.
21%. Meanwhile, the Russell up almost 15% here. So the small caps are the laggard. And the reason we want to talk about the RSP equal weight ETF is that we are making new highs today here. So for a long time, there's been a concern that the S&P 500, which is weighted by market cap, so very large names can have outsized influence. A small move or a large move in NVIDIA can have big ramifications for the broader market. But this equal weight index weights all the stocks in the index in the same way, and now we're seeing that it's making new highs. So it's lending some strength to the idea that perhaps this rally has more of a broad base than just these mega cap names. Our blue line here is the actual S&P 500. So you can see they move pretty similarly in most cases here, but there are degrees of outperformance and underperformance. If we were to look more closely, specifically at RSP, our red line here going across these highs, that was a resistance area near about 192. Then it became a subsequent supportive point after our breakout. So for the most part, we've held on to our supportive area. Now we are having more of a bounce, a bit of a pullback today here, but still made new intraday highs of 197.48. To the downside as well, 182 was an important area, around where we hit some highs back here, breakout point, subsequent lows here, and once again here. So for now, you could say we are in an upward channel type shape here, still trending upward between these two boundary lines that are parallel. So when we do look at our moving averages here, our faster moving averages are diverging farther apart from the slower ones. The trend is still seeming to be continuing, not any signs of slowdown really. We also were seeing that RSI yesterday was making new relative highs as well. We are giving back some of those gains as we said today, but RSI making new highs is an important point when price is making new highs as well, because it suggests the momentum is still strong and there's still perhaps some steam left in the engine there for the move. So we can also see that the point of control, 186.50, that's where we had our heaviest trading area of all. It really starts to thin out above 190 or so. Another pocket here near about 192. So that's our portrait of the heavy trading activity areas. But look here as well. Massive volume spikes here during our decline point here.
I'm just watching right now, yeah.
A buying opportunity.
Yeah, I'm just watching right now. I got a trade out of the way. We got the 21, here we're coming. Just hit the first support, or the second. And the third one's going to be right here. So I don't know if I'm going to wait. 69.48 something. Judge. Judge. And Tesla looks yummy here. Well, the SPY hit the VWAP 3 minutes ago. It's kind of about the same kind of, it seems like it. I keep same scenario every day. Break out, pull back, SPY, consolidate, and then pull back more and die. Or have a run like we did yesterday. George. Today's upcoming economic data, JOLTS and ISM services. See, I don't think they mean the damn thing. Because they're not accurate. I bet you America's real unemployment rate is around 17%. The real. People that can work that won't. I'm debating on putting a tin roof over a shingle roof or even a metal roof over my little bitty 10 by 12 cabin. Okay, well, flag it out. Looking like a head and shoulders on 1 minute. The SPX. What ticker, Bubba? Come on, man. Give me a ticker. Because we could say the right shoulder. Oh! Here it comes down for the double bottom. SPX. Prepare ye. Prepare ye in the name of the Lord. Randy's not happy with Apple. Oak. Well, we're waiting for a pullback. 69.49. And we're going to take this down the line. Well, we got a double bottom. You can see it. It's pretty there, sitting there as clear as could be. But we won 69-49. One more little pullback on this bull flag to the 63 EMA. We won 69-49. Yeah. Yeah, I can play some blues, man. Shit. There it is. I knew it. It was going to come to me. SPX, the 7th. Randy, prepare ye. 69.45. Right there. We're looking at the 69.30s, 60s, 69.60s. And I got one contract at $3.60. The crowd's going wild here at the sports arena today. Washboardjim. I have to say, she has the biggest breast I've ever seen on a woman. Talking about stocks. Strike 69.60 at 3.60 off the 200 SMA. Ooh, now it's at 320. That's not good. Okay. Nope. We can't have this. Reverse. Double bottom. I didn't see the double bottom. $200 EMA. Well, I called a pullback on the SPX. I told my old lady being a rock star next. So we're gonna bounce off the 200 EMA. Yeah. Got a double bottom off the 200 EMA on the 1 minute time frame. On the 1 minute time frame. Come on, bitch. How in the heck did it dip $1? No. Ugh. Bounce. Did I put in the right price or what? Yeah, I did. might add 2 more contracts. Well, we need 260, 360 and 260. Nope. Doo-dah, doo-dah. He says, on my long old doo-dah day, gonna break out the stock, gonna break out the stock. Do 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 do. Come on, bitch. Now we got to break the 200. We're at 380 right now, 390. Take some off the table if you're able. Might be the thing to do. We jumped off the 200 EMA. Back to the 63. I sold them for 130 a contract. Can we win this windfall? 63 EMA. I got in at 360, just one contract, just one contract. And then it dipped down to the 200 EMA. Went to 390. Went to 390. Now we're retesting the 200 here. It's the Singing Day Trader. /ES is now at the 200. I'm still in. I still have a couple. $69.60s. Come on, baby. See how it stopped right there at the 200 EMA? And stopped here at the 200 EMA and at the 63. That's on Tesla. AMD. That AMD looked a little oversold this morning. It's up $3 now. I was talking about AMD yesterday. Someone wanted to jump in it, and I said, wait. For the pullback. I like it here. 207, my dear. Let's go out back and have us a beer. Meta pulled back. Yip, 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 yip.
I'm Nicole Pedalides at the New York Stock Exchange. Live interviews, market movers, and real-time coverage right from the floor. Subscribe now at schwabnetwork.com.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh. Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties.
Carl.
Schwab, a modern approach to wealth management.
No politics, no spin, just the market from open to close and beyond. Streaming 24/7, any screen, anywhere at schwabnetwork.com.
The Back on Morning Trade Live Lows is higher this morning after Barclays upgraded shares there to overweight and raised its price target to $285 from $259. Shares of the home improvement retailer traded relatively range-bound in 2025, closing the year slightly below the unchanged line. We are up 2.3% in trade right now, 252 and change on the price there for Lowe's. Let's take a look at the winners and the losers on the session. We've got Intel leading the pack here, up almost to 8.5% or so. Valero, of course, in the business of energy, is gaining today. We've been watching those in the business of oil up 3.8% right now on that name. Eli Lilly trading higher as well to the tune of 1.5% on this acquisition talk. We'll be waiting to see how that all shakes out as well. And Bristol Myers up 3.3 right now on the trading session. So there's your leaders of the pack on the S&P 500 today. The laggards, we're seeing Western Digital among those, down 9.5% right now, and Seagate down 8.5% or so. So this is, of course, coming off the back of a really nice run for some of those memory names. In fact, if you look across the memory space today, we are seeing most of those down, including Micron, and also SanDisk. That's despite the fact that we saw a nice rally for the counterparts in South Korea. We've got some price target boosts out for some of these names as well on the expectation of momentum in this memory cycle. First Solar also down around 8.5% today. All right, joining us now is Tom Bruce, macro investment strategist, Tanglewood Total Wealth Management. Very good morning to you, Tom. Thanks so much for joining us. Hey, look, we just got some information earlier today. We've got ADP, we've got Jolts, we've got ISM services, all looking a little bit mixed. I mean, it does certainly continue to point to low hire, low fire, as my colleague Kevin Hinks was pointing out, but a fairly strong read, you could say, pretty encouraging on ISM services, particularly when you look at the jobs gauge. What do you make of all of it?
Thank you for having me. So, a lot of mixed data coming out, and I think it kind of points to a theme we've been hitting on, which is a continuation of 2025. We have this sort of tepid data environment where it's okay, it's not, it's not great. ISM, for example, soft data showing we have growth accelerating right now, so that's good. And on the other side of that, you have Jolts, which is a pretty reliable leading indicator.
Jolts.
Of employment, and coming in a little soft. So, again, we're going to have, it looks like we're going to have this environment that's good for some, but not all. And
that's the way it always is.
Overall, we think that 2026 could have growth accelerate as you move on throughout the year.
SPY new low.
Looking at some of the different forces we have at work, we have One Big Beautiful Bill and the myriad of different benefits you get from that, along with AI integrating better into company operations. So, at this moment, yes, we're carrying over a somewhat lethargic economy, an economy that's good but could be better, right? And but we are optimistic about the remainder of 2026 and growth potentially accelerating.
Yeah, that certainly seems to be the consensus out there, certainly as far as productivity is concerned. But I just want to sort of stick with the whole jobs and AI theme. I mean, as a macro investment strategist, how are you thinking about the efficiency gains versus the displacement of jobs in this market?
Well, from an investor standpoint, the efficiency gains and how that translates into company margins, that's really the core of the story. And it's actually not been quite as strong as we've expected so far. We've seen productivity pick up quite a bit, but I think as a whole, we might have expected AI to be integrated a little bit more into the workforce than it currently is. So that's something we may see pick up later this year or into next year, and certainly roll out over the remainder of the decade.
This has been the sign. I mean, this has been like breakout, pullback for the last couple of months. Last month. Been a little bit more difficult for me to trade because it's just not simple and clean like they usually are. Some more drama.
There's real potential that pushes up long-term rates. Rates and a weaker housing market. Mortgage rates have come down a bit over recent months, but we start seeing mortgage rates come back up towards 7% or above. We need to see the housing market deteriorate in a more meaningful way than we've seen so far. So that's one risk we're cognizant of. Another is the market simply going down. There's a number of reasons why the market could go down.
Simply going down.
Any number of things that are unforecastable. But one important distinction now is that a lot of the spending that Americans have is based on the wealth effect. So as you see in the 401ks, IRAs, brokerage accounts rising throughout the years, people felt more comfortable spending. So if you were to see a bear market come in, that may have a bigger impact on the consumer than a lot of people expect.
Yeah, plenty to keep an eye on. Hey, Tom, we're going to leave it there. Thank you so much for joining us. I really appreciate it today. Tom Bruce, their macro investment strategist, Tanglewood Total Wealth Management. We'll catch you next time. Coming up, we will get a closer look at the big picture with the team from Charles Schwab Morning Trade Line. We'll be right back.
I'm Diane King Hall on the floor of the New York Stock Exchange. When markets react, we are live with analysis that matters. Watch now, only on SchwabNetwork.com.
How's it going?
First day, so.
Sometimes,
Next. Try again.
you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Whether you're a bull or a bear, you want to catch the latest market action on Morning Movers with me, Diane King Hall, live from the floor of the New York Stock Exchange, only on Schwab Network.
Trading at Schwab is powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email,
Oh, this is January.
and platform chat.
Put a new file.
Brilliantly with Schwab.
The final 90 minutes of the trading day, that's when markets make headlines and traders make decisions. From earnings shocks to sector rotations, the catalysts that move markets right into the close.
Come on, baby.
I bring you real-time sentiment from traders driving the action. And in Chicago, we break down the data, technicals, and trades you need to see before the bell rings. Live coverage of the close every single day. This is Market on Close, live weekdays 3 p.m. Eastern, only on Schwab Network.
Believe me, when it comes to investing, you'll love Carl's Way. Take a left here, please.
But there's a...
Carl's Way is the best way.
It is the best way.
At Schwab, how I choose to invest is up to me.
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me too.
Let's move on, shall we?
No can do.
I'll get out here.
Where are you going?
Schwab. Schwab, a modern approach to wealth management.
Warner Brothers Discovery has officially recommended that shareholders reject Paramount's Skydance's offer. In a letter made public this morning, the board saying Paramount's offer wasn't comparable to the $72 billion bid by Netflix. So let's just take a look at those involved in the space here when it comes to some of these media stocks. We're seeing Warner Brothers Discovery up just fractionally here, or 0.2% off the back of this favouring for Netflix, and then that is down 0.4% on that stock, and Paramount Skydance is doing a similar thing. Of course, it launching this hostile takeover bid and not taking this fight lying down, suffice to say, but we are seeing a bit of a mixed picture across this space as we are tracking this story. But just some fractional sort of gains and losses here as we try to iron out the details and get a bit more confirmation. Welcome back to Morning Trade Live. It's time now for the big picture. So let's welcome in the team from Charles Schwab. We've got Kevin Gordon, Head of Macro Research and Strategy, Schwab's Head of Natural Research, and Cooper Howard, Director of Fixed Income Research and Strategy as well. Kevin, I do want to just start with you, of course, given the news update we've got around Venezuela and what's going on in the oil markets right now. Obviously, we're seeing prices coming off, and a little bit more confirmation as far as the reporting is concerned this morning that the US actually will be given oil, that it will sell, the proceeds will be held in US banks, and then the banks will give that back to Venezuela once it's deemed safe to do so. How much of this are you looking at, as far as the impact on the markets, what this could mean sort of longer term for oil prices? How are you and the team sort of thinking about this story this morning?
Yeah, so it's still incredibly fluid. I think to the extent that we, get more details on this and what the U.S., how the U.S. stands to benefit versus how Venezuela stands to benefit in terms of the proceeds. I think we have to wait for a lot more information. So I wouldn't try to front run it, but I think just in terms of the amount of oil that it is, it's not necessarily that economically significant to the United States. So I don't really see it as any near-term needle mover in any direction. I think that path of least resistance, assuming we have some sort of access, improved access to more oil reserves, and that does boost supply to some extent around the world. Path of least resistance for oil prices is probably lower, and that's not really a new phenomenon. That's been really the trend over the past year. So it's not entirely different than what we've been experiencing. So all else equal, it's probably a relatively beneficial, positive economic force because you have more
Tesla back at the
solutions,
200
on the energy side. But it's not necessarily the best for the energy sector in terms of, in stock market terms. So there is a little bit of a two-sided nature to this, especially when it comes to looking at this from the investor's point of view versus looking at this from the consumer's point of view.
Okay, so Cooper, we're obviously
We're at the orb on the SPX.
We've got a lot of information as far as labor data this morning, as well as ISM services.
New high on the video.
Actually reading at 54.4, so comfortably above that boom or bust line, but it's sort of a bit mixed when it comes to hiring and job openings, continuing to point to low hiring, low firing. What did you make of it and the moves that we saw?
I don't see a problem with it.
In the markets this morning.
Yeah, so if we look at the labor market, the data that came out this morning, obviously Kevin can comment on some of it because he covers a lot of the macro side of things. But to me, it really confirms a lot of the trend that we have seen, that no hire, no fire trend that's going on. And also really just a labor market that has been softening, but ultimately isn't falling off of a cliff altogether. Now, obviously, we have the big report that's coming up on Friday, so we'll see if that confirms the trend. Expectations are that it's going to be a little bit of a softer print, so 60,000 gains. Now, I do expect that if that were to be the case, looking at how that could influence the treasury market, looking at longer-term treasuries, they've continued to be range-bound, Sam, for quite some time over the past couple of months or so, and I really don't see them breaking out one way or another on that. So really, if we were to see something move significantly one way or another, maybe that breaks the trend or breaks the range-bound narrative that we've seen a little bit lately. But going forward, it doesn't look like anything major is going to happen to bust us out of that one way or another.
Okay, and yeah, obviously, Kevin, just to get your thoughts on what we got this morning. I mean, you have said that you view the labour market as both a headwind and a tailwind moving into 2026. How are you thinking about that?
Yeah, I mean, it's been a headwind in the sense that, unemployment has been picking up over the past couple of years. And if you look at the move off of the trough a couple of years ago for the unemployment rate, it is consistent, the magnitude of the increase is consistent with what you've seen in prior recessions. But we also know that this is an incredibly unique cycle, and it's been the slowest increase off of the trough for the unemployment rate that we've ever seen. So it's been more marked by and characterized by this incredible churn at the industry level, where there are pockets of labor that are certainly in their own recession, the youth being one example, areas like manufacturing and certainly the federal workforce being other examples. But then we've had relative strength in some of the services parts of the economy as well, especially health and education. So there have been these really interesting offsets where it hasn't led to this recessionary-like spike in unemployment. Per the JOLTS data that you were just talking about with Cooper, even though that's for November, so it's a little bit lagged, there was a move down again in the hiring rate to a cycle low, but there was also no major pickup in the layoffs rate. So that dynamic has been, again, something that's been with us for a couple of years now, but has been really, I think, the sort of poster child or the poster child, children's set of data for this unique cycle where you haven't seen that material, pickup in the layoff rate. So assuming that continues and you go through, more of this soft patch where hiring has slowed down a lot, but we look to maybe more of a rebounding in the private the private workforce, and we'll be, watching for that on Friday. That could be a dynamic that maybe defines more of 2026, where there is some stabilization in the private workforce, but you don't necessarily get that aid from the federal side because there has been so much cutting there. There really is no sign yet that there's going to be a pickup in hiring at the federal level.
Okay, yes, I mean, it certainly is an uneven jobs market right now. We'll be watching the unemployment gauge to see if there's any movement there. I mean, certainly as far as the next cab off the rank with the jobs data on Friday. But for now, Cooper, I'm just wondering, how you're thinking about things with respect to, the job situation, the macro data, the geopolitical tensions. The market seems to be largely looking past as far as the risk premium being priced in here. But what's the sort of next catalyst for some sort of meaningful move here? Do you anticipate that we stay relatively range-bound for now as we just wait for these big question marks to be answered?
Good question.
Yeah, so I do expect that we'll continue to stay range bound for now on longer term treasuries. And really what you can do is if you boil down the movements in treasuries to
boil the
changes
word
in
right.
fund rate, changes in inflation expectations, and then the term premium, which is kind of like a catch-all. And it's really that uncertainty, instability, which that's a term that Kevin and Lizanne have used in their 2026 outlook. So I think that it's very appropriate.
We just now hit the 63.
As well. And so long as that instability continues to remain.
I'll be right back, folks. We just now hit the 63.
Concerns over where Fed policy is going. A lot of different concerns and a lot of dynamics that are out there in the market. That should keep instability relatively high, and therefore it should keep the term premium relatively elevated. So I would expect that probably puts a little bit of a lower bound on where we could go for 10-year treasuries. So yes, and I do expect that we'll probably continue to be this range-bound narrative going forward. Now, longer term, looking out for the rest of the year, I wouldn't be too surprised if we start to see a moderate uptick in longer term treasuries. And our call in our 2026 outlook was to see a little bit of a steepening of the yield curve. We still do expect that the Fed is going to cut interest rates, looks like maybe 1 or 2 times this year, probably starting maybe middle of the year or so. But obviously we've got a lot of a runway until we hit that, a lot of data that's going to come in, and a lot of different catalysts, whether they're a black swan or not, that could potentially move that direction one way or the other.
Okay, we'll be watching. Gentlemen, always appreciate your insights. Thanks so much for joining me today. Kevin Gordon, Head of Macro Research and Strategy, and Cooper Howard, Director of Fixed Income Research and Strategy, Schwab Center for Financial Research. Coming up, it's time for the morning trade. We'll take a closer look at Deckers Outdoor. The stock is lower today after a pair of downgrades. Morning Trade Live will be right back.
Schwab Network delivers real-time market insights, live from the NYSE, NASDAQ, the SIBO, and beyond. From earnings to economic data, we cover what matters as it happens. Streaming 24/7, anytime, anywhere, free on SchwabNetwork.com.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
We are back with Morning Trade Live. Let's focus on Deckers Outdoor. The Hoka and parent companies trading lower this morning after a pair of analyst downgrades. More on that in just a moment. But this stock has languished over the last 12 months, down more than 50% from its all-time high on January the 30th of last year. So we're down 4.5% on this name, trading at 102 and change right now. So that is feeling the deepest losses this morning off the back of this pair of downgrades, which we'll get to in a second. Nike also lower perhaps in sympathy here. Lululemon is also trailing 2.7%, and On Holding is down 1%. Suffice to say though, we are looking at a broadly lower market across the major averages now, despite the fact that we did see records, all-time highs at the open, but we are looking at a little bit more of a risk-off tone in this space. All right, that is the focus of the morning trade. So joining us now for a closer look at this is Marley Caden. So As I mentioned, we get a pair of downgrades for Deckers Outdoor from Baird and Piper Sandler. What is exactly behind these calls? Good morning to you, Marley.
Good morning, Sam. Yes, one more bearish than the other, but Hoka seems to be a culprit that's mentioned in both. First, let's start with Baird's downgrade. Baird downgraded to neutral from outperform. This one is the slightly more bullish of the two. They have an unchanged price target of $125, which is, as you noted, they're trading about 102 right now, so above where they currently are. They did cite some concerns in their downgrade about a transition in Deckers' growth story, particularly tied to the moderating growth surrounding the Hoka brand, which has seen strong double-digit growth in the past few years. They expect that growth to moderate, so that's one of their major concerns. They have maintained a 12.62 revenue growth rate over the last 12 months, but they think that that may slow. They flagged conservative financial guidance from management, saying that it could create an overhang on Deckers' near-term multiple, despite their positive broader outlook on the business. Now, they do remain comfortable with Deckers' ability to achieve or even exceed its fiscal 2026 EPS estimate of $6.39, which aligns closely with the consensus of $6.41. So they're just slightly less bullish here from Baird. They also note that they think Deckers' shares seemed slightly undervalued in terms of a long-term perspective, but they say that the structural operating margins and cash flow generation numbers look good. They're just slightly less bullish right now. Slightly different story from Piper Sandler, though. Their downgrade is to underweight from neutral. They've dropped their price target down to $85. That's down from $100. So that's below where we're trading right now. It's almost a street low. The street low is 81. That's the lowest. Shares are up 34% since November. They do note that they've had a positive 8-week stretch here. But they believe that that's because Deckers has leaned into discounting both its Hoka and UGG brands since the summer, and analysts have concerns about that. They think that the company's promotions are being used as what they call, quote, unhealthy consumer acquisition tools. So they think that some of these customers that they're acquiring are not customers who are going to stay brand loyal, which, as we know, in this particularly competitive space is very important. They think those discounts, if they don't hold, are going to send those shoppers somewhere else. They also cite that those sales could create potential conflict with Deckers' wholesale customers because they won't be able to provide those prices, and that could lead to greater consumer loss as well there. So some greater concerns there from Piper Sandler, but two downgrades nonetheless, Sam.
Yeah, interesting Piper Sandler note as far as some of that commentary, isn't it? I mean, good for sales, maybe not so good for margins, but it's interestingly because, you know, as far as consumers are concerned, everywhere you look here in New York City, I don't know about over in Chicago, everyone is wearing Hokas and UGGs because, you know, they've come out with those platform ones with the chunky heel as well. They're no longer sort of indoor slippers, they're like fashionable. You wear them out in the street with your jeans. It's so fascinating, but yeah, let's see how this was reflected in their numbers when we hear from this company later on. But thanks so much for breaking down those two downgrades for us this morning. Marley. Let's trade it now with Scott Bauer, CEO of Prosper Trading Academy. Very good morning to you, Scott. How are you approaching your example trade for this one?
Hi there, Sam. I just want to let you know I am wearing my Hokas right now. I love them. So the chart technically does not look very good. I mean, there's massive resistance, lower lows, lower highs. They do have earnings later in the month, so I really don't want to put on a position playing into earnings. Option implied volatility is very, very expensive right now, even ahead of that earnings expiration. So what I'm doing is I'm selling in an iron condor. I'm selling both the put spread and a call spread, both which expire next week. I'm selling the 195 put spread, and I'm selling the 105, 110 call spread. I can do that. I'm trying to get $3 for it. Right now it's probably trading more like $2.60 or so. I'd like to do that for about a $3 credit, where if Deckers actually rallies back a little bit from it's pretty much near its lows of the day right now, I might get that. If I can do that for $3, then at the end of next week, my break evens are 97 on the downside, 108 on the upside. I love that range just to play over the next week and a half, and then we'll kind of take it from there.
I'm very pleased to say here that you are wearing, of course, your Hokas because during the pandemic, I know that whole saying of, you know, business on the top, party on the bottom, shifted to pajamas on the bottom. So that's reassuring there, Scott. Just wondering, just very quickly, your overall take on the market today. We did touch all-time highs, but we have pulled back now.
Yeah, there's a little bit of caution here. Some of that euphoria, you know, we're seeing upside call buying in a lot of the AI plays. Which maybe that's getting a little out of hand. I think yesterday's move in the semis obviously was was a little bit probably more than expected, but overall things are looking pretty good. But you know what? We have the jobs number Friday, earnings starting next week in earnest with the banks, so just get ready for it.
Yeah, I mean, the semi-cap index, the best start ever to any year. And I believe the best 3-day streak since after the pandemic, the GFC and the dot-com bust and boom, or something that we saw during that time. So, I mean, fascinating, perhaps due for a pullback. Thanks so much for your insights there, Scott. Really appreciate it this morning. Scott Bauer, CEO of CrossFit Training Academy. Coming up, we'll take a closer look at the sectors on the move this morning and moves to watch in overseas markets. Morning Trade Line, we'll be right back.
Morning movers, be the first to find out what's shaping early market action. Tech Check, Options Corner, Futures Focus, Technical Analysis. Morning movers covers it all. Grab your coffee and tune in every trading day at 8 a.m. Eastern, only on Schwab Network.
Stay connected to what moves the markets. Download the Schwab Network app and stream anytime wherever you are.
Live from Chicago, this is Trading 360. I'm Marley Caden. We track macro forces, market trends, and company news that shape investor decisions, all with expert analysis and actionable context. From inflation data to sector rotations, earnings to policy, it's a comprehensive view of the market every trading day. Trading 360, in-depth market coverage straight from Chicago. Weekdays at 11 a.m. Eastern on Schwab Network.
Welcome back to Morning Trade Live. I'm Sam Butters, coming to you live from the New York Stock Exchange. It's time now to take a look at the sectors of the moving markets this morning. So I'm joined by Alex Coffey. Very good morning to you. So we are seeing a little bit of money coming off the table, but there's still some bright spots underneath the surface. Just talk us through what you're seeing as far as some of that sector rotation today, Alex.
Yeah, it's a very different looking day than yesterday's trade, Sam. If you look at it in real time, it's just over a quarter of the S&P 500 components are actually higher on the session. But the breakdown of some of the leading sectors looks a lot different. You have sectors like information technology, consumer discretionary, communication services, and healthcare really driving the upside. And you can make the argument that those are four of the five most important sectors, with the only other name or only other sector I would include in that list being financials. Financials certainly a drag today, perhaps some of that due to the ebbs and flows of the trade coming off a really nice close of 2025. It does seem that the kind of early, intraday attitude is fading some of the winning areas of the market. I know the memory stocks have bounced back when you look at a name like Micron, but for the most part, parts of the market that were really outperforming towards the end of the year are a little bit weaker. Today, financials certainly fit that bill, down over 1%, but all things considered, despite the fact that it's a relatively narrow rally, this market is still up on the session.
Yeah, you raised a good point.
Another big nicer.
Been off to a good start to the year. I mean, you mentioned financials, you mentioned memory is actually coming off today in trade, all but Micron, as you said, which is recovering a little bit. But we are seeing pretty much red arrows across, some of those names at SanDisk, Western Digital, as we mentioned, despite some price target boosts, in fact. What's the story in the markets right now? Because we continue to see NVIDIA is higher off the back of a little bit of a tough end to the day. Yesterday, AMD continues to track lower. Obviously, Intel is higher to the tune of almost 10%. You know, as you look across some of the Mac 7 names, what's the story in the market today?
Yeah, that story is a resurgence in Magnificent Seven combined with just good enough economic data that's not really spurring any fears. But it also isn't doing anything to set the Fed back on its rate cut path if there is to be one. But I did look at the three biggest contributors of the Mag 7 today: Alphabet, Microsoft, and Nvidia. Those names combined are basically contributing about 20-25 points of upside to the S&P 500 over the last, depending on the last 10 minutes as things have shifted. But even if we say it's 20 points, I mean, the market's unchanged. So those three names are doing a lot of heavy lifting today, and that's very different than yesterday when the Magnificent Seven was a drag on the market.
There seems to be a bit of a push and pull in the market today, but the S&P 500 basically just flat right now. Hey, thanks so much for that, Alex. I'll chat to you a little bit later on. Taking a look at action in global markets now, international stocks largely looking past the record set on Wall Street yesterday with a bit more of a mixed picture. European defence stocks have been trading higher on President Trump's intention regarding Greenland. Shares in defence companies have been on a tear lately on thinking that Europe will continue to up its military spending, particularly in line with the most recent developments in Venezuela. Defence stocks helped drive gains across Europe in 2025 and are among the big winners so far this year. Out in Asia, the coffee continuing its strong start to the year. Shares in the
I don't know about this market sometimes.
Memory, Samsung and SK Hynix both adding more than 3% in trade. These
Very difficult one to trade.
to record highs on expectations of prices going higher. It came after a strong double-digit rally from US counterparts like SanDisk, Micron, and Western Digital. But Japanese and Chinese stocks reversing gains as tensions between the two countries ramps up. China now saying that it's launching an anti-dumping probe into a precursor chemical used in chip making coming from Japan. It comes after China launched a ban on exports of dual-use goods, which means for civilian and military use to Japan. Coming up, it's time for Inside Out. We'll take a closer look at Constellation Brands ahead of earnings and bring you an example trade for that name when Morning Trade Live comes back.
Hey, investors, you know the market moves. And Schwab is here to help you move with it. So, whether you're buying, selling, holding, or planning, whether you're ETFing or 401k'ing, saving, spending, or even retiring, you can count on Schwab for market insights, live support, powerful trading platforms, and 400 branches. All at your service, all so you can invest your way. Sounds nice, right?
Yep.
I'm Alex Coffey.
And I'm Jenny Horn. This is
Sounds simply wonderful.
Where we track the trends shaping tomorrow's market.
From tech to energy, crypto to consumer, we focus on what's driving investor sentiment right now.
Clear analysis and forward-looking market coverage every trading day.
This is a make or break level for this stock.
And that could certainly be a short to near-term catalyst.
Next Gen Investing, 1 p.m. Eastern.
Only on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing.
So let's say you're new to trading. Let's just say you are. And you know a little bit about it, but you don't know, you don't have a strategy yet. Well, I'm going to give you one. This is called So this is probably one of my first suggestions, is to create a watch list. And don't make it very big. Make it medium to small to average. and watch them same stocks day after day after day after day after day after day. It's like the Magnificent Seven. I think many of them were, if I remember, red. The other day, these are all great stocks. Apple, Tesla, Amazon, Nvidia, Microsoft, Google, and Goog. It looks like I'm missing one. What am I missing? Apple, Amazon, Microsoft, Tesla, Google. I'm missing one. No, I'm not. They're all up there. You idiot. Can't you count? Spies are at 330, the 6960s. I mean, SPX. We're at a double top, so notice we've had a couple big knives on this thing. It could happen easily, real fast again. I can look at that big knife in 1 minute. $11. 52 to 36. In 2 minutes. Well, 4. Now we got a new high. Do. Tempting to sell them unless I think I'm going to break out. Right now they're at 320. My average is 293. I just got one left. So I sell it. It's a double top. We could easily come up and get to a higher high. So 350. I wouldn't be ashamed if it's over here. Nvidia.
Is there anything that this company is doing that's perhaps different to the others? Because it looks like they're all struggling as far as the performance is concerned. But what stands out about this one?
Well, for instance, you mentioned cannabis-infused beverages. I mean, that is a long shot. In terms of consumer research, I don't know where they got that idea.
What's wrong with it?
More than we do about the developing trends of Gen Z, but I doubt that will be an attractor. And other than...
How dare you? Do you ever ask yourself why liquor sales are down?
Cannabis-infused beverage. So maybe on the margin with some incremental types of hard liquor type discoveries, maybe that will help them. But as I said, I think it will all be about how they report volumes today and what their guidance is going forward. And it is all about the consumer. I mean, sadly, this kind of business really does depend so much on consumer sentiment and appetite for the beverage.
And what about sporting events? I mean, you know, look at the World Cup this year. I mean, I know that having covered China for many years, this is a time when you do sort of start to see alcohol consumption trends going up because they love to sit there and watch the soccer. I'm just wondering, you know, does that have any impact, you know, as far as promotional activity, etc.?
Right. Yeah, history shows us that it could have a, you know, marginal bump, but it kind of reminds me years ago when I covered the paper industry, and analysts said in an Olympic year there will be more demand for paper, and that just never really was demonstrated to be correct. And I kind of think it's the same way with sporting events and alcohol consumption. I mean, because there are major sporting events, it doesn't necessarily indicate an improving, long-lasting trend. There may be a bump in volume then, but analysts will be looking very closely, not necessarily at that, but at the general long-term trend. If the consumer is generally returning to alcohol consumption, and we saw recently that alcohol consumption in this country is at a long-time low, so looking at that could be a leading indicator. We also see that the wanes of the health industry telling us that maybe a glass of wine a day is good, then a year later we hear that a glass of wine a day causes cancer. So that also impacts, I would say, the frailty of the situation.
Oh, yeah, absolutely. I mean, you know, you've had some sobering analyst calls for the booze business as well. A lot of on what you've been saying as well. It's pretty confusing out there, but, you know, we do know that there is this Maha movement, and that seems to be firmly in pace at the moment. But Peter, thank you so much for joining us today and getting us across your thoughts on this one, and a bit of a preview for Constellation Brands. Peter Anderson, their Chief Investment Officer and founder, Anderson Capital Management. So let's trade it now with George Tillis. So you've got an example trade for us on this game this morning for us. George, good morning.
Good morning, Sam. Yeah, I mean, if you look at the price action in Constellation, it seems to be basing the last couple of quarters. Now, it certainly could change after the results and earnings, but nonetheless, things look like they're stabilizing for the underlying stock itself. Considering, again, there's a dividend yield that could be had if you own this particular name. So what I'm going to do is I'm going to basically synthesize a long stock ownership by placing a long covered stock position, which is basically longing or buying 100 shares of stock, and I'm actually going to sell to harvest some yield the 145 February calls against it, which you can earn about $5 a share. So buying 100 shares of stock, selling the 145 call for about $5, which places your cost basis of $136.50. In other words, lower your cost basis by selling that call. So this is a bullish trade. You have to be mindful of that. The short call that you're selling against your long stock position does earn you some yields, to which point, again, it lowers your cost basis to the 136.50. But again, you have to consider the risks associated with that position going down, of course, to zero, which is effectively the max risk in this position. If it does break to the upside on earnings results and some positive momentum, you get to capitalize on this position up to 145. So to which point, again, you don't participate any further than that. So again, it's one way to take a long stock ownership of the position, selling some calls against that position, lowering your cost basis. But again, it reduces your cost basis, but not necessarily reduces your risk.
Right, and as Peter Anderson pointed out, it's not so much what they do as far as the quarter gone, but what they say as far as some of the guidance. Thanks so much, George, for getting us across that example trade for us on Constellation Brands. We'll be hearing from this company later on. We are trading lower by 1.5% on this game, 141 and change right now. So we'll be watching that report later this afternoon. Thanks so much for joining us here on Morning Trade Lines. I'm Sam Barnes. Download the Schwab Network app available in the Apple App Store and tune in 24/7 on schwabnetwork.com. Trading 360 up next with Marley.
Schwab Bank Investor Checking, the checking account built for investors, named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed
Very
for
good.
investors like you, with unlimited ATM fee rebates.
It is
for
now
cash
lunchtime.
withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money
360 on the
also, because your investor checking
6960s.
account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action,
We should go
break
higher.
it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists, streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Mom, when my grandparents moved here, did they know what our family would become?
I don't even know if they could envision it, to leave everything behind, literally come across the entire world. I think that we totally met what their wishes were. Schwab has been with us for almost 25 years. Through purchasing up houses, opening up our business, having children, they've always been there for us.
I want to invest with a company that can help me give my family a happy financial future.
Stay connected to what moves markets. Download the Schwab Network app and get live coverage wherever you are.
Boom.
Good morning. We're 90 minutes into the trading day. Welcome to Trading 360. I'm Marley Caden, coming to you live from our Chicago headquarters. Here's what we have coming up for you in today's show. As CES continues in 2026, we'll break down all the big news and the highlights from Las Vegas Tech Conference in our 360 Spotlight. And Reuters is reporting that Qualcomm is in discussions with Samsung over a contract to manufacture 2-nanometer chips. George Tillis will dissect the news and give us an example trade in our disruptors. And we got ADP jobs data this morning. We'll break down the numbers, take a closer look under the hood, and what it means for our markets in the 360 round. Before we get to all of that and more top stories, let's take a look at how the markets are faring this morning as we're into the trading day now. As we take a look, it is a bit of a mixed picture here as we populate the board. The S&P trading higher more than 1/10% at 6952.85. On the NASDAQ, also higher 4/10 now, 25,739. We are lower on the Dow, though, about 1/3% at 49,288. And the Russell 2000 trading at 2571. That's down close to 0.5% this morning. Taking a look at the 10-year, also down to 416. The dollar mostly unchanged at 98.33. For gold, we're lower on the day, 44.58, trading down more more than 0.8% right now. Crude oil down more than 1% at $56.40 a barrel as the ongoing situation with Venezuela continues. And Bitcoin continuing its slide from yesterday, down 1 1/3% so far, 91,575 for Bitcoin, getting closer back down to that 90,000 level.
Boo!
One of our top stories this morning.
No.
Talk about an ongoing saga. One of my favorite stories, bringing our first guest, Alex Coffey, our senior equities contributor here on the network. Of course, I said favorite story. You know we're talking about Warner Brothers, Discovery, Paramount, Skydance, Netflix, all the names. This big media mess that's happening, but we have a development.
We do. I don't know that it's a surprising development, but a development nonetheless.
There we go.
It does seem like there's
Jimmy needed
one
that.
player in this group of three that is just not taking no for an answer, so we'll see where this goes. But the latest is that Warner Brothers Discovery has officially rejected an amended offer for a takeover by Paramount Skydance and encouraged its shareholders to continue to stick with a deal that it has in place with Netflix. With that, the board basically centers this around doubts around a potential close, hiccups and risks around the financing, but also that they believe there could be just more value unlocked from the deal they have in place with Netflix, considering that they could still spin off the cable TV and, of course, their cash and shares version of Netflix's deals, so the Netflix stock that would be involved as well. Now, this is interesting because this comes after Larry Ellison himself personally guaranteed the $40.4 billion in equity financing, and they still basically, this is in quote from Warner Brothers, the extraordinary amount of debt financing as well as other terms in the Paramount Skydance offer heighten the risk of failure to close, and this is especially when compared to the Netflix offer. So, you know, Marley, this is more of the same in this story, but Paramount Skydance just keeps upping it, and they are not taking no for an answer.
They certainly are not taking no for an answer. And interesting you bring up the letter that they cite the debt as a concern, that this Discovery Global spinoff is an opportunity for shareholders. But they also bring up the obligations to pay if they don't do the Netflix deal. They have $2.8 billion to terminate that merger agreement, a $1.5 billion fee for failing to complete the debt exchange, which they can't execute under P-Sky. That's another concern they had there. Then they go on to say that it would in effect lower the regulatory termination fee P-Sky would pay from $5.8 billion to $1.1 billion. So I mean, a change here. But we are seeing a mixed picture in terms of the response to Warner Brothers marginally higher. We're seeing both suitors marginally lower today. You know, in terms of development, you say it's not unexpected here, but you know, how much longer are we going to continue talking about the saga?
Well, it could continue for a while because even if you get past this stage, there's still regulatory concerns. So, you know, this is fully priced kind of that a deal will happen. It's just what is the deal is the question, and how long is that going to take? So I always kind of say at this point, especially when you see the run-up as a result of this, this no longer becomes a retail trading game. At this point, you can see the amount of repricing that could happen if the deals were to fall through altogether. And there might not be a ton of juice left to squeeze for this deal to ultimately close. So while markets are liquid, most retail investors wouldn't still be in here unless they really wanted to, I guess, at some point become a Netflix shareholders. That's part of how it's structured, or Paramount, etc. But oftentimes, you know, deal arbitrage more of an institutional game.
Alex, we appreciate you breaking down the latest for us with Alex Coffey, our senior equities contributor here on the network and the co-host of Next Gen Investing. We do want to broaden out our scope, though, take a broader look at the markets and what we might expect for 2026. Welcome in our next guest, joining us, Thomas Iorano, managing partner at Sage Advisory. Thomas, thank you for being with us today. You know, 2025 threw a lot at investors. There was a lot to take in with AI concerns and the government shutdown and tariffs and weak job data. But the markets finished the year off really strong. You know, what does that resilience tell you about the underlying setup that we have coming into 26?
You know, I think the setup for 26 is looking quite good. 25 was all about, you know, all of these policy initiatives and changes. And I think it was just, you know, something that kept the market on its toes and having to adjust and say, what are the outlooks for that? But as we get to 26, you know, that's been set. Now the question is, how's the economy going to respond to tariff and immigration policies and tax policy changes and Fed policy changes? And at the end of the day, we think momentum can carry on into 26. We saw an exceptionally strong third quarter GDP print. And I think between policy easing of the Fed, and general overall overall strength, and then the benefits from the tax bill that we got mid-year last year. I think overall there's some tailwinds that are in place that can carry the economy forward into 26. So we're actually quite optimistic about the first half of 26, and we'll see how we progress through the year.
All right, so you're optimistic, you mentioned, about the first half of 26, so we're tilting bull, but we clearly have risks that are rising. We have geopolitical concerns back on the table. We obviously don't have any end to the tariffs. We're going to get a new Fed chair. How should investors think about positioning in terms of balance right now?
Yeah, so, like I said, as we get through the year, we're optimistic on growth. The second half of the year can still be a wild card. A number of different things can come at us. We did midterm elections to think about as we get into the second half of the year. But again, positioning in the market as we get into the first half, again, I think as an economy continues to move along here, the numbers that we saw out of the economic data today, JOLTS was kind of a mixed bag. Labor market ADP numbers kind of a mixed bag, but service sector ISM looked pretty strong. Overall, it almost seems like we're in this more continued Goldilocks scenario where the economy can continue to move along here. And I think that's the backdrop. It should set the stage for a nice tailwind, at least in equity markets. A little bit different for fixed income space as you think about how the Fed will respond in the face of an economy that seems to be moving along nicely in the first half.
That's right.
All right, so let's talk about fixed income quickly before we take a broader look at the equity market here. What's your outlook for the fixed income space and also for credit for 2026?
Right, so let's tackle yields for a second first, right? As we get into this first part of the year, I think the treasury market is going to struggle a little bit with two masters, right? We have this fact that we think the economy is going to do fine, right? So you have this kind of healthy backdrop. Could call into question whether the Fed needs to continue cutting rates. However, as we get to mid-year in June, we are going to get a new Fed chair. And I think the administration's been pretty clear that they're looking to get an individual at the Fed chair level who is dedicated to getting policy rates lower. 3%
Intel had a good day
in the second half of the year. So, there is still some policy initiatives to drag yields lower as we get through the second half of the year and a new Fed chair comes on board. So, the bond market, I think, is going to struggle a little bit with, forces that are pulling in opposite directions. Healthy economy with a new Fed chair with policy initiatives driving yields lower. On the credit front, I think you have to be careful, meaning we're not worried about rising default rates, but the risk premium that you're getting paid in corporate credit is narrow. It's limited, right? There's not a lot of upside there. So in the event that anything goes wrong, there's not much protection there. So I think as you position yourself in the credit space, you have to think about strong companies, strong sectors, low volatility sectors, and just areas where you can earn your yield.
All right, so when we're looking at credit here, are you seeing any cracks as we come into 26, or even any cockroaches, to use that term that keeps popping up here? And if you are, where are you still seeing opportunity?
Right, so, the idea of cockroaches in the credit space that have come up, I mean, listen, there's been, I'll say, limited instances in the private credit space where issuers have been challenged, maybe with excessive debt levels and difficulties in rolling debt. But as we look at the investment grade market and certainly in public debt market and high quality credit, we're not really seeing any issues in terms of defaults. So we're still pretty comfortable there. Like I said, it's just a limited valuation, or really rich valuation, so limited downside protection in that credit space. But overall, I think as we progress through the year, if the economy continues to do well in the first half as we expect, the idea of those cockroaches becoming more frequent and more problematic, I think is limited at least for the first 6 months.
All right, let's move over to equities, particularly international equities. We saw the global markets outperform the U.S. for the first time in, I think, more than a decade. What's your stance on international for 2026 after the performance that we saw in 25?
Yeah,
so, we're optimistic on international. We want to be involved in that space. I think you have to think about dollar weakness as a U.S.-based investor when you're thinking about international exposures. On the international front, there's a couple things also to consider is that foreign central banks have been aggressively cutting rates, right? So that's been a huge tailwind for capital markets globally. We have to recognize that we're at the trough or the bottom of that cycle. We're not sure that there's scope for foreign central banks to continue easing and putting a tailwind into foreign equities. So I think you kind of have to think about that. and be a little bit cautious if you're not going to get that tailwind. Are we going to see growth take back up globally outside U.S.? And if not, it does call into question whether or not foreign equities can continue the outperformance against U.S. markets.
And Thomas, let's focus on U.S. equities too as well here. We've continued to hear sightings about valuation concerns, concentration risk in America here in terms of our equities. How are you addressing that without stepping outside of the market?
Bitch.
So I think you have to focus on earnings, right? Last year was, again, a year about policy change, and you had policy tailwinds. As we get into this year, it's going to be about how fundamentals perform, right? Are we going to get the earnings growth that we need? So I think positioning in the equity space, you want to target areas where there's some upside, where valuations still lend a little bit of room for expansion, right? We saw a huge multiple expansion that drove returns last year, particularly in the mega cap stocks. Some of the small caps and mid cap sectors lagged that multiple expansion. So there's some opportunity to participate in the way if the market broadens out and those particular sectors, small cap, mid cap sectors, maybe you get some multiple expansion and some earnings growth to go along there. So there's still some upside, we believe, in domestic equities.
Thomas, we appreciate you being with us to take a look at market outlook for 26. That's Thomas Urano, managing partner at Sage Advisory. And we've got plenty more for you today on Trading 360. Next, of course, we've got the big three coming your way. 3 stocks, 3 charts, and 3 trades. Rick Ducat will take us through the technicals, and Don Kaufman will join us to take us through the trades for the retail ETF XRT, Merck, and Caterpillar. That's next on Trading 360 on Schwab Network.
Iconic trading floor in the world. This is Opening Bell with Nicole Petalides, live on the floor of the New York Stock Exchange. The countdown, the setups, the stories that make markets move. Minute-by-minute breakdown of the biggest headlines, earnings, and global movers. Just the trades that matter. As the bell hits and the markets react in real time, Opening Bell, live at the NYSE, right when it counts.
Believe me, when it comes to investing.
Okay, well, I'll be back.
But there's a
shortly.
Is the best way.
Look.
At Schwab, how I choose to invest is up to me.
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me too.
Let's move on, shall we? No can do.
I'll get out here.
Where are you going?
Schwab. Schwab, a modern approach to wealth management.
Welcome back to Trading 360. I'm Marley Caden. It's time for the big three. We've got 3 stocks, 3 charts, and 3 trades for you. Rick Ducat will take us through the charts as always, and here to take us through the trades today is Don Kaufman, the co-founder of Theo Trade. Great to have you both with us. Don, would love a big picture thought on the market action we're seeing in response to some of the data that we got this morning.
Yeah, data aside right now, just some really wild rotations, and it's one of the things we're going to talk about in some of the trades here in just a moment. The rotations that we're actually seeing in and out of different sectors, for instance, to retail, to healthcare, ETFs, they're manic. They're absolutely manic rotations. And it kind of feels like right now that the AI trade is not the in trade. We're trying to buy anything and everything other than necessarily the AI trade. Yeah, look no further than the financials. They're exploding to the upside. Just a fundamental basis behind a lot of these moves. As I said, very, very manic trade. And the concentration risk kind of continues to grow. I mean, NVIDIA, closing in now, $4.7 trillion market caps.
It's wild to think that we're talking about these numbers, but NVIDIA not in your big three today, but I do have a feeling we're going to talk more about some of those manic movements we've seen in the mania with this first one. It's retail ETF XRT. You know, they had a really impressive closeout to the year, a wild run to the upside. You know, for the retail space, is that part of the reason it's in the big three?
No, actually, it has nothing to do with it whatsoever. So I'm not going fundamental here. I'm looking at the XRT, and this is rallying, in my opinion, for all the wrong reasons. This is one of those manic kind of moves to the upside. And I think that the XRT has more to do with breaking out to a new all-time high than it has anything to do with a fundamental basis behind this. Yeah, Target's come back and, Walmart's at or near highs. But again, the fundamentals are not necessarily the underpinning over here. Trade is. I mean, the market right now, as a whole, is going 180 miles an hour, but can't see 5 feet in front of itself. And underlyings like XRT, which of course is an ETF, it's just about markets hitting, if you will, all-time highs. And when it kind of butts up against the all-time high, we explode into that all-time high, and that's exactly what this first trade seeks to do. I'm only going out to the January 23rd expiration inside of the option chain, and I'm doing that because I'm looking for a short-term, if you will, burst to the upside. I'm going to buy the 89 calls. Again, that Jan 23rd, I'm going to buy the 89 calls. I'm going to sell the 91 calls. Just a nice, compact $2 wide spread, done for about a 90-cent debit. Looking for a quick, again, burst to the upside, predicated on pretty much, as I said, it's all the wrong stuff in this, but it's still a bullish trade because we're going to, it appears, all-time highs.
Yeah, we've certainly been saying that a lot lately on Market on Close as we wrap up the day to another all-time high, a close above 49,000. But it's we're pretty close to that range that he was just highlighting, Rick. We're at 88.50 right now, so only about 50 cents off of the beginning of that spread. What's the technical setup look like here?
Yeah, quite an interesting setup too, because on one hand we did have this very nice rally off of those tariff news shock lows. We also held this $78 level here, this green line around these lows here. That was our breakdown point. That was a supportive area several more times. So we can see that now that is the lower end of this rather wide range in which price has been trading. The upper edge is around this level here, near about the 89 mark or so. So that was a repeated ceiling here. We had kind of this zigzag between our two boundaries here. But for now, as Don said, making new intraday highs, poised potentially for an upside breakout here. So if we were to look at our other studies, our moving averages that we follow show that for now the trend is still in place here. We have our faster moving averages diverging apart from our slower moving averages. Price remains above all of them. Our white trend line is still in play. We did just also break out of our blue downward sloping channel there after our last test of those highs. So we had our bull flag, bull pennant type of behavior here, where after a sharp rally, sideways to downward consolidation that seemed to kind of solidify around our moving average confluence here near roughly 86. Now, what the bulls would want is for the price to retake those initial highs and push further into uncharted territory here. RSI cooperating with that bullish outlook for now. Upside breakout, matching prices breakout here above the 50 midline, making new relative highs, but still short of that overbought area. That would be one more bullish signal that could be generated. So now if we look at volume profile, our heavy trading areas, the areas in question, right around here near 87, right around here near 85, and 80 is our point of control, the heaviest trading area of all. So again, a bit more bullish that we've pushed out of these volume concentration areas. Heavy trading at the highs suggests conviction even at these elevated levels here. Certainly an interesting one to watch in the coming days as we go forward.
Yeah, certainly with this short-term look for it to continue to the upside here with that first trade in our big three. But the next one here is Merck, another chart that as I'm looking at had another major run to the upside here. But I know better than to expect you to be 2 for 2 bullish here, Don. So are we bullish on Merck?
Oh, absolutely not. No, this one is going to be a bearish take. I'm going to look for Merck to actually pull back, and I'm going to give you some of the reasoning over here. First of all, it's an unfathomably large move to the upside. Merck just ran from 82 to 111 and change, hitting again all-time highs. Right here, right now. This is a 35% run. There's been a couple of pullbacks along the way, but it's a 35% move from, again, just a few weeks ago, if you will. As I said, an unfathomable run. What I'm going to do here, though, is a vast departure from the previous trade. First of all, I'm going to be bearish. Secondly, I'm going to take duration. Duration is absolutely critical here because I am stepping in the way, and I don't mind saying this, I'm stepping in the way of a freight train of a stock. It's been exploding to the upside. So I want to bear up a little bit. I want to do it in defined risk, but I know that my timing is not going to be all that accurate. It could continue to the upside, but I do believe that the pullback is going to come. It's going to take the stock back under 100, and that's exactly what I'm going to trade for. This is a March 20th expiration. Again, March 20th expiration. I'm going to go out, I'm going to buy a put spread, I'm going to buy the 105 puts. Again, buying the 105 puts, selling the 95 puts. So it's a nice $10 wide put spread done for a $2.35 debit. So $2.35. That's the risk of the trade, okay? It's a cheap shot for what I think is actually a decent probability for a nice pullback here. Again, 35% run, a lot of political risk in this sector right now as well.
All right, so with Merck, as we take a look at the chart and that incredible run-up, you can see right there, you've highlighted it here with that channel there that Don was just talking about. What's the technical setup look like?
Right, a pretty enthusiastic move to the upside here that for now is hanging on to some of these elevated levels here. So what we had in general, 98, our green line here, back all the way in here was a gap level centered around earnings. That's roughly where we hit highs. I kind of just try to give the general whole number price levels here. But once again, highs around that level, and then we hit support. Also, 95, Don's trade strike level 2 is another area that probably makes sense to highlight here because it's these old highs and lows that matched up roughly there as well, right about here too as well. So 95 would be another standout level to the downside. To the upside, well, actually not to the upside, just still to the downside, but further up, I should say. 105 was roughly where we saw these old highs, 105, 106, and it's roughly where we held support. So we had our breakout, we retreated to support, and then we have pushed above those initial highs once more here, making new intraday highs above 111. When we take a look at the moving averages, we can see that our blue weekly 5-day EMA matches up pretty closely with this boundary line that you could draw going across these highs near 108. That could be a level to watch for potential support. RSI, however, showing a bit more of a bullish outlook here, making new relative highs, moving into the overbought area here, also breaking through that red trend line. Now, when we look at volume profile, we can see that here, the old highs that we saw near 105 stand out as a heavy volume trading area here, and also the level here near 100 and 95 as well, once again showing some additional importance for that particular level. A quick look too at our 5-year chart, and also we can see that for now we're quite a bit off of those old highs here. Now we're approaching the edge of this longer term volume area where we've seen a bit of chop in this consolidated range. So maybe we could be in for a bit of more turbulence once we start hitting these longer term levels.
I like how Don set this one up just to put himself in the way of a moving freight train with Merck, because you can see how steep that incline is. Right now, up on the day as well, too, on a mixed day, up 1% in the third, right now at 110. We were looking at that 95 level. This next chart also had a move to the upside here, a little beat down today. We're talking about Caterpillar. It traded down almost 3% today. Doesn't appear to be any major news behind that move. But, are we bullish or bearish here, Don?
Yeah, this one's actually going to bother me more than anything. I'm going to be bullish here. I'm going to be bullish here because it's very similar to the very first setup that we did in XRT, and that is We're approaching at or near all-time highs. But Caterpillar has a stark contrast from, for instance, XRT. XRT, you can trade it, it's got decent spreads, but Caterpillar's actually got retail order flow written all over it. And what I'm implying with that one is, all right, so we have an underlying that's approaching at or near all-time highs. Anticipate, if you will, call buying to come in here. So for those of you that are not necessarily familiar with what we term, market making or dealer gamma, when retail traders come in and they buy calls, it forces the market maker to sell them calls and then turn around and buy stock. So the retail trader that is buying call options can actually force, if you will, underlyings to the upside. This is all about, if you will, options, the cart leading the horse, which is, of course, the stock. So to me, this is less about price action. It's more about actually the trade itself. And that's exactly what I'm looking for inside of CAT. This trade, I'm going out to the January 23rd expiration. Quite simply, I'm going to go out and I'm going to buy the 635 calls. I'm going to sell the 640 calls. Nice $5 wide call spread done for a $1.55 debit. I'm looking for kind of this explosive nature as we, reach into all-time highs. We're at or near it. And today's pullback, if you will, is just, again, a more opportunistic time to actually hop on board looking for those new highs.
Yeah, we're not too far off of those highs right now. The all-time, the high 625, 627.50. We're at 606.93 for Caterpillar right now. So, Rick, as we take a look at the technicals here, walk us through what they're telling you.
Yes, and Don makes a good point. Those moves that are fueled perhaps seemingly only by exuberance, they're still real, they still happened, and that was still the price at that time, even if they ultimately fizzle here. So these kind of shorter term plays can be very interesting prospects here in situations like these where we're brushing up against our old resistance near 627.50. We have tested that level again yesterday and today, but so far have not really managed to get quite there yet. But we also haven't really filled the gap near 600, which also represents another old high point here. So we can see, like XRT, we are right on the verge of triggering that breakout here. So could be, again, a very interesting setup here if you happen to be long in this name and that starts to happen. A high point here matches up with the old lows here after earnings near 545. So we can see then from our next chart here that much like our other three names, our moving average portrait still shows a pretty bullish picture here. We are still seeing our 5-day and 21-day substantially above our longer term quarterly and yearly exponential moving averages here. One potential hiccup here is that RSI not really cooperating the same way. We have crossed below that overbought area, and we didn't quite make it there this time during our most recent rally here. So what the bulls would want to see would be not only for our red trend line to be broken, this downward sloping trend line that dates back a little further here, but also for that overbought area to be crossed in a strong way that shows some kind of conviction, kind of cementing that breakout. Finally, our volume study here, our volume profile shows that the important trading concentration area right about here is near 575. So a really clear node standing out there. The next important level from this perspective, 525 stands out as well.
Yeah, and those both considerably lower than where we are right now at 607.30 for Caterpillar. But shockingly, Don Kaufman looking for two bullish moves in two similar charts. I'm not sure what to make of this day, but Don, it's so great to have you with us. Two bullish calls, one bearish. That's Don Kaufman, co-founder of Educator, and of course Rick Ducat, our lead market technician here on the network, for being with us to break down the technicals. Coming up next, we are going to head out to Las Vegas and give you the latest from CES 2026. Stay with us.
Sometimes, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Morning movers, be the first to find out what's shaping early market action. Tech check, options corner, futures focus, technical analysis. Morning movers covers it all. Grab your coffee and tune in every trading day at 8 a.m. Eastern, only on Schwab Network. Kick off the morning with the data and the decisions moving markets.
Morning Trade Live breaks down the macro moves driving the price action, from Fed policy to global growth to inflation prints and geopolitical risk. Smart, fast and always live from Wall Street to your screen. Morning Trade Live, where the markets meet the macro, weekdays at 10 a.m. Eastern on Schwab Network. Welcome back to Trading 360. I'm Marley Caden, live in our Chicago headquarters. It's time to spotlight CES 2026. Joining us now to help us do that, Stephen Dickens, the CEO and principal analyst at Hyperframe Research. Stephen, we appreciate you joining us from Las Vegas. I hear you're at CES.
Yes, it's a crazy show, so I'm coming to you from my hotel room, so apologies for the somewhat simple background.
Oh, no apologies needed. We appreciate you taking the time before your day kicks off there in Vegas. So as far as what your key takeaways are, obviously AI, the big story. We're not just gadgets now, almost signaling a shift in direction here. You know, what are some of the major themes that you're noticing?
So, this show's fantastic. It's huge. We're across multiple hotels and convention centres and conference centres, and there's everything from AI-powered swimming pool cleaners and toothbrushes right through to enterprise tech being launched. This is no longer just a consumer show. I've spent time with NXP from a semiconductor perspective. I've spent time with Global Foundries this week. So this is really becoming an automotive show. It's becoming a semiconductor show, and obviously we've got the consumer piece. Particularly impressed with the 130-inch Samsung TV that I saw on the show floor. But joking aside, two big things have kicked off. Jensen Huang and Lisa Su in their keynotes making announcements. NVIDIA launched their Cosmos World Foundation model, and AMD announced their Ryzen AI embedded P100 series. What this is about, we're starting to move beyond physical AI, from generative, we're moving beyond the generative to the physical AI and robots. I've seen a lot of robotics companies demonstrating here on the show floor, and I think that's the next wave. Also had conversations with the team at Global Foundries and their recent acquisition of MIPS. Spent time with their CMO. Really fascinating conversation, and what we're seeing is this embedded AI moving us beyond the sort of ChatGPT revolution into this embedded. We're going to see that moving beyond what you think and write, which has been probably the first wave of AI, to what you see and do.
So as we move from this sort of more conceptual chatbot-based AI concept to this physical AI and these robotics, and we had the CFO of Oshkosh on yesterday talking about their AI fire trucks and AI garbage trucks. We're really starting to see it in practice. You know, does this physical AI shift dramatically expand the total addressable market for semiconductors and hardware?
Exactly, Marley. That's what we're seeing. This, I spent time in NXP. They basically built a building in the parking lot. This is going to be a huge activation for them and significant marketing dollars. I spent some time with them yesterday. Asked them why they're here in such numbers. All of their customers are here. All of those people who are embedding AI. I spent time with Enphase, the guys who were competing with Tesla for solar panels build-outs. Fascinating stories. So for the semiconductor guys, this is a TAM expansion, and I think from translating what we're seeing on the ground here at CES with a tech perspective into what the traders and people who watch the show, the key takeaway is Jensen's here. I saw him twice on keynote stages in the last 48 hours. Lisa's here. Lip-Bu Tan was on stage with the YY, the CEO of Lenovo, yesterday. All of these guys are here because of TAM expansion.
And another thing I keep hearing mentioned and seeing in the headlines is agentic AI and this move from systems that don't just respond to your requests, but they actually act on your behalf, this movement away from the traditional chatbot. How big of a leap is that from the physical assistants that we know now?
So I spent some significant amount of time with the team at Lenovo and Motorola in the last 48 hours. I got a chance to spend some time with YY, the CEO, last night, and I'm spending some time with him. Literally, I've got to run from this segment for a meeting with him. They launched Kira which I think is an interesting point to what you were saying there, Marley. This is a cross-device agentic assistant. This is going to follow you from your apps to your Motorola phone, to your tablet. It's going to be a cross-device agentic framework. And I think that's what we're going to see now. We want to be able to have those immersive experiences and then follow us wherever we are, regardless of device. The other thing that I took away from the session and the time I spent with Lenovo, they launched 3 new servers yesterday. 2 with Intel, 1 with AMD, focusing in on the inference market. So we've been talking about these large language models for the last 2 years. We've been talking about training. What we're seeing now is a pivot to inference. So I think NVIDIA was in there, AMD was in there, Intel was in there. Again, going back to this TAM expansion point, we're going to see that inference boost. One of those servers was an edge server that Lenovo launched. And I think that's crucial because you're going to see that in retail, you're going to see that in healthcare, you're going to see that in smart manufacturing. As this AI moves into prime time and moves into mass adoption, I think this is going to be TAM expansion for those semiconductors, but that pulls through the rest of the market.
All right, Stephen, one last question for you since you have to run off to that meeting. But as we move into inference and agentic AI and this idea of physical AI versus conceptual, does this next phase favor a broader group of winners than just these couple mega cap names we continue to talk about?
I mean, there's obviously a play there for the semiconductor guys. I talked about the Jensen, I talked about Lisa, I talked about Libutan, the time I spent with Global Foundries and NXP and those guys. There's obviously a tailwind for those guys from what we're talking about here from a TAM expansion. But I think, this is going to pull through names like HP, HPE, Dell. It's going to pull through names like Lenovo that I mentioned. There's a long list of winners as we see this overall TAM expansion. It's going to be a rising tide raises all boats scenario, because I think you're going to see a lot of people have that enabling technology come from the semiconductor guys. You're going to see the frameworks and tooling that comes alongside it so that they can build, and it's just powering innovation across the stack. As I say, I've seen AI-powered swimming pool cleaners and toothbrushes. I mean, some of that's not going to survive, obviously, but I think what we're going to see is that this AI is going to be able to be democratized and available in so many different devices and configurations that it's going to raise all boats.
Stephen, we appreciate you taking the time before your busy day at CES to highlight some of your key takeaways. That's Stephen Dickens, the CEO and Principal Analyst at Hyperframe Research, joining us live from Vegas. Coming up next, we've got the Disruptors. We'll be taking a look at Qualcomm potentially making an AI chip deal with Samsung. That's next.
The Schwab Network. Tune in 24 hours a day, 7 days a week on SchwabNetwork.com
and on all your favorite streaming services.
Schwab Network, available anytime, anywhere, on any device for free.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Do you like using charts when analyzing your stocks? Our technical analysis webcast series breaks down different charting techniques like trend analysis, price patterns, moving averages, oscillators, and much more. Best of all, You can ask questions directly to an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Welcome back to Trading 360. I'm Marley Caden here at our Chicago headquarters. Let's head out to the New York Stock Exchange for a check on the markets. Welcome in Nicole Petalides, host of Opening Bell and the Watch List. Good morning to you, Nicole. We're 2 hours into the trading day. We got some data this morning, but still seeing a bit of a mixed picture.
The exciting part is record. I mean, you know, look, it's only a few days into the new year, and we're seeing records for the S&P 500 and the Dow Jones Industrial Average. Today, right now, the Dow has since pulled back and now in the red, but did hit record intraday highs today in the morning. And people are eyeing Dow 50,000. They're eyeing the S&P 500 at 7,000. Get the hats ready. They are, in fact, ready. I've seen at least the 7,000 one. So there is some optimism here on Wall Street overall. Yesterday, a lot of tech talk really helped to boost things along, as Jensen Wong over at Consumer Electronics Show has talked about excessive demand and we need more energy. Just sort of full steam ahead when it comes to all things semiconductors and chips, and that brought optimism. Also, we've had energy being a big story now on the heels of the Venezuela story. In fact, all the CEOs of the big energy companies will meet with President Trump on Friday to try and reposition in Venezuela. We're actually now going to take in 30 to 50 million barrels of oil from Venezuela, sell it at market price, and then use that money for Venezuelan people when appropriate. So that's been a big story. Sandisk has been the story of the year. It's up more than 45% in just a few days, so that's been a winner. Warner Brothers.
Oh boy, back at the top.
Paramount, that story continues to go on. The Warner Brothers story has been incredible.
Oh my.
Warner Brothers up 167%, so it still looks like they're going with Netflix. Those are a few of the things that I've been watching, and the Jolt data really, that is still at near 5-year lows as far as opening. The ADP was a little stronger.
Yeah, a bit of a mixed picture in terms of the labor data we're getting ahead of Friday, but we did get a lot of analyst action today as well, making their 2026 calls. One of them is for McDonald's, and it's bullish in the restaurant space and pretty bullish, well above the average price target. Can you walk us through Oppenheimer's call here?
Yeah, it's really interesting because basically they're looking for revitalization, a comeback for McDonald's, because McDonald's had to raise prices after COVID and there was inflation. Beginning in September, they've actually been cutting prices and moving more towards value meals and such. So OpCo puts an alpha
480, the 6960s.
I'll tell you, Barclays has a 372 target.
The 6960s are now at 480.
Optimism that the analysts do have on the name, that has been
530.
sort of in a downtrend, right? I'll tell you, let's say over 1 year it's up 3%, so it's a lot of nothing. But they do think that they'll see revitalized earnings for 26 and 27, innovation in the pipeline, the value perception, everything for the buy one, get one for $1, $5 value meals, combos that give you a 15% savings. These really provide value, and that's what people are looking for. And they've also brought the prices down. They brought back things, they brought on things like the crispy strips and snack wraps, and so overall, you do have OpCo saying this is a golden opportunity for a breakout for a name like McDonald's, which has been sort of really underperforming, and they think that now going forward, they're really bullish on the restaurant sector overall for 2026, which in 2025 underperformed. They had top picks, which include Chipotle, Domino's Pizza, and McDonald's, which we're going over right now. But really just this value perception, these things where you get a combo meal and you get 15% off if you had bought it separately, for example, and this buy one, get one for $1, the $5 value meal, things like that, and innovation. So good news. Apparently, the analysts think for McDonald's in the year ahead.
Yeah, and we're trading slightly higher on this mixed day, about 6 tenths higher. Nicole, we appreciate you walking us through that note from Oppenheimer on McDonald's. That's Nicole Petalides. And now it's time for the disruptors. We've got George Tillis joining us now, our senior markets correspondent here with today's company. We're talking about Qualcomm after saying that it will likely use Samsung's process to manufacture mobile application processors. George, what can you tell us about this and how important is it?
Well, I think this is interesting. I mean, one of the things I noticed about Qualcomm, it's actually the largest wireless chip vendor globally. Their licensing technologies are used ubiquitously across multiple communication chip technologies. Their CDMA technology also blends together communications chips with computing, like CPUs. They compete with companies like Intel and AMD, but also companies like NXPI in the automotive segments, as well as ARM holding in the licensing technology stack. It's all performed up about 10% over the last 52 weeks. Usually these stocks move in tandem, or I call them they travel together, and this is one that's been underperforming. Now they're actually moving to a 2-nanometer process technology, which is again a smaller chipset technology. And I think what the news today is associated with is that they usually utilize Taiwan Semiconductor as an exclusive foundry manufacturer or contract manufacturer. It looks like they're broadening that out to include Samsung, which is actually becoming one of the larger contract manufacturers globally alongside Taiwan Semiconductor, and of course Intel as well. So I don't think this is necessarily a game changer in terms of Qualcomm's prospects per se, but it does give you an idea that they're advancing manufacturing technologies, which may indicate there's more demand for their chipsets and licensing technologies going forward. One of the things about Qualcomm is that it may end up participating this year associated with what's going on in the mobile chipset space and the automotive chip space to integrate, of course, artificial intelligence and the demands for edge cloud computing. We are seeing, in fact, the memory storage manufacturers, Micron, Seagate, Western Digital, for instance, SanDisk, all performing quite well, but those companies, again, use memory to, again, store it and produce the outputs for artificial intelligence, but a lot of the technology stack associated with that include the cellular names, cellular chip names, including ARM and Qualcomm, which still haven't been performing. So, for what it's worth, again, this may indicate there's strong demand going forward for Qualcomm's technologies. And again, that also means it potentially could go higher from here.
Yeah, and also Mark would move away from almost working exclusively with Taiwan Semi and going back to Samsung's foundry process. But Qualcomm trading lower today, we're down 2.7%. So with that move to the downside and a dip here as you're setting up your example trade, how would you structure it?
69.60, 520.
Work going on within the semiconductor stack. Yesterday we saw Seagate, Western Digital all ran higher, all moving lower today, as well as Qualcomm. So I think this is basically just a back and forth in terms of trying to find footing. But if you look at Qualcomm, at the very least the last quarter, 185 seems to be an area that's trying to break through. I'm not saying it's going to, but if you go back on the chart, you can see it going back to October, December, even this last week. So with that said, we are seeing a pullback today. So what I'm going to do is I'm going to structure a trade in anticipation of a potential break above that 185 area, with the pullback in mind. So I'm essentially going to go out to February with about 44 days to expiration. And I'm going to structure a long synthetic combo trade. So this is essentially synthesizing a long stock position. I'm going to buy the in-the-money 175 call, and then sell simultaneously the 175 put. And altogether, it costs you about $3.50 a share, $350 a contract. So the whole premise behind the trade is you have to get break even at least 178.50. If it hits that, you do have a limited profit potential, so it's unbound to the upside. But again, at 178.50 is your cost basis if you are assigned shares, and that'll happen if stock hits 175 or lower. So again, it's a play on the potential break to the upside with some time embedded in it, because I'm selling that 175 put to help finance the 175 call.
George, we appreciate you being with us to break down the latest here for Qualcomm and also for that example trade. That's George Tillis. Coming up next, we've got our 360 round. We'll be taking a look at the ADP jobs data that was released this morning and also previewing expectations for Friday's jobs report. Stay with us.
Trading with Schwab is powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
And I'm Jenny Horn. This is Next Gen Investing, where we track the trends shaping tomorrow's market.
From tech to energy, crypto to consumers, we focus on what's driving investor sentiment right now.
Clear analysis and forward-looking market coverage every trading day.
This is a make or break level for this stock.
And that could certainly be short to near-term catalyst.
Next investing, 1 p.m. Eastern.
Only on Schwab Network. Welcome back to Trading 360. I'm Marley Caden. It's time now for the 360 round. For that, let's bring in our panel to discuss the ADP jobs data that we got this morning. Joining us, Joe Galvin, the Chief Research Officer at Vistage, and Corey Staley, the economist at Indeed. Thank you both for being with us. Corey, we got the ADP data this morning showing just 41,000 jobs added, which was below the expectation. Do you view that as a red flag for the labor market, or is this just confirmation that hiring is slowed but not cracked?
I don't necessarily think that, the one number could be taken as a red flag. I mean, certainly it is a little more of a yellow flag when we look at the context of where the labor market has come in the last couple of years, right? Like, we saw much higher numbers. We were getting, these 6-figure job gains we added. Now we're seeing consistently much fewer and even some negative months happening. And so, very clear signal here that we're seeing a labor market that is adding fewer and fewer jobs. And we're seeing that not only in ADP, but we're also seeing a similar thing in the BLS jobs reports going as well. So.
And Joe, you've been surveying CEOs for more than 1,500 smaller and mid-sized businesses. How closely does today's ADP number line up with what they've been communicating to you about hiring plans?
It's very consistent with what our CEOs have told us. In our June survey of over 1,500 SMB CEOs, only 42% were planning on increasing headcount the year ahead. And that's the lowest number we've seen in the post-COVID era, driven by volatility, uncertainty, tariffs, the usual suspects. We fast forward to Q4, and what we see now is that 57% looking ahead plan on increasing headcount the year ahead. So with hiring taking 3, 6, 9 months to take place, it's pretty consistent with what our data says. It also suggests looking forward, we'll see a rising labor market as more jobs are made available. Also interesting in that Q4 number is only 7% plan on decreasing headcount. That's a drop from 13% just a quarter ago. So I think you're seeing a labor market that's starting to stabilize. You're seeing CEOs look at where they can grow and how they can grow with the working hours that humans remain the fossil fuel of growth.
And Corey, as we head into Friday with our jobs data that we'll be getting, what do you think is the most important thing to focus on here? Is it
$5.30.
Is it wages? Is it the unemployment rate?
Well, you're yakking today, baby.
Number is always interesting to look at.
God.
I think that the most important numbers.
She does ask good questions. There's many of them I would never think about it. So we got the 6960s, the SPX. I guess I just got one contract. And they're now at $5.20 with a 293 average. Alrighty, time for lunch. Spy with a new high. $6.20.
Probably met 20 years ago. Jim's really been there to answer any questions I ever have. Makes a huge difference when you have someone that actually cares.
Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
That ain't good. Oh my gosh.
Welcome to Fast Market here on Schwab Network. I'm Diane King Hall. It's noon Eastern here at the New York Stock Exchange, and Wall Street grappling with some cross currents after new all-time highs for the S&P 500 and Dow. Let me give you a check of your scorecard as we hit the lunch hour on Wall Street. We've got mixed markets right now. The S&P 500 has a gain of about 0.25%. Interestingly enough, pacing the gains, we've got healthcare at the top of the leaderboard. It is followed by consumer discretionary and information technology. There are those who argue, obviously, you can't continue to see the gains, at least with a certain weighting, without tech, without consumer discretionary. But there are also those who point out the broadening out that we've been seeing. The Dow pulling back a little bit after its records, off by just shy of 0.2%. We'll see. We'll continue to watch and see if we may possibly hit another record later today. I know some investors are on 50,000 watch after crossing 49,000. We'll see. NASDAQ 100 right now has gained more than 0.5%. There you go. Tech still at the top. Russell 2000 small caps taking a step back, off by a little bit more than 0.1% there. Here's the roadmap for today's show. We will look at example option strategies for Boeing after it landed a big airplane order from Alaska Airlines.
Boeing.
Plus, the team from Lightfolio will be along with new sentiment data on Delta Airlines. And sticking with our theme, United Airlines is also on our radar today. Now that we've got the roadmap for today's trading action, I'm bringing my co-host. You've got Kevin joining us live from the SIBO. Joe Mazzola will join us shortly. Tom White has the day off today. All right, Kevin, when I look across markets, I know we're mixed right now, but it seems to be just keep buying is the theme on Wall Street.
$7.
Analysts that I hear from, that I read commentary from, say pay attention to the broadening out because you think about the equal weight, you think about
Pay attention.
price action in transports. What's your take when you look broad strokes across the markets, Kevin?
Tell them kiss your ass.
You know, Diane, we've been talking a lot lately about the S&P 500 equal weight versus the Magnificent Seven, or versus the entire index. And even though we have 5 sectors in the S&P 500 higher and 6 lower, and the equal weight S&P 500 is down 0.6%, we're higher. You know why? Because it's communication services, it's information technology, and it's consumer discretionary.
It is not.
Those big three are 3 of the 5 that are higher. And when those 3 are higher, it's very hard to sell this market off because they are such a big swath of the overall S&P 500. So one of those interesting days, we've been talking a lot about the equal weight versus the S&P 500. Today, it's the opposite. It's the S&P 500 higher by the weighted stocks, higher than the equal weight. So fascinating market here. Like I said, hard to sell this market off when information technology is higher, communication services higher, and consumer discretionary higher. So big names dragging the market higher, but
$6.97.
Hard to figure out. We're getting awfully pricey up here ahead of fourth quarter earnings, Diane.
Oh, good point.
You have to pay attention to the weight,
Good point.
to the heavyweights, because one of the things I looked up, and I'm glad we brought the heat map, is I looked right at the heat map to see what's pulling us higher. You've got NVIDIA higher. It's above 190. I know, we've kind of been like flirting in and around that level. It's got a gain of 1.5% today. It didn't have the tailwind earlier this week from CES because you thought some of that might have come because of the super chip. You got Microsoft higher. You've got Alphabet, Google higher. So you've got some members.
And you were bashing the heck out of it in the video. Not me.
I just think that looking at, the one great thing, and there's a lot of great things, but
Got
the
a new
one great
high.
thing about the Thinkorswim platform is the visualization, the heat map. And it shows you how much those 3 sectors, information technology, communication services, consumer discretionary, how much they drive the overall S&P 500. Remember, 6 sectors of the 11 are lower today, but yet the S&P 500 is higher. So, when you've got the big names like that going higher, and let's face it, healthcare is also doing well. The other one that's up is real estate is higher. But, you're still looking at a overall market that seem to want to rally into earnings season starting on January 13th, but the broad look that a lot of times that we're talking about, that isn't there today, right? The equal weight is actually down. So I think watching these as we prepare for fourth quarter earnings season, Diane, the bar's getting pretty high here because of where the overall market is. So I'm watching these names very closely. We're going to talk about a lot of names today that have had really good runs
up into today's date. So that brings problems going into earnings. When the bar is high, Diane, as you know, it's hard for them to beat on earnings, and anything can weaken a stock, just like the opposite. When the stock is beat up,
I'm glad I heard him say that.
any good news can rally a name. So that's what I think. That's what the theme we're setting up for going into fourth quarter earnings season.
Great point there. And, you know, obviously, when
I have to give him kudos for saying that, because I don't know if I'd have thought of that. I might have. Back in the day, I would have. But I don't know if I would have thought about that now. Is that, you know, we could be priced in already into earnings. I think banks are first.
that's not necessarily a bad thing in terms of where we go from here. What's your thought, Kevin?
I think when you look at the numbers that we've gotten so far this week from jobs, it's kind of going along the same theme, Diane. The no hire, no fire. I hate nicknames, but it really fits this market. And look at what we've got here. Yes, we got some private sector jobs, not a big number, but a good solid number after being negative last month. So 41,000 jobs. If you look, it was education and health services added 39,000, leisure and hospitality 24,000. You know, business services, professional business services lost 9,000 jobs. Every category of size of business was higher, but not by a lot, right? And the jobless claims data we've been getting has been showing not a pretty strong labor market. However, in terms of new jolts, job openings, much less than expected and lower than last month. So I think this is painting a picture that we have to come to grips with. Is this labor market is just dead in the water right now. A 4.6 unemployment rate, jobs significant, consistently under 100,000. We're looking for 55,000 on Friday. This is a labor market just not moving. And like I said, I hate to say it, but no hire, no fire seems to fit this current labor market.
I know. I didn't know you hate nicknames. I would have thought that you like them. I do. I actually like them when there's kind of a nickname for the situation. Although
like
no
Mr. Hickey,
hire, low fire, however you want to call it, it's. Yes, it's I guess the
or Mr. Spitty.
Nickname for it, but it is troubling because I was having a conversation earlier today with Joe Bruce-Willis, chief economist over at RSM. And
yeah, that could be troubling.
If hiring is starting to decouple from growth, right? So right now it seems like the market reaction is it's not a bad thing because it probably leads the Fed to cut rates more, which could be good long term even for the job market, right? Because they're paying attention to the job market as well. But long term is that.
See, no hire, no fire. I've done that for about 12 years now. I tried to hire people, make my company grow, but I just could not find any help. And I'm talking $5 above minimum wage. I could not find any dedicated help. I think that's where it comes across, dedicated.
As well on Friday, we'll be watching that real closely as well.
All right, let's talk the memory stocks, memory and storage stocks. They look like they're not remembering a lot today. So you take this all into context because you obviously have years of trading experience. I wonder if this is not surprising to you given the powerful move that they had yesterday. So you've got Western Digital down, what is it, down 9% right now, down 8%. you name it in this space. They're lower today, but they had those massive double-digit moves yesterday. What's your thought from the years of trading experience you have? Does this kind of make sense? Is it not? Is it more of just a pendulum swing that happens?
By the dip, baby.
Certainly the news cycle, the headlines, Jensen Wang's comments, all favor the demand story for memory. And all these names that have run, yes, the story is good on them, but the charts are ridiculous, Diane. How far they moved from bottom left to top right. The air's getting a little thin up there. And when you see a stock like Micron that we've seen historically in single-digit PEs, it's now a 32 PE. What you're thinking that is, it goes to an old trader saying, no matter what the company is, no matter how good or how bad a company is, at one point I want to be long it, at one point I want to be short it. And stocks get overbought and oversold all the time in good news and bad news. And at some point as a trader, you've got to take profits. You've got to at least lighten your position. That's what you might be seeing here. The news is all good, and these stocks have run a long way, but as you can see today,
that's right.
Taking a little breather here as someone out there is taking some profits, Diane.
Yeah, it looks like that to me, too. All right, let's welcome Joe into the conversation. We got Joe Mazzola joining us now. Joe, we're looking across the memory names. They're taking a step back after that big move yesterday. Does your thinking line up with what Kevin mentioned in terms of you got to watch the charts on this?
Yeah, 100%. You had stocks that are moving 15, 20% a day, not a month, not a year, a day. And to see that those type of rallies, it absolutely makes sense that there's going to be some fading at some point. Traders might be looking for better entry points. It could be a pullback. It's where I like to use something like a Fibonacci retracement to kind of see where there might be some of those levels where traders might start to step back in and buy them again. And so there's a lot of different ways to kind of look at these in terms of valuations. I think what Kim was talking about with Micron and Sandisk, Western Digital, these are stocks that are way more than triple digits in the last 52 weeks. So a healthy pullback is just that. It's healthy, and looking for better entry points might be what the market's doing today.
Okay, and then speaking of entry points, we got mixed markets after those records that we're on record watch though. Maybe we'll hit another one in the S&P 500. Maybe we won't. We'll see today. The Dow, though, pulling back a little bit right now. We look at broad strokes across markets. What's your thought, Joe?
My thought is that we are setting up with what appears to be maybe a little bit of a breakout of some of this consolidation as we're heading into earnings. It's interesting to me to see kind of how constrained volatility has been, given the fact that this week alone we're going to have non-farm payrolls on Friday. We could theoretically get some type of announcement from the Supreme Court about the legality of the tariffs, and then within the next week or two, we're gonna kick off the earnings cycle as well too. So, implied volatility has been a bit subdued. Now, that being said, I think what's really important is to kind of look at a couple different things. Number one, there's a spread between, Kevin knows this, implied volatility and then the realized move, and that spread is actually pretty wide right now. So even though volatility seems cheap, you're just not getting a big enough move from the options market, from the underlying, to offset the price that option traders are willing to pay for things. And I think what happens is when that occurs long enough, and this goes really back to probably the week of Christmas, so you got all those days where we weren't trading on Christmas Day and on New Year's Day, and people just kind of really started to make their way back into the offices this week. You're starting to see a little bit of that volatility buying, but not much. And when I look at some of the straddle prices for the indexes and some of the ETFs heading into, especially some of the sector ETFs heading into the earnings cycle within the next couple of weeks, boy, they seem like relatively cheap. I wouldn't be surprised to see some buying of that kind of heading in, to some of this macro and specifically some micro events that could be market moving.
All right, so speaking of market moving, we've got some potential deal news happening in the healthcare space. This is according to a Wall Street Journal report. Eli Lilly they're continuing to make these moves to beef up their drug pipeline. According to the journal, the drug maker is in advanced talks to buy Vintex Biosciences. Shares of Bolt are actually gaining ground, which you don't often see that with the one who's making the acquisition, but I guess the street likes this. Kevin, what's your take when you look across this? And what was also interesting to me is this doesn't seem to be about GLP-1s.
Yeah, well, first, let me say for full disclosure, I am not a healthcare analyst or a biotech analyst. However, when we see one company buying another, and the buyer rallies $50, that is, the news to the street, to the trading community, that this is perceived as a pretty good buy or something that's really going to help this company. So, without giving specific on either of the names, I'm looking at Eli Lilly up $49 on this news, and so that means that the street thinks that they're adding to their portfolio. Remember, these pharmaceutical companies, they have massive product portfolios. And let's face it, Eli Lilly was perceived as being a little slow to the game in weight loss or whatever. And so when it rallies like this, that tells me that the street feels pretty positive about this deal, and they're not doing anything. Think about some of the takeovers that we've seen, like Salesforce and other companies that have bought and their stock is going into a winter while they're buying. Not so much in this one. It really looks like the street thinks this is a good deal.
Indeed. And Joe, what's your thought on this one?
Yeah, broadening the portfolio. This is more of an anti-inflammatory kind of Crohn's disease type of a pill that can be taken to help with those issues. And so, yes, Eli Lilly has been kind of earmarked as the GLP company in the last few years, and it's done extremely well, right? With that title, but as any pharmaceutical company has to do, right? They have expirations on patents at some point, so they're looking to kind of broaden that portfolio. The street's rewarding them right now. I think, my personal opinion is the bump that you're seeing today. I know Kevin said it's $50 move, but that's still 5%. So it's everything's relative, right? The stock was a $600 stock just a few months back, so it's already had a pretty decent move. To me, it looks like there's a little bit of a technical bounce as well with this, but here we are setting all-time highs, and on a day when they're announcing a deal. So as Kevin mentioned, look, it sounds like the street is very comfortable with this deal, and they like the fact that they're running the portfolio.
Very much comfortable with it, to your point about the new all-time high today. So, okay, rewarding them with that advance and the diversification of their pipeline. We've got bull versus bear coming up. Guys, get their example trades put together for Boeing. That stock's been climbing today after a big plane order. A lot more fast market after this break.
$21 and the 9 are squeezing. We're going to know something within a minute. Blakey.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Sometimes, you know, you could have done better.
That's a
Same
bad
goes
job.
for where you invest. Level up and invest smarter with Schwab.
Looks like that applied.
Boeing are gaining some ground today after Alaska Airlines says it is ordering more than 100 new jets from the plane maker. The jets will be a combination of
When are they going to get them done?
787s with deliveries
Oh, God, look at that.
through 2035.
Beautiful.
This marks Alaska Air's biggest plane order ever. The company says it's an effort to both expand
Ever?
the fleet and replace some aging aircraft. Alaska Airlines currently has a fleet of 430 aircraft and projects it will grow to more than 475 by 2030 and more than
Kidding me.
550 by 2035. All right, time now for a step more on Boeing. For that, let's welcome back in our co-hosts Kevin Hinks and Joe Mazzola. It is bull versus bear time. So before we get to your example trades, we got to talk your thoughts on Boeing. Big plane order. Is it a further tailwind? Because listen, last year was a good year for Boeing. Joe, I'll start with you. Your thoughts.
So you use tailwind, you use climbing. I'm going to add soaring to the analogies that we're going to use for airlines. Look, this stock just within the last kind of 6 weeks, really since mid-October when they pulled back from 220 down to about 175, back to where it's at now. It had a pretty decent breakout yesterday, good candle. Looking to maybe, kind of push back towards all-time highs. I like the charts on the stock. I think they're very constructive. It's almost like a V or kind of a U-shaped bottom that we've put in the last 6 weeks. It looks like the stock wants to run to the upside. You get some decent fundamental news today in terms of the Alaska Air order that you've talked about. Now, that being said, I think the biggest thing that investors need to pay attention to with Boeing, for me, is always the cash run rate. Right? Are they generating cash flow? It seemed like they've turned the corner this year and started to do so. And for me, that's what I'll be paying attention to when we go to the next earnings announcement.
Okay, Kevin, what are your thoughts? I know you've been following this one closely for years now.
Diane, Boeing and I have a love-hate relationship, but we've had it for a long time. And, it's interesting to look at a chart that's just rallied, 70 or, 25, about $55 the stock has rallied. And you look at their last earnings release, and it's a negative $7.47 a share. If you remember, they took a big charge in their last earnings report that made the stock break
$8.30
until 2027. The release of some wide body
James.
jets, the 787.
Okay.
They're still getting orders for them. Kelly Ortberg has this company turned around. I think a big.
Excuse me, Mr. Spitty. It's Washboardjim. As I get ready to speak, I'm going to discuss a couple philosophies here. We have a double top. Now we can either consolidate, kind of pull back just a little bit, and have a cup and handle, and then boom, and break the double top. Or we break the double top and still have the cup and handle.
And the orders keep piling up. The backlog, even though they're delivering more planes.
Or we exit the idea because they're at $8.30 right now.
That said, it has run about
It's $11.25.
and it is overbought on the RSI, Diane.
Okay, so there's the analysis there and the explanation of your love-hate relationship.
10-4.
with this. Let's get into the example trade. We'll start with yours, Joe, first.
Everything Kevin said is true. The stock is trading.
She took the 1150s this morning.
Perspective, it's had a big run.
Damn, Sue.
And I think when something like that occurs,
Girls.
Something like a stock
Hot.
replacement strategy can be helpful for traders or investors because that way they don't have to pay the full debit that they would to own the
Let's
shares.
put her in my top three.
Still allows them to participate in some upside. Specifically, what I was calling
Top five, all in all.
around the 220 level. They just really happened about 2 days ago. So what I'm looking at is
Okay, here comes the
basically a
pullback.
call to action. I know Kevin looks at a lot of these, but what
See
we're
the
doing
double top,
is
now you got the pullback, and we went below
February 20th
support.
expiration, the 230
So I
call.
don't know if I
So
can
the January 23rd expiration, that's the 240 call.
depend on it.
The reason I chose the 23rd expiration, that is because that's the week prior to earnings. I believe the earnings come out on January 28th. So what you can do as a trader, as an investor, if you're looking at this trade and it's working out for you, the way this trade works out is that you continue to get this kind of slow grind up that we've seen. Now, you can make the case that it hasn't been a slow grind. You know, given that candle that we had a couple days ago where we had that big move, I wouldn't be surprised to see a little bit of consolidation. Way. And this is the type of trade that would benefit. It's almost like a covered call without actually owning the shares. What you have built into this is you have that long call from the February 230 strike. And what you can do is you can roll that 240 strike. So if it gets in the money a little too quickly, you can always roll that out. Or like I said, as you're coming down towards that earnings announcement on what appears to be January 28th, you could exit the position, or you have some optionality where you can kind of move this thing around. So that's why I like the embedded call diagonal here, because of the fact that it gives you some flexibility. And at the same time, when you're looking at implied volatility right now, it's still relatively low.
Jimmy's getting good at knowing when to get out.
Implied volatility percentile.
Okay, Kevin, what's your thought on this before we get into your example?
DAR.
I have your percentile of 7 in Boeing, so you're talking about the bottom 1/10 of the.
Anybody know what I'm talking about?
Therefore, I like the fact that Joe went out for a full month. He went all the way out till February 20th, so a month and a half into the future, and bought the 230 call, selling a 1 month earlier. That gives him several options. Number one, it gives him a fair amount of Vega, which is buying implied volatility when it's low. And you also give you about 3 or 4 chances to extend duration and chip away at that net debit. You look at a $10 diagonal paying, between $8.50 and $9. You think, well, that doesn't look great. But if you think you've got it for a month, you've got 4 chances to chip away at that net debit. A lot of fun you can have with a trade like this, Diane.
Okay, all right, so that's your reaction to that one. Now, what's your approach?
So I did something a little bit different, and that is I went for movement. And I don't know. Boeing could go up another $50, or it could move significantly on the downside like it has in the past. I don't know where it's going. So the fact that it's moved so far, I want to, the paper money trade that I want to look at, if you think that it could move and you're not sure which direction, there's a lot of choices you can do. You can do a long iron condor, you can do a double calendar. This one I did was the 1/2 back ratio, which is, I looked at the expected move. I went out till January 23rd, so I stayed ahead of the January 28th earnings report. Went out to January 23rd, about 16 days. What I did was I sold. Let me get my strikes here, make sure I'm right. I sold the 242.5 put. I sold 1 in the money put, and then bought 2 of the same expiration, January 23rd, 230 put. So I bought it right at the money or slightly out of the money put, around 230. Sold the 242.5, so I did the back ratio, but I collected about a $3.60 credit. It's actually a little lower than that now. It's been working its way lower. It's closer to $3, but I collected a credit for this trade, which means if it goes to $242, I simply keep the credit. But on the downside, if it were to break on the downside, I have an extra put unit. I have a short put vertical and an extra put on the downside. So even though I'm paying theta for this trade, not collecting it, I have the benefit of a move in either direction. I'm profitable, Diane and Joe.
Okay, Joe, your thought on this one?
You know, this trade as a standalone trade is very bearish, but this trade could also be used in conjunction if you're long the shares. If you're long the shares and you're looking for a way to provide a little bit of extra protection on the downside, as opposed to just going out buying puts on their own, doing this back ratio should now. This would require a big movement in share price, which, you know, should that occur, then this would work out. So interesting trade.
All right, there you have it. That's our bull bear take on Boeing. Coming up, we got cash tags. We're taking a look at Delta Airlines. Several analysts boosting their price targets on the stock today, including Deutsche Bank and Citigroup. Keep it right here on Schwab Network. Fast Market. We'll be back after this break.
Hi, I'm Alex.
I'm Jane. And I'm his mom.
Sometimes, you know, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
I'm Sam Landis, live from the New York Stock Exchange. When the market moves, we're on it. Getting the reaction, the strategy, and sentiment in real time. Stream Schwab Network at schwabnetwork.com.
Trading at Schwab is powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat.
Like we're pulled back some here.
With Schwab.
Coming to the 63.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with your coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
No politics, no spin. Just the market from open to close and beyond. Streaming 24/7, any screen, anywhere at schwabnetwork.com.
Welcome back to Fast Market here on Schwab Network. I'm Diane King Hall alongside my buddy Kevin Heath over at the CFO. Time now for our cash tag segment because we want to bring in our next guest, and that is Andy Swan, co-founder of Lightfolio. We are taking a look at Delta Airlines today. All right, Andy, let's get into it because we've seen a lot of analysts come out and they're updating their price targets on Delta, raising them is what I'm noticing. When you look across your data, what are some of the takeaways that we should know?
Yeah, I think the analysts have it right. I think the market has it right to be bidding up Delta here. This is a company that is just a clear leader in the space. You know, they're able to charge more for more premium experiences, and that's exactly what people want. When we look at web visits, which are very indicative of future revenue for these airlines, because that's where people go to book their flights or to at least research their flights. Delta up 7% year over year. Only United is beating them, while both American and Southwest down 4% year over year. And both those were off of pretty low levels last year. So Delta doing very well here, separating itself from the pack. They're the most profitable airline. They've got the ability to charge their customers for premium upgrades. And what we see when we look into the airline sector is that it really comes down to those premium upgrades. And when people are searching 29% more year over year, 33% more year over year for Delta One or
What are you searching?
Delta Comfort, it tells us that the travelers that are getting onto Delta Airlines are the type of travelers that you want in this type of K-shaped economy. They're luxury focused, and they're ready to pay
Back at the 63 again.
which is what drives profits for these airlines. So Delta, a clear leader here in the airline space.
You know, Andy, the business plan of premium and international that Delta's doing, that United's doing, that seems to be the ticket. That seems to be the plan that's really working for these airlines. Profitability, more customers paying more money per seat, all those things. People are paying up for more legroom, all that. Southwest, is in its own little category, but they seem to be moving out of that category, at least trying. Some of the news headlines that they're trying to get first class and assign seats and do things like that. Is that, are they playing catch up?
I think we're going to know and get in here in another second.
Delta is a clear leader. United Airlines actually also seems to be doing well. American, which is similar
Another minute.
in terms of premium and international, but seems to lag. What is American missing that Delta has, that American has, that Southwest seems like they're trying to have?
Yeah, well, according to our data, what American lacks is follow-through and delivering on the promises that they make. When people book on Delta or they book on United and they upgrade, they enjoy the upgrades that they get. They don't feel like they just got squeezed by a corporation's algorithm that's just trying to maximize the dollars per seat, which is what you feel or what consumers feel according to Flyflow data when we're talking about American. And Southwest, on the other hand, for a long time, they did extraordinarily well by being the company that gets you from point A to point B with a very low fare, no extras, no add-ons, etc. The problem is the consumer has moved on from that and now demands a better experience, and especially in this type of economy, when we talk about the K-shaped economy and the luxury traveler, the luxury spender, the consumer with more money, they're willing to spend a lot more because they have a lot more money. And for Delta and United, they're doing a phenomenal job of capturing that wallet share and saying, if you're willing to pay more for a few more extras, we're willing to deliver, and they do a great job of delivering on that. Unlike American and Southwest doesn't even offer that option yet. But I'm excited that Southwest is going in that direction next month.
Very good.
I'll say this,
I am
Andy.
too.
I noticed over the holidays, full airports. The airport I flew into was Atlanta, which we know is Delta's hub there, and it was pretty, well-traveled, it looked like, over the holidays. And one of the things I want to go to is, your data about web visits and that being a predictive tool, especially as it relates to Delta. It makes sense because, everyone says when you're booking a plane ticket, it's a laptop activity, although you can do some things on the app now. Is there a point where that breaks down at all, or could we continue to see that pattern, especially now that we're out of that big holiday season?
Yeah, I think on a year-over-year perspective, Delta did very well, and United did very well, and Southwest and American have a lot of catching up to do. We're into a little bit of a lull type of season now, so it's a really good time for Southwest to be changing the way that they do things. I think February was a great point to roll this out because there's certainly going to be troubles. They're trying to change the entire DNA of the company, but I think that it's very clear we had a very good holiday travel season, and as we start to ramp up into the summer, it will be interesting to see how this mix changes and how these airlines start to really tap into these luxury consumers that are willing to pay more, because that is clearly the playbook that is winning and the playbook that Delta especially is executing on better than all others.
One more thing, Andy, before we let you go. Capacity. It seems like, I read a couple articles, two of them were talking about capacity, but they weren't talking about lower capacity in terms of Delta, but they were in terms of some of their competitors. Do you guys get any data, or are you reading anything about capacity? Because that has that counterintuitive reaction in the stock. Less capacity means higher prices and more profitability. When you think more capacity lowers the price per seat and hurts some of these. Do you have any comments or ideas or data about capacity? Delta seems to be holding, the rest of the industry seems to be coming down.
Yeah, one of the things that it clearly happened during COVID is these airlines figured out which routes they actually really need to fly and what customers will put up with in terms of, the timing of their point A to point B flying. And so I think that these airlines have gotten much more efficient at filling up pretty much every single plane and every single route that they're going to have. And if they aren't going to fill it up, and if it isn't going to be profitable, they try to find a way to eliminate that leg off their schedule. So when we look at the data from a Lightfolio perspective, there is some rumbling and mumbling and frustration about the lack of options that used to be there in terms of routes and timing. But when it comes down to it, people move their schedules around flights more than they pin their flights into their schedules. And once you've gone to that level of, I'm going to get there on Thursday, that's the main thing. Now I want the experience to be good, so I'm going to pay up for more labor. I'm going to pay for access to the club on my layover. All those things are what Delta's cashing in on and what Southwest is missing out on. And it really comes down to the experience is more important to today's flyer than the exact timing or the exact routing of the flight. And I think that the airlines have caught on to that. COVID's what sparked it, and they've executed brilliantly since that point.
All right, thank you, Andy, so much for your latest data. That's Andy Swan, co-founder of Lightfolio. Now, for the trading perspective on all things Delta, Kevin, we got a lot of insights from the Lightfolio team. Let's bring Joe back into the conversation here. Joe's got the example trade on this one. Kevin, do you want a quick final thought before we get to the example trade?
I think what Lightfolio's data really drove home was the fact that the premium and international, the companies doing that, and Delta was early into this business. United followed along, Americans trying to do that, and even Southwest is trying to do it now. That is the key going forward. That's the key customer that not only makes these companies, healthy, but it makes them incredibly profitable, Diane.
All right, Joe. All right, you heard the data they brought, and I'm sure you looked across this, you see all the analyst activity. What's your approach for an example trade?
Two things. Number one, I'm going to go to the charts and look at the nice little flag pattern that seems to be setting up and in the charts here. So you have this flagpole that basically goes all the way from 55 up to around 70. Before kind of pulling back, and if the breakout, which we kind of set up on Monday, is showing that there's the potential for this thing is potentially wrong now. That being said, there's a couple of different ways you can do this. So I just look at selling a put, a real basic strategy. If you want to own the shares around $70. I think when I queued it up initially, it was around $1.70. I think it's probably around $1.50 right now. Still, it's about a 2% yield over the next 1 week. It is just a 1 week put that takes into consideration earnings that are coming out next week. So the risk, of course, is always to the downside. You can get put the shares and the stock theoretically go to zero. But I would say with this one, there's potential for some missed movement to the upside. So if you're looking at this and say, hey, I like the idea of selling the put as a way to take shares, but what if, right? What if it continues to ramp up? You can add a call to this. You could do something like a combo where you sell the put and use that as a way to finance buying the call. But the way I have it structured right now is really simple. It's just a cash secured put. You're tying up at the 70 strike. You're tying up $7,000 minus the $1.70 or $107 that you collected. With for the potential, right, to buy those shares at $70 should it settle below there next Friday.
All right, thank you, Joe. That's the example trade there. We're going to stick with the airliners with breakdown coming up. We're taking a look at, we just did Delta, we're looking at United Airlines next. We've got more fast market after this break.
the Schwab Network. Tune in 24 hours a day, 7 days a week on SchwabNetwork.com
and on all your favorite streaming services.
Schwab Network, available anytime, anywhere, on any device for free.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Welcome back, Pat here on Schwab Network. I'm Dan King Hall live on Florida Big Board. Before we get into the breakdown, we'll give you a check on where markets stand as we get closer to the bottom of the lunch hour. Got mixed markets still right now. You got the S&P 500 higher, similar to the top of this hour, by about 0.25%, down lower by 0.25%. NASDAQ 100 still starting to show up by more than 0.5%. Russell 2000 lower by about 0.2% there. United Airlines on our radar today with a few analysts moving their price targets on this one. Among them, TD Cowen is raising its price target on United. So too, Citigroup is boosting it to 153. That's up from 132. It maintains a buy rating. It comes a year after some turbulence compared to the prior year. With that, time now for the breakdown. Joining us for perspective is George Sillis, Senior Markets Correspondent for the Fundamental Take on United Airlines. So last year did have a solid year for United Airlines, not as strong as 2024. I mean, it was, pretty close to the top of the leaderboard. You got all these analysts who are moving around their price targets today. How do you look at this one, George?
Well, I mean, first off, you look at the price action, it's hitting some new 52-week highs. So there's clearly a lot of price momentum moving to the upside. I think what's happening here with United specifically is they seem to be decoupling away from the low-cost carry model to the premium brand volume model. So if you look across the board, there are fewer options in the airline travel space. And with that said, they're creating cartel-like pricing behavior or pricing power where it's prohibitively expensive to fly in out here, and people complain all the time that it's very expensive, but you have to think about the benefits of that expense, and that's the airlines and the shareholders. That's what's really going on here. If you look at the capacity across the board, capacity is actually increasing at a decelerating rate, and that's causing prices to rise. And United is actually very clear that they're focusing on premium brand volume. So all the capacity that they're increasing, they're trying to increase price per seat. That's just manifesting in the better bottom lines. I mean, if you look at the sales numbers, at least going into 2026 from last year, we're coming off the back of 2025 as they're reporting out this month or the next couple months and quarter-wise. EPS growth is expected to be around 23%, only on about 7% sales growth. So what I see here is the industry, and United is part of this, the big player, is operating leverage. They're improving again the returns to the revenues, and that's going across the board, whether it's Delta, whether it's Southwest, which is improving, even American, despite the fact that American has some challenges with debt, they are improving their profitability, but that debt is really encumbering the balance sheet. And if you look at United, one of the things about it, it's got a pretty solid balance sheet, market cap $38 billion, they have $13 billion in cash. Now they do have debt, that debt is collateralized by the fleet, the debt around $31 billion, but the ratios relative to some struggling airlines out there like American are much healthier, and I think that speaks to why it's higher. And I think the analysts also see some continuation of trends for this name. TD, Cowen increased their target to 138. If you look at Citi, 153, and like I said, these profit metrics relative to sales, 2 to 3 times EBITDA to sales, that's great operating leverage. The risks are, you have to keep in mind that labor costs and fuel. Right now, fuel is very favorable. Labor costs seem to be more in line compared to historical averages. Profitability has increased. And seasonality last is very important here as well in the airline space. Generally speaking, if you go to Q4 of the previous year into the next month, which we're in, the January fact, these 4 months are really prominent for airlines in terms of price performance. So things are working out, but you have to keep in mind that fuel prices right now are low, and they certainly can change going forward.
Okay, George, quick thought. You mentioned especially that it seems like United's leaning into premium, and that seems to be why partly why analysts are boosting their price target. I wonder if it's going to kind of, based on the price action, if it will look more like 2024 versus 2025, including what you mentioned about fuel, because crude oil prices have been low.
So I think 2024 is a little bit of an anomaly in the sense that we were coming off some of the 5-year levels post-pandemic. So now I think what's happened is there's been consolidation in the industry space over these years. I've covered a lot of these airline stocks. They seem to have been increasing their operating levers. They're running at lower capacity, so the seats are booked. Prices have been rising, and they've been focusing on premium pricing as well. So when you essentially have a fixed fleet and you're increasing your prices, that's just bottom line. That's a trickle-down effect of the bottom line. So they're really capturing, as an industry group, the elasticity of demand, essentially. So they're increasing prices, and people are still paying because, again, the capacity isn't keeping up with the true travel demand. That may not necessarily be good for consumers, but it's great for the companies, and that's what's happening.
And it's prosperity for consumers. I've been one of those who has just simply just said, fine, here's my card. All right, thank you, George. That's George Sillis, Senior Markets Correspondent. All right, let's get Kevin back in here for the example trade. Kevin, you heard George breaking down this one and the airliners in general. What's the approach you're taking for the example trade?
Diane, there's a lot of good news about airlines, but a lot of it is already built into the stock. United sits just below its all-time high, which is traded in a very short time ago, up to 119.20. So what I looked at is a protection strategy. If you were thinking something in the protection, remember it's got earnings coming out January 20th. So what you can do in a paper money protection strategy is something like this: a put calendar that buys after the earnings report. I'm buying the Jan 30th 107 put, and then I'm selling the January 16th 107 put. So a downside protective put calendar that kind of brackets the earnings event, which would allow you to extend duration into the earnings event. I put it in for a debit of 165. It's trading about 135 right now as the stock has moved higher. So the protection you're buying is even less expensive than it was before. But again, this is a stock that has a big, strong rally that it's moved higher on, and this is a bearish strategy. It gives you about 8.5 to 9 short deltas. So this is one that certainly collects theta. It is long Vega, and oh, by the way, the implied volatility currently on United Airlines is at a 12%. So right around that 1/8, lower of implied volatility. So buying implied volatility, buying the Jan 30th, selling the January 16th, 107 put calendar with a chance to extend duration into the earnings event and really chip away at that debit, Diane.
Okay, so it's taking the earnings event into consideration for this approach on the example trade. What calendar is the approach Kevin is taking there? All right, you got it. That's our travel theme for today, it seems like. Thank you, Kevin, for that example approach. That's going to do it for us today on Fast Market. I'm Diane King, alongside my buddy Kevin Haynes. Our thanks to Joe Mazzola for stepping in today for Tom White. Download the Schwab Network app. It is available in the App Store. Tune in 24/7 on SchwabNetwork.com. Stick around. We've got Next Gen Investing with Jenny Warren and Alex Coffey coming up.
Schwab
Schwab Bank Investor Checking, the checking account built for investors, named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on the guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists. Streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Hey Bob.
Hey.
Last year, my dad had a stroke. Big shock to see this person that I've always seen as a force in our family be vulnerable.
Wait, had a stroke?
Yes. Now we're in the car together almost daily. I started to realize what can I pick up from my dad? He's been with Schwab for a long time.
Jim, my financial consultant, I programmed that 20 years ago.
Jim's really been there to answer any questions I ever have. Makes a huge difference when you have someone that actually cares.
Live insights, actionable data, and market-moving analysis. Schwab Network connects the headlines to the why in real time. Watch free 24/7 at SchwabNetwork.com.
Trading at Schwab is powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals, you can spend less time searching and more time learning. Trade brilliantly with Schwab.
Welcome to Next Gen Investing, and of course, happy Wednesday. I'm Jenny Horn alongside Alex Coffey, and as we check in on markets here, we are seeing some choppiness, a bit more of a mixed section that we started our show off in the last 2 days on a pretty bright spot, but still clinging on to at least, again, the NASDAQ up 0.6%, S&P's up about 0.2%, Dow lower by 0.4%, and pretty much actually right now perfectly matching the move to the downside in Russell, which is also down just shy of 0.4%. So again, we saw the Dow hit record highs yesterday, and S&P is also pretty much at these record highs, but seeing a bit more modest price activity today, which feels honestly refreshing. We've been really in a straight shot to the upside across our major averages, Alex, so today taking a bit more of a breather.
Yeah, this is a weaker session, but the strength is in the right place. As you look at the four sectors that are higher on the day, discretionary, healthcare, communication services, and IT, you'd argue four of those or those four are in the top five most important. Maybe you throw financials in there to round out the top five. Financials are giving back. over 1% today as the bank stocks are under a little bit of pressure, but they've been carrying their weight for the better part of the last month and a half. It's really been the Magnificent Seven that's been the drag. Well, not today. Magnificent Seven up about 1.1% if you were to index the group. And if we get big mega cap tech leadership like you're getting today, you don't need a broad market rally. We've proven that for the better part of the last 3 years. And so, yeah, less than 30% of the names are higher today, less than half the NASDAQ names are higher, but there's strength in just enough of the right spots that it's offsetting.
Yeah, and that's actually interesting because it's been kind of the inverse of what we've seen in the last several sessions, where we've seen actually really nice days, but without the full participation of that Mag 7, as NVIDIA has been fairly choppy. We've seen some more muted reactions to some of the commentary we've gotten out of CES 2026 so far, so we'll be parsing through some of the still feedback we're getting from the street, as well as just the price performance in regards to some of these major developments into the world of AI, which is pretty much always our focus on this show. So I definitely think CES is the driving force, but today actually driving a bit more optimism than what we've seen hold in the Mag 7 in the last couple days.
One thing that we talked about in market on close, and I think it was Monday afternoon, but I think it's an important discussion, is as the market makes new all-time highs, as implied volatility comes down, and then throw in there they're on the verge of going into an earnings season as well, what you'll start to see is that the movement between the average stock and the S&P 500, so what maybe NVIDIA does on a regular day versus what Apple does, the actual movement of the stocks might start to increase. But the index itself is sort of locked in place. And the reason being is there's a lot of reasons for kind of that stock picker dynamic to happen, but also reasons for, okay, for example, we'll have earnings of the banks kick off things at some point. There are things that are the same about the banks, but there are things that are different. And so what JP Morgan Chase does might be different than what Goldman Sachs does. But say JP Morgan Chase goes up a lot and then Goldman goes down a lot, the impact to the S&P 500 is probably minimal in that case, but of course there was a lot of movement that happened. So this is a long-winded way of saying we're starting to see dispersion pick up, and so there's still opportunity, there's still action, but if you only look at the S&P 500 quote or the Dow Jones at the end of the day, you're not going to see that.
Yeah, that's also a good point. I think a good distinction of right now, the way markets are shaping. I mean, for so long, this has been the driving force of the upside. We're finding upside in other pockets, yes, which I think is the healthy rotation that keeps being discussed. So we'll focus on actually some of those individual movers throughout the next hour. We'll kick things off with a food focus on top of our show today, as well as then diving into some charts and trades of D.R. Horton and Lennar, with some mixed analyst commentary today on these home builders, two of our largest home builders actually. And then for FOMO today, we'll discuss the outside move we're seeing to the upside today in Intel. Again, heavily tied to some of the commentary we're getting out of CES 2026. We'll also discuss the potential Eli Lilly acquisition and the way that is right now transforming the pipeline actually outside of GLP-1s, as well as the broader discussion where we touch on NVIDIA, CES, still the dominant conversation, and close things out here under 30, which we'll be discussing American Airlines. So wide variety of equity focus today, which is important. There's finally starting to be news in some of these individual names that is not so much heavily tied to the, say, broader macro or geopolitical situation.
Yeah, and it's news that I think if you're a company, a lot of times, or whether it's analyst upgrades and stuff like that, but like the actual news that the companies are putting out, whether it's guidance updates or announcements, like there are things that they want to be read because people are back at work now, they're back in the computers. It's almost like in that holiday time frame, it's like try to get the news out there that you wouldn't mind just being overlooked, where people aren't going to be paying as much attention. So it's not the Friday afternoon news drops now. We're back in the thick of things here as we are in the middle parts of this first full week of the year. Let's talk Starbucks though as our first mover of the session. Price target hike at Barclays. Again, we're still in that kind of moment, I think, within these analysts where people are that cover these different stocks are getting their ducks in a row for the year, making sure all their coverages are up to date.
Yeah, actually today Starbucks is seeing a pretty substantial move to the downside. We're down now over 3%, and I mean, despite the fact that this analyst coverage was pretty optimistic, all things considered. So we did see Barclays with an updated price target on Starbucks shares to $110 from $95 a share. Now, they did also say that they believe sales challenges will persist with the restaurant sector, and this was part of a broader note, but then more specifically saying that they did maintain this overweight rating, yes, and that they're just perhaps right now adjusting some of their coverage, as you did point out, on the broader restaurant space. But of course, Starbucks has been challenged. I mean, we're still looking at a loss of almost 7% over now the last 12 months or so. The average rating is still overweight. They do have a mean price target of roughly $95 a share, so that would imply, obviously, some optimism from where we're currently trading just below $86 a share, $87 a share, excuse me. But a name that has still been able to contract about 26% from its highs made now a little over a year ago, while also still remaining off of lows by almost 15%. Starbucks has been stuck fairly range-bound recently, and right now trading just slightly above its 250-day moving average, but it's been just this choppiness in a recent trend right around 86. So we're hoping for some upside, and I will say that at least encouraging that they see some optimism as far as just price performance over now the next 12 months.
Yeah, I think it's important to note too that this stock is from a scale standpoint incredible, right? But from a position in a portfolio, I do think there are question marks as to where would this fit. I think it's really hard to make the case that it's a value stock with the decrease in earnings that you've seen over the last couple of years through the struggles. You've actually watched the multiple climb out of 35 times forward earnings. Well, this is not a company that's growing in the same stratosphere as a company like NVIDIA, which for the longest time throughout its move has traded like 40 times earnings. So that's the kind of name that you're comparing it to. Starbucks may ultimately benefit from some of these technological breakthroughs and the scale that it has. And so, in some ways, is a big part of where the future is going with AI and robotics and everything. But it's not creating it. And so I look at this and say, I think it just found itself in a tough spot. It's not really a value stock by any stretch, but it's certainly not a growth stock either, but it's priced like one.
That is very true, and Starbucks has a lot riding on, of course, the new leadership. I know that's not a new narrative, but it's also been a bit more of a focus of how they continue to reinvent themselves. And frankly, a very crowded space. We know that the coffee consumers are loyal, yes, but many do trade down for some of these vices. I know that there's also the thinking that you don't trade down for your vices. I definitely don't, but Starbucks would be, as a non-coffee drinker, one of the first things I would probably likely be cutting out. But our next name today, McDonald's, which is part of this broader note we did get out of Oppenheimer, with some varying opinions on the restaurant world. So they did actually upgrade McDonald's shares to outperform from perform, $355 price target. They are more bullish on the restaurant sector though heading into this new year, given 2025's underperformance. So the top picks they stated were Chipotle, Domino's Pizza, as well as McDonald's. McDonald's shares, though, they highlighted, have long been stuck in this $300 trading range, do offer a golden opportunity for a breakout. They also believe the company's steps to reposition their value perception and create an innovation pipeline enables a pretty powerful setup, and they expect this revitalized earnings growth now into 2026 and 2027 after 2 years of disappointments. I always think McDonald's is kind of an outlier in the restaurant space because, frankly, it's just as much like a real estate play as it is right now just a true restaurant play, given the sizable exposure that the franchises now have to just, again, real estate. I think that the inner workings that are complicated, yes, but at least we can acknowledge a move to the upside, and this was one of their more optimistic picks amongst the restaurant stocks as they took on a different tone than what we heard from BMO that gave that note on a lot of these fast casual names yesterday.
Yeah, I think McDonald's, alongside many of the traditional quick service restaurants, finally found that line where it was like, okay, you can't raise prices anymore. Mm-hmm. You kind of lost the plot when it comes to the role you fill within, the restaurant space. If I'm going to be spending $20 for a meal, maybe if I have the time, I'd prefer a fast, convenient place, maybe a Chipotle. But even those, $20 a meal, that's where we've had these names like Chili's sort of step in, or the Apple, like the traditional restaurant that can offer a little bit more of an elevated experience for not that much more in terms of price point. So we know that there was a big focus on sort of getting back to the value roots for many of these names last year. And we'll see if they can continue. But I love to call out from the analysts around 300 almost being like a magnet. We'll see if it can break out meaningfully from that level, because of almost any trade over the last 2.5+ years, kind of fading McDonald's when it gets away from 300. So when it gets in that 320 range, it's been a really, really reliable short name. And then any movement below 300, particularly when it had a test down near 250 two times late in 23, and then of course the middle parts of 24, ultimately really, really strong buying opportunities. It's found its way back to this 300 line so many times.
I know, and that's the thing I will say about McDonald's is I know that it operates in a difficult world, especially right now with pricing concerns. I mean, we were even hearing from their management that they had items like, their various, the McDoubles, for example, were up like 150% in price over the last 5 years, which when you're working with an item that costs, relatively a low price, obviously the price increases are all, percentages is all relative, but still, it was definitely, I think, going away from that traditional, cheap, quick, easy type of model that it for so long honed in on.
Last thing on this too, I think it's important to note, this is a company, unlike Starbucks, which even though it has, a mid-20s forward valuation, it does, assuming it would continue to do so, which we don't have reason to believe it wouldn't, pays like $7.50 a share annually in dividends. So this is one of those names where it maybe finds its way into income-like portfolios as well as being sort of a value play given its consistency as a staple over the years. So different type of portfolio construction, but certainly one to give attention if you are looking for those kind of assets.
Absolutely. And our next thing today is part of this broader note that we're seeing out of Yum Brands with Oppenheimer also now downgrading Yum Brands to perform from outperform. No price target though following the stock's outperformance, they said, in 2025. And so after a 13% advance in the top large cap picks for 2025, they do view Yum's risk and reward as more fairly balanced. They did say that they endorsed a Pizza Hut sale or separation, which we did get reports of about a month or two ago at this point, that earnings dilution implies a healthy pro forma valuation and supports a more neutral stance. So by no means taking on a pessimistic view, just giving the argument that right now things just fairly balanced again, given the outperformance. And outperformance is all relative. Outperformance to the general discretionary and restaurant names, of course, not an outperformer relative to say like the tech trade, but still, I do think it a healthy thing to acknowledge that perhaps things just look more relatively value neutral at this point going forward.
Yeah, I think a lot of the same things that we just said for McDonald's and to a lesser extent Starbucks apply here. Interesting company, interesting portfolio of brands, but not a lot that's different than really McDonald's, other than maybe, where do you rank Taco Bell versus McDonald's, but that's going to be, individually. But yeah, one to watch for sure. Similar, again, strategies would include both. Where things get interesting, though, we've had these conversations, several times over the network with different guests. Alcohol consumption, and has that maybe peaked, and is it on a little bit of an alarming trajectory if you're investing in these type of firms? Constellation Brands and its performance maybe suggests yes.
Yeah, I mean, shares of Constellation Brands tumbled 38% last year. So whether the stock will see a rebound this year will depend on the spending power of hugely one of their biggest demographics, which is the Hispanic consumer. And so the street is expecting, earnings to contract 19% from last year. Sales are expected to fall about 12% from a year ago. But alcohol makers have had a really hard time as economic concerns have led to fewer group gatherings as well as fewer convenience store trips. Across beer, wine, spirits, and overall just producers, they're feeling the pinch as consumers drink less, squeezed by these higher prices, and this increasingly habit of being more health conscious, as well as rolling menus to find these alternate ways to unwind and socialize that maybe don't include consuming alcohol. So we saw that beer sales fall 7% a year ago from the quarter that ran through August. The slowdown, they did say, was largely due to the softer spending from Hispanic consumers who do account for roughly half of Constellation's beer consumer base and have shown signs of unease amid, again, changing immigration policies, but also just higher prices in general. Their wine and spirits business has been struggling up even more, as they did sell some of their mainstream wine brands to focus more on the higher-end brands with these richer margins. But those divestitures did shrink their top line by about 65% year over year, and again through the August quarter. So they have a lot of right now a test to face as far as their earnings event after the close today. And unfortunately for them, or maybe fortunately, they're one of the only names that has earnings really left still to report, so there will be, I think, an added focus that typically wouldn't be for Constellation because there are only earnings to really discuss.
Yeah, it's like a preseason game when it comes to earnings. We'll get them in earnest, I believe, kicking off late next week when it comes to some of the financial names that really, I think, set up week one of earnings, and then we go from there. But Wells Fargo is the price target. They have an overweight rating, but so many of the answers we're going to get from the company this afternoon. So I'll leave it at that. I do think the pressure of less alcohol consumption amongst Americans and worldwide is an alarming one for these companies, and I don't know what you can say if you're Constellation other than investments and other aspects of your portfolio to stave that off.
Yeah, and you're right. It's something that's being wide felt. I mean, you look at the charts of like Molson Coors, Anheuser-Busch, Sam Adams. They all tell the same story, and it's really rare to find these exceptions to that rule because, again, just mass consumption is facing overall declines as far as volume.
Well, and it's also like, there's marketing and there's commercials for these type of things, but it's a dicey situation because you can't really be like excited and encourage more consumption of alcohol. So it's a tough area to be. You quietly want the if you're one of these companies, you want the consumption to either grow or stay the same, but there's not like you can do publicly to like champion more of it.
Yeah, that is true. You're right. It's something that's like the hard economy of like, pushing for more alcohol consumption, but it's really not a bad thing that we're seeing this demand from younger generations, like more alternative drinks to.
I don't think it's just younger generations anymore either.
I agree. I think it's been something why I think it's blamed on, unfortunately, like the millennials, the Gen Zers, but I cannot say that it's necessarily specific to one cohort now because it feels pretty widespread as far as like the global consumption trends we've seen. So we'll leave it there for the top of our show today. Coming up next, though, we'll discuss another area of the market that has a lot of questions to face in the coming year, and that is the home builders. We'll be diving into the charts of D.R. Ford, our largest home builder by market cap, as well as Lennar, both with some downgrades today at Citizens.
To what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I see something from Schwab.
Uh-oh.
Yeah, Schwab lets you invest in trade and roam.
And if you want, they can even manage it for you.
Not to mention Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties. Carl.
Schwab, a modern approach to wealth management.
Whether you're a bull or a bear, you want to catch the latest market action on Morning Movers with me, Diane King Hall, live from the floor of the New York Stock Exchange, only on Schwab Network.
Welcome back to Next Gen Investing. It's now time to dive into the charts. And of course, our chart master, Rick Ducat, on two of our largest home builders, at least by market cap, D.R. Ford as well as Lennar. And following some really interesting news that we are getting reports from the White House and the Trump administration, who says that they're attempting to ban the U.S. from right now these large investors buying homes. So hopefully it helps the ongoing problem of right now supply, which they're just facing such a supply the light time in the overall home building space, but also we have seen this deferral mindset of waiting to buy homes until prices come down. So hopefully that environment is a bit easier for that in the coming year. But walk us through some of the pain that has been felt by these home builders across the board here, Rick.
Right, interesting too, because even despite mortgage rates going down, the applications were also down as well at this time. So it's a difficult environment, especially for first-time home buyers, as you say here. But this particular chart, most of the price activity can fit within the boundaries of this downward sloping channel type shape. We did have a bit of a breakout here to the upside, but for the most part, closing prices stayed within that area here. And you could extrapolate that, put it across the lows to give you this channel. And remember, this isn't like gospel truth of price activity. This is general trends we're trying to establish here and general boundaries to be on the lookout for in case of a potential breakout. So our horizontal levels that we're looking at today, 167 was a high point that we saw after our gap to the downside. Didn't quite make it there once again during our most recent rally here. Things have kind of fizzled since we had this low point here that we had. Our two green lines are supportive areas here, 141 and 136. If you were to backtrack a little bit, you can see these were areas that came into prominence several times here during the past year. So we can also see that we did break below this 141 level today. We're on pace to close below that point. Intraday lows were significantly beyond it here. But there's still some time left in this trading day here. We could see a bounce and a pullback here. So this area near 141 will be pretty interesting to watch as we continue during this trading week. So our moving averages suggest that the trend is more geared toward the downside. The faster ones are diverging from the slower ones, trending downward here. Prices on pace to close below even our fastest 5-day weekly EMA. So we can see that we're not seeing any signs of trend reversal toward the upside here. In fact, more of a sign of acceleration to the downside. That's interesting because we also saw a bit of a divergence here, bullish divergence in the RSI that did not really play out here as the bulls might have hoped. In this case, our green trend line was broken very shortly after our longer-term red trend line. Our downward trend line was broken here. Now we're on pace for a new closing low today. So certainly another example, these things are not crystal balls, as I'm saying before too, that these are just pieces of information you can use to inform your decisions. It's always best to kind of take them into account with other factors, indicators, price activity, etc. Our volume nodes here, and here come in at about 145, 154, 155 or so, and about 170. So those are the important trading areas. If we were to keep moving to the downside too, there's another smaller one here, but at around 137 or so, 136, that general point too would be another area to watch.
Yeah, and a lot, I would say, to hopefully be enthusiastic about at least going forward, because this has not been a name of strength, and I know we're down another 2.8% today, but a lot of room to recover if you're of that thinking that we'll see a recovery in the broader home building world. So all that to be said, as we do think through now trading, DR for example purposes, this is the largest home builder, so it does command to me the most significance because it has the greatest read on just like scale. But all that to be said, as we think through trading the same, how do you think about DR?
Yeah, not to say the obvious, but difficult market conditions, I believe, for many of these different home builders and real estate, worldwide, but really here in the U.S. So it's a bearish look. I don't think anything that Rick went through from a technical standpoint really excited, traders that are watching. So a couple notes, they do have earnings in about 2 weeks, so they're trying to stay ahead of that with next week's expiration. Bearish put vertical spread, so buying the debit spread, looking at the 146, 141 put vertical Jan 16, 250 debit, which means $5 wide spread. Spending 250 means equal risk to reward. Risk 250, chance to make 250 with a 143.5 break even. You simply find that by subtracting the debit from the long strike. In this case, that's 146. Net of 250 leaves 143.5. So you'll need some help in the market, not a ton, and you're looking at a move lower over the next week and a half into next Friday.
Which would be following just, unfortunately, the same trend that we've seen. Now, for Lennar, a lot of the same price activity, a lot of the same commentary, frankly, that is playing to the same, where we're seeing, again, a deferral mindset, consumers waiting, and I think that hopefully, with this trend of mortgages and continuing mortgage rates continuing to fall, Hopefully it leads to some meaningful trend improvement, but as far as what you're watching for Lennar here, Rick, set us up.
Yeah, so this is all the home builders, the major ones all put together. Lennar, unfortunately, at the bottom of the pack here, minus 21%. But kind of what I wanted to point out is that it's been a rough time for all of them. Sharp drop-offs here as we headed into the last month of 2025 here, and things that don't seem to be improving in the more recent term. But to look more specifically at Lennar now, again, kind of the broader general shape you could encompass between these two wider set apart blue channel lines here. Those were kind of the extreme price boundaries here. But then we had this very sharp, shorter term trend line in purple here that encompassed our earnings move here to the downside. So our green line, 103, is important here. That's the standout level. That was our worst close, or rather our first worst close. We closed marginally lower just recently there, but recently after that. But 103, that general level, is where price held the line several more times, and that's again where we seem to be getting a bounce now. But today it looks a bit less promising here so far. Now we can see that our red trend candle today almost on pace for a bearish engulfing type candle. If we were to close near those lows, that would be the result. So an interesting thing to consider, especially if we do move once again to test that supported area near 103. When we look at our moving averages, today we are closing below, or on pace to close below our blue weekly 5-day EMA there. That comes in near 105. So that would be another important area to watch into the close. The shorter term moving averages, the shorter term they are, the quicker they are to respond to potential trend changes, but the less reliable they are. So something just to keep in mind as well. RSI has managed to get out of the oversold area here, so that's more of a positive sign for the bulls here, but beware of another drop off here below that point here, moving to the oversold area in the trending market. Typically is regarded as a sign of further weakness to come. The volume areas that stand out here that are closest to current price, there's a small node right here near 105 that really sticks out, this sharp spike in the trading activity. Kind of suggests that once again that's the last stand, the last line in the sand before potential further downside here. 110, also another heavy area, and then 115 and 121 to the upside.
And Lennar today, not seeing the same extent of weakness as DR Horn, but also still out another 2%. So not exactly the bright spot the bulls were hoping for, but also today's citizens did give a more downbeat tone on a lot of these home builders. So appreciate that, Rick D. Pat, for always helping us with the tactical setup. And now, last but not least, as we do think through trading Lennar for example purposes, Alex, walk us through your thinking.
Yeah, similar directional bias with a little bit more of a bearish tilt here, but a little bit longer till the next earnings date. So going out to the end of the month in this case and slightly altering the strategy, looking at a put calendar spread as opposed to a put vertical spread. With this though, 100 being the strike, selling the Jan 23, buying the Jan 30 strikes. Centering again that 100 put strike, looking for a 50-cent debit. If you're able to do that there, that would mean a max loss of $50. You can see the steep nature of this particular risk profile as it's more profitable, or has the more potential to be profitable, the more closely you're able to accurately project where a stock goes. So precision almost more important than anything, so you would need downside, but you also want that downside to go to a particular place, and in this case that's $100.
Yeah, and in this same, no major catalysts in the coming weeks and months. I will be curious to know if banks give any indication that we could see a firming up the credit environment, although frankly that has not been really a catalyst to the upside for a lot of these homeowners that have just seen continual pressure, at least as far as price performance. We'll leave it there though for Chartmaster today. Coming up next, it's time to talk a big winner of the session, and that is Intel. Intel shares surged as much as 9%. We've sentiment back from that strength, still up 6.5% following some continual strength in regards to their CES commentary.
For instant reactions, earnings breakdowns, and hot takes that teach you about stocks and markets, follow me on X at NPetalides and connect with me, Nicole Petalides, on LinkedIn, Facebook, and Instagram.
Trading at Schwab is powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Live from Chicago, this is Trading 360. I'm Marley Caden. We track macro forces, market trends, and company news that shape investor decisions, all with expert analysis and actionable context. From inflation data to sector rotations, earnings to policy, it's a comprehensive view of the market every trading day. Trading 360, in-depth market coverage straight from Chicago. Weekdays at 11 a.m. Eastern on Schwab Network.
Stay connected to what moves markets. Download the Schwab Network app and get live coverage wherever you are.
Hey, Dad.
I have a question for you.
Sure.
When did Granddad first start investing?
Granddad had an account with Schwab before there were branches in the area. We really started with nothing. He worked hard, and after he passed away, the torch has been passed to me, and my advisor, Jennifer, she was with me with the journey, helping with the estate distribution. The two grandchildren planning for their college educations. Someday it'll be their turn.
Welcome back to Next Gen Investing. It's now time for FOMO. Today we're talking Intel, which is having a really nice session this morning. We've pared back some of that strength, but still definitely a leader throughout our tech trade. Joining us first is Marley Caden, host of the Schwab Network, in studio with us. And so, Marley, not really any specific news driving this upside. And I know that, again, we've given back some of that strength, but still, another really nice session here for Intel.
It's really CES related, and you mentioned that we saw a pretty sharp swing. We were up almost 9% for Intel first, then we pared some of that back. Now we're trading up about 6.6% higher, so still a really good move to the upside for Intel. And it's just coming out of CES. They're unveiling on stage that they have their consumer laptops, which are featuring this Panther Lake processor at CES. They also announced that they are going to begin orders for those January 6th. So that was, they've already begun them. In fact, I don't know why they would have released that date as being yesterday, but they're now available, globally available January 27th. Now, this is the first time that they're using this 18A process technology that has been under a lot of discussion as the foundry business is looked at. The company describes it as, quote, the most advanced semiconductor process ever developed and manufactured in the United States. So that also felt a bit pointed, kind of like the commentary from Lisa Su when she was on stage speaking at AMD. Everything feels a little bit like shots fired at CES, and that's another one of those comments. These particular laptops will have the Intel Core Ultra Series 3, which is the first line of this Panther Lake series. They say it'll deliver significant performance improvements, particularly for AI applications. Going forward, the industry and Intel are both at a strategic inflection point in 2026, and they call AI a huge opportunity. They say it will power more than 200 PC designs with global partners. Their top models feature up to 16 CPU cores, deliver up to 60% better multi-thread performance, over 77% faster gaming performance, which is very important to a lot of people that use these, and up to 27 hours of battery life compared to previous generations. So pretty marked improvements there overall. Important to note, Intel has wrestled with its yield for this Panther Lake series. And when I say yield, they're talking about the share of good chips that are produced from each silicone wafer. They've had some struggles with this product line, but executives addressed that at CES, saying that the yields are improving month by month. That's coming from Reuters. They spoke directly to them. They also announced plans to launch a platform for handheld video game devices later this year. And for the first time, they're extending their Series 3 processors to embed in industrial applications, which includes robotics, smart cities, automation, and healthcare. So some other major potential revenue drivers, but obviously the performance of these laptop products, and once rolled out, this gaming platform, could be essential and crucial to Intel's turnaround plan, because despite their really strong performance in 25, they were up like 84%.
they are still amid Louboutin's turnaround, and they're certainly not near the end of it.
This is another example of what we stressed, which is the story aspect of stocks. Nothing really changed, but there's something that's being believed in now in Intel. But not everyone's a believer. I don't know if you saw the JP Morgan comments, but JP Morgan essentially saying, hey, they talk big, they got these big plans, but you're going to have to see it happen a few times before major companies like NVIDIA are going to really take the risk to switch from a TSMC to an Intel. So look, they did a lot of, it sounds like, Marley, kind of damage to their brand, particularly around reliability and ability to actually execute on these plans. They can talk about the plans, they're pretty good now, but they have to actually do them.
Yeah, I saw that note too. They said, the Taiwan 70 is where they think looks pretty hard to shake. That's how JP Morgan phrased it. And they flagged that uncertainty, these old doubts. This rally is running up against those old doubts because of the erosion of some of their brand and their consistency. So I think they are going to do it. This is a really, we talk about it in AI a lot, but this is a shut up and show up moment for Intel because they have to prove that they can do it if they want some of these big outside customers. But I will note, Melia's research did come in with an upbeat call for their foundry story, which I think is a big deal for them because foundry has been one of the major focuses of a lot of this caution and concern. Melia's upgraded Intel to buy from hold. They set a $50 price target. Right now we're at $42.80, saying, quote, we really like CEO Louboutin, and they pointed to improving prospects for its contract making business. But like you said, they are still running into these doubts, and until there is some proof in the pudding, for lack of a better term, I think there will still be naysayers on the other side until they have something concrete they can hold on to.
Yeah, and that's not even specific for Intel. I think that's a lot of right now what we're seeing with some of the weakness, like yesterday, AMD tanking without really any news, because I think that we're tired of hearing, these unveiling of products, this pipeline of innovation. Well, you have to be able to prove you can monetize that, and that's where Intel, unfortunately, for years now, has struggled to on that execution leg. But at least in new leadership, we're seeing from Louboutin that he continues to be, a very busy man, so I commend him for that. And so as we think through now trading Intel for, again, example purposes, a difficult one because we've been in sort of a un-Intel-like price performance span for quite some time. But considering that, recent trends we're seeing, how do you think through the same?
Yeah, so many really successful investors start with the story or the belief or the fundamentals, and they looked at things like the chart and the technicals to confirm that their thinking's on the right track. Certainly the technical picture, the charting picture has improved dramatically for Intel over the last year. And so say you think more of the same, maybe neutral to bullish for this stock, I looked at a neutral bullish short put vertical for this example trade, 41.38, February 20th expiration, looking to collect $1. So $3 wide spread, collect $1, creates a 2-to-1 risk reward. And so with that, guys, the break even would be 40. You can make $100 and you risk 200. We know the risk profile, it's that elongated Z shape, where if it stays above the short strike, you're in the max profit zone, works its way to break even, then of course your risk below the long strike is where things are capped. So max loss 200 again, max loss, or max gain rather is 100, break even 40 for this example.
Intel, and not really doing a lot to erase that 6.5% move. We'll have to see where we close here because I'm following this one all today, and we've given back that 9.5% climb we saw this morning, but still 6.5% move on no specific real news is definitely a win. So we'll leave it there for FOMO. Appreciate it to Marley Caden, host of the Schwab Network. And coming up next, we'll continue our broader CES discussion focused on two of really Intel's key rivals. And rivals is maybe a stretch, but NVIDIA, AMD, some of the commentary and takeaways we've already heard from those companies, and of course, this major event that's occurring this week.
comes to investing, you'll love Carl's Way. Take a left here, please.
But there's a...
Carl's Way is the best way.
Is it? At Schwab, how I choose to invest is up to me.
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me too.
Let's move on, shall we?
No can do.
I'll get out there.
Where are you going?
Schwab.
Schwab, a modern approach to wealth management. Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
Morning Movers brings traders the biggest headlines to start the day, from volatile overnight swings to
Schwab.
the earliest analyst calls. Get your watch list ready. 8 a.m. East.
Oh, God, shut up. Prime Washboardjim. We just now hit the 200 EMA. Randy, was I talking to my sleep? I actually felt like that was a real heavy one. Real heavy. I said, well, that don't seem right. Right now you're at resistance. That's where you are. If we break the 200 EMA, we'll go near and far. I've never heard anybody sing so good in my entire life. I need to invite my music teacher over. Ms. Johnson, you ought to listen to this guy singing day trading stocks. I think there could be a movie made out of this. The first musical by Elvis Presley. Wall Street Winners, James Howard. Okay, here we go. Nvidia dropping. Is that a new low? No. Thank God, I was going to have a panic attack. There's Randy's favorite stock, AMD. Is he still alive? Well, that was a pretty good nap. That's what you are.
And basically presented their forecast and future for the next year. NVIDIA specifically coming out and revealing the Rubin series that they're going to come out with, the new GPU chip. And really, I think it's two different stories here. NVIDIA has basically come to the table and said, look, we're still a dominant player. Like, we are still king overall. I know everybody's talking about Google, people are maybe talking about AMD. No, we're still top dog in the category, and we're going to make sure that we define it that way.
Oh, you think so?
A little bit of a different story. I don't know. The market hasn't loved the approach maybe that they just say, look, everybody's going to need AI. Every possible thing is going to need our chips. and there's a lot of demand out there, and they basically just scattershot it across all the different industries that are going to need AI technology. I think NVIDIA has come out, obviously from the price action over the last 2 days, has come out as the winner compared to AMD. But there's still the big questions in the market of, is this AI a bubble? Is there, too much pressure on the valuations of these companies? And really figuring out, are they truly worth what we've been willing to pay as investors for these different businesses?
Okay, so along those lines then, Logan, let's skip to the final step. You're in a meeting with the client, they're asking you, or maybe throughout the last couple of years, they've talked to you about the importance of needing to be involved in these big winners, the NVIDIAs. They got a friend down the street who's made millions on these things. Is it still that discussion, or as things have broadened down? Obviously, Oracle last year had a big year despite giving back a lot of that. Palantir has been a big winner. We've seen other Magnificent Seven names, Broadcom, you mentioned AMD, we just talked Intel in the last segment. What I'm trying to say is there's more names now than just NVIDIA. How are your clients and the discussions you're having with those clients approaching the market now? Is there still a desire to be super concentrated in these big AI chip winners, or are there more choices now for them?
Yeah, I think there's more choices, but I think at the same time we're cautioning people right now that people that maybe have not had a lot of risk in their portfolios and are now really wanting to be in these AI plays, whether it's NVIDIA or some of the other names you mentioned, but we're kind of putting a little bit of a pause on that. Even the companies that have had a nice run in the recent memory, just like you mentioned, Intel having a good week this week. So we have to temper some of those expectations, because I think particularly like the hard chip sector of semiconductors that has ran the market for the last few years, in our opinion, is overvalued in a lot of ways. The market is really pricing in complete perfection across the board. I think that's one of the reasons AMD got hit on this. The market is looking for perfect execution for these names. And we, just like some of the other areas, not only the broadening out into other technology names, but broadening out into some of the names that have been completely out of favor, like blue chip stocks or dividend names. As interest rates are coming down, I think those are becoming more attractive. Even energy, despite what's going on in Venezuela, there's other good opportunities out there that aren't necessarily this chip space. Although I think it's fascinating to see the dynamics between the other, AMD versus NVIDIA versus Google. I think you got to temper some of those expectations with clients and let them know, hey, it might be a good time to be backing off of some of these names, reducing the risk exposure, and looking at some opportunities that haven't had the love that the AI companies have had over the last couple of years.
Okay, well, you took the question right out of my mouth. That's exactly what I was going to say, but I am curious your thoughts on strategizing, given the ancillary area plays, like right now what we're seeing with metals or energy, or just completely taking on the approach of shifting away from some of these high growth names into those more value-oriented names. Is that sort of what you're saying, or do you still find the balance of both, given the fact that there's a ton of names, obviously, to find value in right now in this market, especially as we set up a new year?
Yeah, absolutely. There's other areas that are associated with AI, but maybe not be the AI pickaxes, for instance, that a lot of people are calling the NVIDIA chips. And I think there's several areas, but I like the software side of things. So
pickaxes,
like a Snowflake that has had a decent run, but has had some volatility as well. That is a software type company that is utilizing AI to actually make businesses money, because the chips are all great, but we have to see how that translates over to actual businesses and how it's increasing productivity or increasing revenues overall. So I like the software area, also energy. There's a lot of different places that you could play this. Obviously, some of the nuclear names have had tremendous runs over the last couple of years, and you might want to wait for continued pullbacks in those, although they are off highs significantly. But I think you can look at the overall oil sector that hasn't really moved hardly at all, and look at names in that area. Again, despite Venezuela, I think there's still a strong play to be had there for AI names, because the energy demand that's going to come from this over time, as you hear the AMD CEO coming up and saying how big this is going to expand to, there's going to be really strong energy demands, and I think that's one way to play it.
Okay, so final question then, how do you see this sort of unfolding then? Maybe we're moving away from the infrastructure, the build-out kind of ideas in our mind. Are we now thinking about companies that actually can benefit from this? Maybe some of the financial names that can maybe find some cost savings, efficiencies? Is that where you're at in your thinking?
Yeah, I love it. I think that's exactly right. And it's diving into these earnings reports as we're entering 2026 to see what are the financial companies that are utilizing AI, what are some of the industrial names or some of the stodgy consumer staples that haven't utilized technology to a degree that we've been expecting, but are they starting to implement AI, and is it truly translating to something? I mean, I've said this before on the show, but my water company implemented an AI type user face.
SPX at the Orb.
But there might be some opportunities out there for some of these companies that are now integrating the chips into their day-to-day workflow, which could increase productivity and find some real opportunities in these stocks that haven't got the love that the NVIDIAs and the AMDs of the world have.
I know, I love that. You see the
You know, I'm tired of listening to you.
My apartment building also is.
Let me see your portfolio, big guy. I bet you I've heard the same story over and over for the last 6 years. Or longer, maybe. Oh. Little boom. Jimmy gets up from his nap and we bounce off the VWAP. Yes, we did. George, help me.
It's really operational-wise, America is not too far off when it comes down to things like pricing power, gross margins, than the other carriers. The challenge really is the debt load, which is about $38 billion relative to essentially $10 billion in market cap. It's about 3.8 to 1. Where you look at United, they've got less than 1 times equity of debt. And Delta seems to be more favorable in that regard as well, with lower debt levels. And so that can be a constraint to net income for shareholders, and that's really what we're seeing here with American. It's been underperforming the other names, but not necessarily a bad name. It's just the reason why. That's what I'm trying to explain is that balance sheet still seems to be sort of a ball and chain that they can't get rid of right now.
For businesses that have so many things go perfectly, it seems, for them to be successful, given the recent, what's called instability and tension geopolitically, particularly in South America, I imagine a pretty peak time to be traveling into some of that region. International travel is important for American Airlines and United Airlines and Delta. Do we think there's going to be an impact from this, or too early to tell?
Well, I think it's too early to tell. And again, there was obviously some airspace shut down over it as well initially over the past week. I'm not sure how that's manifested as of late. There may be a suggested impact when these companies report coming up. I think that's something to be mindful of. I think overall, if you look at what's happened in this group since 2024 is they've actually reduced capacity and increased the premium offerings. So they're increasing prices for the same seats, offering fewer seats.
A little pullback.
Everyone's paying more, is what I'm trying to say. All consumers are paying more, they're complaining about it. But again, if you hear consumers complaining about the price of airline tickets, then you have to understand that the airline companies are making money. That seems to be the case across the industry group.
Yes, they are.
But again, they're not increasing their take equally because when it comes to American, they still have to service the debt. But I will say this, importantly enough, interest rates can certainly impact a company like American more so than the less debt-laden airlines like Delta or United going forward. I did notice that this year, for fiscal year 25, which they're going to complete the reporting coming up, 62 cents next year, $1.85. That's a pretty meaningful increase in EPS, and that could be a function of some more favorable interest rate conditions for American.
Yeah, I will say that American, I know we often talk about some of the debt that plagues them, but hey, 3% pop today is nothing to write off. So nice to discuss American, hopefully breaking out of that $15, $14 range we see. Appreciate George Chellis for all of that breakdown on American Airlines. That's all it's needed for Alex and myself for Next Gen Investing for this Wednesday. We have the watch list coming up next.
Schwab Bank Investor Checking, the checking account built for investors, named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way you're going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists. Streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Mom, when my grandparents moved here, did they know what our family would become?
I don't even know if they could envision it, to leave everything behind, literally come across the entire world. I think that we totally met what their wishes were. Schwab has been with us for almost 25 years. Through purchasing of houses, opening up our business, having children, they've always been there for us.
I want to invest with a company that can help me give my family a happy financial future.
Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
Hey, Bob. Last year, my dad had a stroke. Big shock to see this person that I've always seen as a force in our family be vulnerable.
Wait, had a stroke?
Yes. Now we're in the car together almost daily. I started to realize, what can I pick up from my dad? He's been with Schwab for a long time.
Jim, my financial consultant. I probably met 20 years ago.
Jim's really been there to answer any questions I ever have. Makes a huge difference when you have someone that actually cares.
Good afternoon. Welcome to the Watch List. I'm Nicole Petalides. We're live on the floor of the New York Stock Exchange. It's 2 p.m. Eastern Time. So glad you are with us. We did see some records early today for the Dow and the S&P. The Dow has since turned lower. The S&P is still holding on to some gains. We have a big show for you today. Of course, what will the consumer do in 2026? How will they behave? The K-shaped economy and the economic divide. We'll discuss that with our guests. In the meantime, geopolitical tensions. Of course, the situation with Venezuela is impacting markets across the board, from commodities, oil, metals, and more. A close look at the forecast for IPO activity for 2026. We're expecting some more. The strong comeback could be likely, and we'll learn more about that. In the meantime, here's a quick look at the markets. 2 hours left in the trading day, and you can see the S&P is up 9 and 69.54. The Nasdaq is gaining 133 points, up 0.5%, while the Dow pulls back 0.5%, down 231 points, and the Russell's down 1/3 of 1%. Oil and gold are both lower. Gold is down about $35. Oil is down $1. The VIX is right now at 1488, and the 10-year bond yield at 414. 91.120 on Bitcoin and dollar at 98.40. For some of the big stories in the markets, we turn our attention over to Jenny Horn, host of Next Gen Investing. Good afternoon to you. You're taking a look here at Intel, I believe.
Yes, so Intel, with a really nice session today, especially in regards to posting at the CES. Not really a specific catalyst driving this upside. I will say we pared back some of our initial strength because shares were up as much as 9.5% earlier today. But hey, still 6.8% move, nothing to write off here as they're ramping up their gaming ambitions to see, by developing this new chip, frankly, and also this platform specifically for handheld gaming devices. So at CES earlier this week, their VP and overall product development GM did say the company plans to roll out a full hardware and software platform built on their Core Series 3 Panther Lake processors. They did unveil Panther Lake last year, and they've already started deploying the chips across a broad range of now PCs. So they're working through this dedicated Panther Lake variant optimized for portable gaming systems. That was reported by TechCrunch yesterday. Panther Lake, though, does also represent now a pretty major manufacturing milestone for a name like Intel, as it's the company's first processor that is produced on its advanced 18A process node, which entered production in 2025. And so right now, Intel shares, again, seeing a pretty nice pop this morning. Investors have been very much zeroed in on not only just Panther Lake, but that 18A manufacturing ramp, which is a core component of their overall turnaround. And the next near-term checkpoint for early demand, the next wave of this monetization era is going to be when we see the rollout of those new Core Ultra 3 laptops later this month. And so Intel shares, having a pretty nice session, but in a really nice recovery. Now let's see if it has legs with the next wave of, the Prove It story. Are they able to execute on a lot of these major advancements they've unveiled in the last couple of weeks and months, frankly?
I think the Consumer Electronics Show has brought so much to us this year. A lot of optimism, when it came to NVIDIA and also AMD, but then so many others, right? We continue to talk about how the Consumer Electronics Show continues to break news, and in this case, new products for Intel really brought some optimism too. So good news there from Vegas. How about Constellation Brands? Let's take a look at
Intel also.
earnings after the close.
So unfortunately,
We have 2 more hours.
not super high, but maybe that's actually to their benefit as shares have contracted roughly 38%.
1 hour and 55
And the shares
minutes.
expecting some more contraction. Earnings expected to pull back about 19% from a year ago. sales also expected to contract about 12% year over year. But alcohol makers have, broadly speaking, have a really hard time as economic concerns have led to not only just fewer social gatherings, but fewer convenience store trips. Now, we've seen across beer, wine, and spirits, producers have felt the pinch as consumers also just are drinking less. The squeeze began by these higher prices, but also more and more of these growing alternatives to be able to socialize without consuming alcohol. Now, in the quarter that ran through August, their beer sales fell about 7% due to the largely softer spending we're seeing from the Hispanic consumers, who account for actually roughly half of their overall beer customer base, and have also shown signs of these overall pricing just unease amid just the uncertainty with the future-looking pricing environment. They have also right now trying to mainstreaming their overall wine spirit business, focusing more on these higher-end brands, richer margins. But those divestitures did shrink the company's top line by about 65% year over year through the August quarter. So earnings not expected to show a lot of strength, neither are sales, but signs of at least recovering spending is huge. But again, I think it's really time to address the broader theme that is weighing on not only just inflation, but also Anheuser-Busch, Molson Coors, Sam Adams, and that's like consumers in the United States from a global volume standpoint are drinking a lot less, and that's being felt by a lot of these brands. So maybe seeing some recovery on this earnings call, but they have to write an overall trend that is not just being felt right now by Constellations.
All right, well, we have a lot to watch. I mean, I was covering earlier how people are going back to fast food from, McDonald's and Chipotle. So people are still willing to spend. Let's see what happens. Thank you so much. Looking forward to those earnings, Constellation Brands, after the close today. We'll have that for you here on Schwab Network. And coming up, a big picture look, Jack Atlin, Chief Investment Strategist, founding partner at Crescent Capital, will join us as here right now. Here he is. Right now, look, we have markets at record highs. Your thoughts?
Yeah, off to a strong start, Nicole. I think
Very good.
It is certainly the January effect that impacts mostly small caps, and we're seeing small caps up twice the rate as the S&P 500 right now. So all in all, it's a good sign. We'd love to see really a broadening of the market, and that's happening so far this year.
Are you in this camp of double-digit gains again for 2026, or will you take 5 to 7%? Are you worried about maybe even some negatives?
Yeah, I mean, I would take anything that the market's willing to give us this year. Historically, the midterm election year is not a great year. The average return of a midterm election year is about negative 0.7.
Oh, really?
At least from that perspective, we're not expecting much. However, we do expect a lot of liquidity coming down the pipe with a lot of fiscal stimulus in Q1, thanks to the big beautiful bill, and then perhaps a new Fed leadership in Q2 that could lower rates and potentially start buying bonds again.
Tell me more about, the impact that we're having on economic news. For example, the JOLTS came in, and that showed a cooling labor market, right? I think it's not particularly great. And then services, the ISM services showed some strength. ADP had more jobs. I mean, it's sort of like we get mixed bag. Friday we get the real jobs report. Your thoughts?
Yeah, so, we're seeing spending rise, but we're seeing the labor market kind of languish, and that's really reflected in the consumer sentiment surveys, which are really
it's like a little pullback.
Plunging. So generally what's going on, we believe, is that, remember, we have
We've got a 1, 2, 3 coming up.
Spending is concentrated among the top quintile, the top fifth of income earners, and probably most of the discretionary spending is concentrated there too. So one chart that I saw, which was probably
right to that support.
exemplifies exactly what's going on, I think, is this relationship between the AI stocks and electricity prices.
We're going to come down and hit the bottom of the orb.
Upper echelon benefits from the rise in AI.
We're going to bounce off this triple bottom.
The lower income consumer is now suffering with higher and higher electric bills.
No, shut up.
I see. So when you talk about some of your investment
We have a triple bottom here with the 1, 2, 3.
Stock picks. What are you going for?
Sure. So we're going for a broadening. We're going for a diversification away from the mega cap tech names. They've done great. They're probably a little bit overloved at the moment. And so we need a catalyst to broaden, and we think that
69.50s.
lower financing costs could be that catalyst. So if we think about huge liquidity in Q1, again, a lot of tax rebates, a lot of refunds coming back to consumers' pockets.
Wasn't even watching it.
With potentially,
Here comes the orb.
What was termed
Well, the triple bottom didn't hold.
where the Fed sells T-bills and uses those proceeds to buy 10-year treasuries and mortgages to try to get the housing market
Jimmy doesn't know
unlocked.
what to think
That
there.
could really
Everything
create
happened so fast.
a reduction in financing costs. Who stands to benefit? Really the smaller, lower quality, higher leverage parts of the market. And that would be a big reversal from last year.
So a name like Innoviva and
Should you go ahead and grab them at 3?
where do those fit into this story?
Grab one at 3.
So these are small
And then
cap
buy the other one if it
companies,
hits
again,
the
away from
orb.
mega caps, but they're also big
That's the
cash
question.
flow generators. Innoviva is a royalty essentially collector. They own a lot of property rights. They have mostly in the healthcare space, and they're generating strong cash flow from respiratory assets and also experiencing some pretty rapid growth. The other is Harmonic. They're also a fiber company. They are going to transition from the the cable
$2.90
to fiber optics, and there's a huge opportunity set globally for them. They've also seen some pretty dramatic growth. Let me see, over 30% year over year. So huge opportunity for a very small company.
Okay. In the big picture, you expect some volatility, and are those big pullbacks? I mean, could we see 10% pullback, and are you going to be buying on those days?
Yeah, I mean, I think we have to keep in mind that
They're now at $3. Jimmy's at the 290s. We're at the 69.50s.
For up days, we have to
Lotto, which
make
means
sure we're
today.
diversified, and we have an
One notch out of the money at $2.90.
that have down days too.
There they go again, 290, 275.
30% pullback, which most investors
Want this to hold.
think there's a much higher likelihood than actually
We
reality.
can drop down and hit that orb.
Pullbacks happen, and we have to position what
That's where I had 4.
portfolios to not only ride through those, but actually to
If we
power
hit-
through them as well. But yes, diversification helps, and then
Now, see, that's what I
rebalancing,
thought
so
we'd
that
hit
if
that
we do
red
get a
spot.
pullback and if we have some dry powder, we'll be able to deploy those assets into
You really
those
suck.
markets that have been beaten down.
And I know we're always looking for a broadening out, but the Mag 7 seem to always come in focus. When people ask you about the Mag 7 names, what do you tell them?
260.
Yeah, I mean, I think right now there's probably an oversupply of AI, and we think there will be winners and losers. Until that time, you have to own them all because you don't know who's going to win, who's going to lose.
Okay.
But we don't need 6 hyperscalers competing with each other indefinitely. So
Come on,
we
baby.
think this is a space, we call it the Peter Lynch effect, where if you like the sector, you like the growth, then own them all and let the winners bail out the losers. That said, we have to keep in mind it's a very concentrated group. Not only do the top 10 names in the S&P account for 40% of the market cap of the S&P, but really NVIDIA, for as large as it is and as powerful as it is, really only has 6 customers. And so
I'm Washboardjim. I am the founder of the Sneaky Snake Trading Strategy, where I talk about chart patterns, moving averages,
of companies.
and being in the now.
Jack, it's great to see you. Happy New Year. Jack Adlin, Chief Investment Strategist.
And right now we have
Partner at
290
Thank you.
and 260.
Options Corner, Rick Ducat standing by and
The
he'll highlight
69.50s.
the
Lotto.
investors are looking to trade
We're-
on recent news of Taiwan
We're
Semi.
kind of
Freeport,
bearish,
Macmoran, and
but we're at a
We'll be
bottom.
back.
So we're getting ready to have a little breakout, aren't we? I'm not sure about that, James. You're right here. I wasn't supposed to do that. Oh, 220. Oh. Oh, God. Dang. Come on. We can't go any lower this. I just have to get out because I ain't gonna sit here and babysit this.
A webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand.
Come on.
Head over to schwab.com/coaching and start learning today.
Oh. Not good.
Real-time access, data-driven analysis from U.S. equities
No.
to global macro matters. Schwab Network connects the dots. Watch live,
Marvel.
subscribe free at schwabnetwork.com.
Marvel even pulled back.
Welcome back to the watch list. Time for Options Corner, where we analyze unusual options trades.
Marvel.
And Rick Ducat, lead market technician,
Go on, Jimmy.
with us. And we're looking at Taiwan Semi, TSMC, hitting all-time highs yesterday. It is pulling back a bit today, but JP Morgan did note that AI is really going to help Taiwan Semi to keep on winning. Let's take a look at the chart and what you found as far as a trade, please, Rick.
Right. I mean, Taiwan Semi was a key player in this whole industry. Even before the AI boom, it's the dominant producer of advanced chips. It's an integral part of this whole ecosystem that modern life pretty much depends on here. Market cap above $1.6 trillion at this point here. We also had a bullish note from Goldman Sachs earlier this week. They raised their price target to $466. They said AI is a multi-year growth engine with capacity tightness expected through 2027. We're breaking through those old highs, that repeated ceiling near about 300 on our chart. But one trader perhaps not seeming to be as bullish here, at least in the relatively shorter term here, perhaps looking for a retracement off of this big rally with a large bearish play. The trading question, plus 5,000, February 6th, 320 strike puts at a 12.84
Well, if this bounces back, I'll be okay.
Debit. So an average debit here, because this
That
is
was a pretty good little
sprint type trade.
impressive
It was done in,
rebound right
several
there.
different increments here, several
For a
different
second.
lots. But all said and done, the debit paid
$30
was about
$30 on that one candle.
$6 so quite a large dollar amount here for this one. 30 days to expiration
almost
here, so about
40.
a month out. Our break even for this one, 307.16. So only looking for about a 4% move to break even here. And when we compare that to the expected move for this 30-day time horizon for February 6th, that would be about a 10% move expected almost potentially. So certainly within the possibility of that potential range here. We can also see that in terms of the volume of this trade here, the quantity that was traded also stood out. It was pretty large, relatively speaking here. It was about 5% of the total options volume that changed hands so far in this name today at the time I checked here. However, the sizzle was a bit lower, the sizzle being the activity versus the 5-day moving average of options volume here. It was only at about 0.9, so a bit lighter of a day than usual, despite the bullish outlook here and bullish news here, and a large bearish trade.
All right, and look, I mean, there's been so much talk about Taiwan Semi and how it's emerged as the backbone of global artificial intelligence, the whole economy, because of what it brings to the table. And it, moved the market valuation crossed 1.6 trillion, and even sort of, got larger than some of the other big names. So as the demand intensifies, good news there for Taiwan Semi. Let's talk about Freeport-McMoRan, and we think about copper and the highs we've been seeing. Now you found a bearish trade.
Yeah, another bearish play and a name that's seen really explosive growth. That's kind of the theme for our trades today in question. And, precious metals have really been crazy lately. Gold, silver, platinum, palladium, everything just having really strong gains. But also copper, too. Don't forget copper was at record highs. And all of these materials are really important for, again, our electronics and this whole semiconductor electronics field here. Gold and silver historically weren't really too useful for industrial purposes aside from dentistry and a few other limited things, but now gold and silver are becoming increasingly useful in electronics here, so something else to consider. Very interesting time for this company here, Freeport-McMoRan, that's heavily focused on gold and copper here. So you can see that low point in April, we've doubled since that point. New 52-week highs yesterday. Bank of America had a price target increase as well to 68 from 58. They kept their buy rating and named it a top pick in North American metals and mining here. So basically they're looking for that all-time high of 63, 62 to be broken here. But then again, an aggressive bearish play here, plus 15,500 February 20th, 50 strike put at a 124 debit here. So in this case, a $1.9 million debit paid here. Break even, 48.76, about 11.3% to the downside here. When we compare that to the expected move for this February 20th time horizon, about 44 days out at this point here, the expected move is about 12% only. So we're quite close to that range here. So this trade would need a move beyond that range to make some serious money here. It would need almost the edge of the expected move just to break even here. So again, another trade that was a significant portion of the total volume though. This trade at the time I checked was about 23-24% of the total options market today for the stock, which had a sizzle of 1.2, so slightly elevated trading.
Right, and look, what's gone on in the metals has been totally incredible. Unseen, like, in decades, depending on which metal you're looking at, but as you noted, you found this bearish trade. What about Merck hitting another name to talk about, and what are your thoughts on this trade that you found?
Yes, a bit of a mixed bag for Merck today here. On one hand, UBS raised their price target to 130 from 105 and kept their buy rating here. Merck also today successfully completed a cash tender offer for Cidara Therapeutics, ticker CDTX. Won't be trading much longer anyway, so not much point in looking it up. But they're a biotech company for cancer treatments here, and Merck acquired them here for, I believe, about $6 billion or so. That was some positive news. But on the other hand, then, the CDC, the Center for Disease Control, also changed its recommendations about the HPV vaccine dosage. Now they're saying our children should only get one dose versus the 2 to 3 it used to suggest here. Jefferies analysts said Merck could lose $630 million in revenue as a result of this because of its Gardasil vaccine being one of its top-selling products, and the loss of revenue for this main part of their financials here. But the trading question seems to be taking a more neutral to bearish outlook here. Minus 6,500, February 20th, 115 strike calls at a 231 credit here. So an opening trade, all these trades I should mention, these are all opening trades again today. The volume is far exceeding the open interest in all of these options here. A $1.5 million credit received for this trade. 44 days out, just like our last one here. In this case, the break even is about 8.6% to the downside, 117.31 here. Again, pretty close to that expected move, just slightly beyond that boundary here, according to the options market. So this would be a trade that would be hoping for the price to just kind of stay beneath that break-even level and just keep the credit received here. Again, a significant part of the day's volume was this lone single trade here, about 17% or so, with the sizzle 2.1, so about twice the typical activity versus the 5-day average today.
Well, it's great to see you, Rich Ducat. Good names to take a look there. TSMC and Freeport McMoran and Merck. Thank you so much for Options Corner today and all the charts you always look at for us. Coming up, now, U.S. capture of Venezuelan President Nicolas Maduro is impacting markets across the board, and we'll watch what's next, particularly maybe for metals, gold and silver. We'll be right back.
Kick off the morning with the data and the decisions moving markets. Morning Trade Live breaks down the macro moves driving the price action, from Fed policy to global growth to inflation prints and geopolitical risk. Smart, fast and always live from Wall Street to your screen. Morning Trade Live, where the markets meet the macro, weekdays at 10 a.m. Eastern on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Do you like using charts when analyzing your stocks? Our technical analysis webcast series breaks down different charting techniques like trend analysis, price patterns, moving averages, oscillators, and much more. Best of all, you can ask questions directly to an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
I'm Kevin Green, and I track options flow daily, identifying who's buying, who's selling, how it's going to impact markets. Watch live on Schwab Network and schwabnetwork.com.
Trading with Schwab is powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals, you can spend less time searching and more time learning. Trade brilliantly with Schwab.
Welcome back to Watch List. I'm Nicole Petalese. We're live on the floor of the New York Stock Exchange with a few movers for you in the market right now. Check out Boeing is higher today after Alaska Air ordered 110 aircraft, including 5 of the new 787s. Alaska also has an option for an additional 35 737 jets. Shares of Boeing are up 6% so far this year. And we're keeping an eye on First Solar, which is down nearly 10%. Jefferies downgrading the stock to hold. The analysts also cut the price target to $260 from $269 due to the company's limited booking visibility and emerging strategic questions. All right, let's get back to what's going on with metals. What an incredible 2025 we had. We welcome in our next guest, Derek McPherson, CEO of West Point Gold. Thank you so much for being with us. So there's no doubt what a year 2025 was, and we'll get to that in a moment. But the Venezuelan story from this weekend and now and going forward, does this impact gold and silver? I know we had a knee-jerk reaction a bit. What's the story with metals and Venezuela? Is there any correlation?
Well, I think gold has become more, gold's always been a hedge for political risk. I think it's started to have more of an impact since February 2022 and the changes that the U.S. government weaponizing the SWIFT system, and so gold's become a lot more popular as a politically safe commodity and a reserve asset. And so I think that certainly has had an impact. And I think when you get these geopolitical events like the capture of Maduro, that gives you a little bit of a pop in the gold price, and it traditionally always has. But it doesn't necessarily give you that sustaining move, and I think we're seeing some of that profit taking come out today.
Understood. I mean, when we look at gold that went above 4,500, we had silver, we had copper, palladium, platinum, all of them were hitting some sort of new high. Do you expect metals to continue to do that in 2026?
Yeah, I think I think we're going to continue to see a move up in metals, hard assets, and commodities. And the reason is that the underlying driver here, while you get these geopolitical events can give you these short-term moves, the really underlying driver here is sort of twofold. One is you have the world shifting away from the U.S. dollar towards harder assets, and gold is obviously an asset that the central banks can take on as a reserve asset, and so we're seeing more of that particularly the Eastern world and the BRIC countries, those at risk of potentially being at odds with the U.S. And so that is, I think that's part of it, and that is going to continue. That is something that's slowly happening since February 2022, and it's progressed. It's really been the driver of the gold price, the underlying driver of the gold price. The second thing, and it's something that is rampant all over the world, is aggressive deficit spending by governments. Governments are effectively devaluing their fiat currencies, and the result of that is that devaluation of those fiat currencies is pushing hard assets higher. And you're seeing that in gold price, the silver price, platinum, palladium, copper, and other hard assets throughout the commodity complex.
Understood. So at this point now, do you see gold as the central bank buying, as the, sort of the play, the lower rate environment? There were other things that were driving gold, right? I mean, certainly central bank buying was one story. Lower rate environment, it's always used as a hedge, as you noted.
Yeah, I think that I think those are the underlying drivers, and then what you saw sort of, what really caused the explosion of gold price in 2025 was all of a sudden Western buyers stepped in. So what we saw in 2022 and 2023, which gold had pretty good years in those years as well, if you look back relative to history, those were driven by that central bank buying. What we saw in 2025 is sort of Western investors and Eastern buying. And Eastern buyers tend to buy more of the commodity, so they'll buy gold, physical gold. That's why I saw the gold price rise. What we saw starting in 2025 is the Western buyers get involved. We finally saw tons start to get added to the GLD. It became a bit of a trade. It certainly became a momentum trade, and I think that's gonna continue. And actually, what we've seen is not as much a. I think what we're going to see going forward is I think the commodity is still going to do well, and I think it's got much higher to go from here over the sort of the longer term. But I think what you're going to see is where the fork is, where the investment is actually in the producers. Companies like Franco-Nevada and Kinross that are shown on the right there that are really leveraged to the gold price, because we haven't really seen those. Those are still trading at a material discount to sort of your typical S&P 500 company, but they are printing cash at the current gold price.
So do you buy those today on dips, periodically? What's the play?
Yeah, I think you buy on dips. I think you're going to. I think the opportunity here is that these companies, at $4,500 gold, most of their average cost is sub $2,000 an ounce. They are literally printing cash in a material way, and so I think that is something that and quarter-over-quarter increasing rates, right? Last quarter the Q3 results were sort of priced around $3,500, $3,700 gold. This quarter it's going to be north of $4,000 gold, right? That's $500 an ounce. That's basically going straight to the bottom line, and so I think that's an important on these dips and these opportunities. It's an opportunity to step in and build a position as the gold price. Even if the gold price is stable this year, you're going to do really well on those companies that are mining metal.
What about silver? I mean, we think of silver as sort of twofold because it is somewhat of an industrial metal, but it's also a safe haven to a certain extent. It's sort of like, gold's little brother or something, right?
Silver oftentimes is, you're right, there's an industrial component to silver. I mean, silver is actually a major component in solar panels. And so there's there's a significant industrial use for it. It doesn't have the same precious metal, and you don't get the central bank buying. But you do get retail buying. So when retail investors really want to add precious metals exposure, it's a lot harder. It's harder to buy an ounce of gold. It's a lot easier to buy an ounce of silver. And so that's where that market comes in. Additionally, silver is a bit of a unique market, and what I mean is that the majority of silver isn't produced by primary silver mines like gold, so the the fluctuation in price is not necessarily driven on supply, it's driven on demand. And so when supply is generally flat, it comes out as a byproduct of some very large, mostly large copper mines. And so that opportunity in silver is that when there's demand all of a sudden, supply doesn't come up to meet it, and so you get these big spikes in price. And silver's been on a great run. I do like silver here. I think it's got probably a little more run, but probably, my feeling is that the majority of the juice in the short term is coming out of it with this very quick run to $80 an ounce.
All right, well, good to know. Derek McPherson, CEO of West Point Gold. Great to see you, Derek. Thank you so much. Coming up, AI, the revolution or the bubble? Let's see. Our next guest thinks depends on which company you're speaking of. We'll go into some of the names on the list. We'll be right back.
Oh boy. 2:36 Eastern Time. Nice cold coffee. Okay.
Sometimes, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Real-time market moves, earnings breakdowns, and trade-ready insights. Follow me on X at Sam_Vardas and connect with me on LinkedIn or Instagram for more.
Trading with Schwab is powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab. Trading at Schwab is powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh.
Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties. Carl.
Schwab, a modern approach to wealth management.
Welcome back to the Watch List. I'm Nicole Petalides. We're so glad you're with us. Nitin Pachetti, Portfolio Manager at Papyrus Capital, is with us here to talk about AI. I mean, there's certainly this feeling, most people I speak to still think AI rules the show. Maybe it won't see the same growth, maybe it won't be all the same companies, but There's certainly this feeling that AI definitely still has a long way to go. What do you think?
I think that's, thank you for having me again, Nicole. I think that's totally right. I mean, I think that we're in the early innings of sort of the I guess, AI life cycle and the AI trade. I think the difference, though, is that a lot of capital from 2023 through 2025 has really flowed into these, AI winners in the stock market, right? And that is, a lot of these companies are extrapolating a lot of growth for a long time. And I think that's really the key because, not that a single day makes a trend, but when we think about yesterday and we think about the AI trade and what Jensen Huang from NVIDIA said around cooling, for example. You saw some of the names that make components that cool data centers. You saw some of the names that, some of the companies that build data centers down. But then you saw the memory names, Micron, SanDisk, Western Digital, Seagate up pretty substantially. And so I think the point being that, as the AI trade matures,
yesterday was the day.
There will be more winners and losers, right? And it won't be just sort of, rising tides lift all boats. And that's really the key, which I think is sort of exactly what you're saying too.
Some of those names that you mentioned, I mean, we always think of NVIDIA and AMD, but you're talking about SanDisk and Micron and some of the other names. I mean, there's sort of this trickle-out effect, and then, of course, we get to data centers and all that. I mean, which names of the names we know, and I know you have some stock picks and such, but of the most popular names, which ones sort of still lead and keep the course?
I mean, I think the answer to that question, higher level, starts with sort of the training versus the inference curves, right? So I think you obviously saw a lot of money put into training for the last few years as these models like ChatGPT have scaled, right? And I think the idea here now is that you're at a point where more applications for AI will be used from an inference perspective, right? And you still need to, all these names that you have here on the screen, right? You still need your, flash memory to take that data and, basically use it for inference purposes, right? And sort of after you've done your ChatGPT queries, you need to take, the queries, the work done, and store that on hard disk drives like Seagate and Western Digital. So I think when we think about this, rise of the inference curve, I think all of those memory names really benefit. We've talked before about copper. When I was on your show in Freeport in November, we've talked about sort of fiber optic cable as you're connecting all these data centers together with Cogent. So I think all of those companies to me are really beneficiaries of this next leg.
Understood. Let's talk a little bit about some of the stock picks that you have. I mean, for example, Golar and LNG. Why that?
So, similarly, when we're talking about kind of the 10x amount of energy required for, a ChatGPT query versus a Google search, we're going to need more natural gas. I mean, all the stuff we've heard even the last month or so on using some of the turbines from, airplane engines now to power some of these data centers to 25 megawatts, right? Like, all of that means more natural gas demand for powering the data centers, whether it's on the grid or it's behind the meter, right? Data center specific. And something like a Golar benefits because they have these vessels that liquefy natural gas offshore. As we find more stranded gas reserves, they do it very low cost. We transport it to, all the regions in the world where there's very little natural gas, but need it to power this whole revolution.
Right, understood. Now, on the other side, you do think there are certain companies that may not survive in the same way. In fact, you have them shorted. You're betting that they're going down from current levels. Names like what?
So we are short some of the data center, construction companies, some of the, ditch diggers, and, the companies that kind of lay some of this cable, just because over time, as you get to the point where, you scale through your GPUs, and data center bills start slowing, for us, we think that a lot of those companies are kind of at peak multiples on peak earnings. That makes sense. And if those earnings start to decline after, 2028, a lot of future growth through 2031, 32 is being priced in here. And so, it's a very long-term bet, but for people like us, right, we're looking to always have an insurance policy on our portfolio, right? And that insurance policy is when we're long these memory names, we're long, names like Cogent and Golar LNG, right? We want an insurance policy on the other side, and those are the companies we think over, 2 to 3 years will do worse than, some of the other AI names, and that way we're kind of covered on both sides.
Right, I understand. I'd like to ask you just quickly, the mid-cap special situations, maybe something off the beaten path. Quick thought there.
Yeah, I really do think the market is changing, and I think that as we've seen all this capital flow into large cap tech the last 3 years, I think that there's been sort of a scarcity of capital flowing into some mid-cap names in the U.S. And I think for me, for us, for buyers, that's really the place to be, is where are some of these mid-cap special situations? We're in a company called GCC in Mexico, and it's a cement company. Sounds pretty mundane, but it's trading at 4 or 5 times earnings, and we think there's a potential relisting, plan happening into the U.S. and the same way CRH, the aggregates company, did a couple years ago. We think there's massive multiple expansion that happens from some of these kind of ordinary event plays in mid-cap land. So that's another place where as the market sort of lives and dies by the next AI data point, which creates some really scary moves, we think there is great opportunities to be had in much more, like you said, exactly like you said, off the beaten path mid-caps.
All right. Well, Nitin Sacheti, thank you so much, portfolio manager at Papyrus Capital. Thank you. Good chat there. All about AI. Now, what's in store for 2026 when it comes to some new listings, the IPO market? We're expecting a lot more, right? Let's talk about some of the activity that our guests are waiting on. We'll be right back.
The final 90 minutes of the trading day, that's when markets make headlines and traders make decisions. From earnings shocks to sector rotations, we're tracking the catalysts that move markets right into the close.
Here on the floor, I bring you real-time sentiment from traders driving the action.
And in Chicago, we break down the data, technicals, and trades you need to see before the bell rings.
Live coverage of the close every single day.
This is
Market on Close, live weekdays 3 p.m. Eastern, only on Schwab Network.
Opportunities don't stop when the market day ends.
That is true.
Schwab gives you round-the-clock access to over 1,100 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading.
Well, that's too funny.
No matter the hour, you can trade really with Schwab.
Hey, investors, you know the market moves. And Schwab is here to help you move with it. So, whether you're buying, selling, holding, or planning, whether you're ETFing or 401k'ing, saving, spending, or even retiring, you can count on Schwab for market insights, live support, powerful trading platforms, and 400 branches. All at your service, all so you can invest your way. Sounds nice, right?
I'm Seth
Sounds real nice.
The New York Stock Exchange. When the market moves, we're on it.
We're on it, baby. That's right.
And sentiment in real time. Stream Schwab Network at schwabnetwork.com.
Is that right? We got a snake with breakout. And we've got a little flag. Hard to say.
Welcome back to the watch list. The IPO market has been ramping up right in 2025, and there's more expectations for 2026. Our panel is ready. John Jamarone, editor-in-chief at IPO Edge, and Evan Schlossman, principal at Zero Capital.
Well, I think 2026 is going to be a life-changing year for me.
Well, Nicole, the first quarter, the big ones I'm expecting, at least in the first half, I'm going to jump over
life-changing.
We're looking at certainly, or excuse me, on the blockchain side, we've got Consensus and Kraken, and then on the AI side, I'm sure your viewers are well aware of this. We've got OpenAI. A lot more to dig into there, but those are the big names everybody's focused on.
Yeah, SpaceX, Anthropic, K2 Space, Canva, Databricks. Evan, what are you watching for?
Yeah, absolutely. I mean, in our portfolio, certainly OpenAI, but also Canva as well. I think we're looking as 2026 starts to ramp up as any IPO cycle. We're excited about and expect sort of first come to market the high quality names with sort of proven track records.
Cybersecurity might be another theme too, because I saw Huntress has been a name that's on there too. I mean, that's been,
Get more already.
Is maybe a probability in the crypto wallet startup. There's some different things Plaid with fintech. Evan, want to expand?
Yeah, I think we're seeing across the board there. I mean, if you look at the macros and certainly the crypto side, right, and fintech as well, you are seeing very strong traction over the last year. Certainly crypto has had, ebbs and flows in sort of macro cycles there, but from a regulatory aspect, I think there's some advantages to them going public sooner in this market. So that's something interesting to look at. But we're, as John mentioned, also looking at the AI side. I think we're seeing a huge amount of enthusiasm from investors into names in that space. And so that is certainly something in our portfolio, but we are excited to see how that matriculates through the 26 cycle.
9 more minutes to power hour. And this is a good setup here.
23 U.S.-based companies that listed above $1 billion in value compared to
69.50s at 125.
The expectation is that 2026 will surpass that. What do you think, John?
Well, Nicole, if I might, and Evan, I think we'll agree with this, just less than an hour ago, we had yet another private raise with the parent cloud and Anthropic, which you alluded to. That's $10 billion raised there at a $350 billion valuation. We also had $20 billion raised from XAI, which is Grok, which is a must counterpart to Claude. And to me, that's really interesting because that's $30 billion right there, Nicole. Last year we had 44 million in IPOs altogether, right? So the private market is red hot. The question is, if these guys go public, what should investors do? And we can talk more about that. My instinct is to be a little careful. When you raise that much money, you still need more. You got to tap the public markets. I've seen this kind of thing happen before, and you need to watch out. Going back as far as, say, Facebook, 2012, I remember being in Sun Valley, seeing Mark Zuckerberg walk into a room in the lodge there, and everyone was saying, "What's going on with your stock price, Mark?" And he said, "Well, I try not to look at it." But when you raise this kind of dough from guys who are smart as hell and know how to sell stock when they can, you got to be a little careful.
Understood. I mean, Evan, when you think about what's going on there at Zero Capital, you talk about maybe retail investors getting more exposure to IPOs than they have in the past.
Yeah, it's interesting, right? Since Zero started, we are a basically publicly traded venture capital company, right? So you can buy and sell, or venture capital fund, you buy and sell shares of us on the retail market. And so what we've seen, I think is there has been an astronomical amount of value being created in the private markets, especially with new innovative technologies. You look at the AI side, Anthropic, OpenAI, SpaceX, which is rumored to be going public, or looking at going public. And so we started, the thesis for Zero is to provide retail investors and investors access to the growth that occurs in that private market. And so for us, we're excited about this IPO side, but for Zero, we provide kind of a vehicle to access the growth in the private side before that. And I think it's been astronomical the amount of growth we've seen matriculate into the private side. And so it seems like these companies are maturing to a stance where they are getting ready to, go public. I think we're going to see a pretty strong 2026 as long as macros hold out.
And we also sort of think that this administration was more business friendly. That was sort of the idea in the first place, right, John?
Well, this administration also likes to dabble in the IPO market to some degree, Nicole. So I just happened to notice my team on, I think, New Year's Eve, Truth Social launched some ETFs. And I can't help but point out, Nicole, one of them, the Red State ETF, charges 65 basis points on a diversified U.S. property portfolio. Schwab's own REIT ETF charges 7 basis points. So I would be very wary of getting too involved in that. But yes, the administration is very business friendly.
Okay. And finally, just the big names like the SpaceX, OpenAI, XAI, Anthropic. John, do we see these this year? I mean, do we see at least one or two? What are you going to guarantee here?
So, well, Nicole, I'll make a guarantee, come on now. But I think, and there's good reason to think that these companies are spending so much money on these data centers, which Ed knows all about, and you probably echo this, which over time should work out, but for the time being, this CapEx is tremendous, and that's why they're shifting over to the public markets. I mean, frankly, I'm very happy to have Evan here, because I would advise investors to watch out about investing in this stuff. Remember, Nicole, we discussed this many times. A lot of your viewers are going to get little to no allocation on an IPO. It's likely to pop if it's priced properly, so it's already up a lot. These investors are not going to just sit on massive profits and not take any off the table. So just be mindful of how much they've gone up. I might even say, take a look at some of these really interesting businesses on the blockchain side, like Alphaton, which is tied to Telegram, 1 billion monthly active users. There are a lot that stick around. There are a lot of interesting, smaller stories out there. I hate to say it, but the real money with Edmund and company and his investors may have already been made by the time a lot of our viewers here can touch these things once they go public. And I do think they will in the middle of the year because they need the cash.
All right, thank you both. John Charon, Evan Schlossman, thank you. It's great to see you both. I'm Nicole Petalini. So glad that you are with us. The S&P still holding on to its gain and a record. We'll have a record close here, maybe. We have a chance. Not the Dow, though. It's down almost 300 points. I'm Nicole Petalini. And Market on Close is next.
Schwab Bank Investor Checking, the checking account built for investors, named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists. Streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Mom, when my grandparents moved here, did they know what our family...
One more minute, power hour.
To leave
everything behind, literally come across the entire world. I think that we totally met what their wishes were. Schwab has been with us for almost 25 years through purchasing up houses, opening up our business, having children. They've always been there for us.
I want to invest with a company that can help me give my family a happy financial future.
Stay connected to what moves the markets. Download the Schwab Network app and stream anytime wherever you are.
Good afternoon. It's 3 p.m. on Wall Street, and this is Market on Close. I'm Marley Caden, coming to you live from our Chicago headquarters.
And I'm Sam Barnes, coming to you live from the floor of the New York Stock Exchange. Let's take a look at what is coming up on today's show. We'll be joined by the team from the NASDAQ to discuss ETF performance from 2025 and which trends to keep on your radar for the new year. Later, we'll dive into the world of commercial real estate and why 2026 could be a year of stabilization for the group. And in Options Corner, we'll check in on Micron as it touched yet another all-time high. But for now, Molly, take us through what's on your radar today.
A lot of headlines today, Sam. The first one, Intel shares jumping after unveiling new laptop computers running on its Panther Lake processors at CES in Las Vegas. The company says it has started taking orders domestically. Global availability will start on January 27th. These processors represent the first computing platform built on Intel's 18A process technology, which the company says is the most advanced semiconductor process ever developed and manufactured in the United States. We also got an update in the latest on the Warner Brothers Discovery acquisition drama. The media company is officially recommending that shareholders reject Paramount Skydance's offer. In a letter that they made public this morning, the board unanimously agreed that Paramount's offer is not comparable to the $72 billion bid made by Netflix and expressed some concerns about a lack of certainty for Paramount to actually complete the offer, highlighting risks of costs that would be borne by Warner Brothers and shareholders if it failed to do so. Eli Lilly also moving higher after it is reportedly nearing a deal to buy Ventyx Biosciences for more than $1 billion. Neither company has commented publicly yet, but the purchase would align with Lilly's announced plans already to move beyond the diabetes GLP-1 space and into immunology. Also, home builders under some major pressure today after D.R. Horton and Lennar both got downgraded by Citi and had their price targets cut. Citi says it's concerned that the housing market may stay sluggish throughout 2026, also lowering their price targets for companies like Four-Star Group, Pulte Group, and Toll Brothers as well. Lots for us to talk about today, but first, let's take a look at where the markets stand as we head into the end of the trading day. Still a bit of a mixed picture here. The S&P mostly unchanged, but slightly in the red at 69.4341. For the NASDAQ, we're 1/3% higher, 25,726. On the Dow, we're trading 0.6 lower right now, lost about 322 points at 49,140, and the Russell 2000 is 1/10 lower at 25,8035 right now. Taking a look at the 10-year, we've dropped to 4.15. The dollar mostly unchanged on the day at 98.43. Gold is also lower today, 44.6830 a troy ounce right now. Crude oil trading 1.5% lower at 56.22 a barrel, and Bitcoin continuing its drop down to 91,525, giving up some of those gains that we saw earlier in the week. I do want to check in with Sam in New York, though, and see what some of the top stories that caught her eye were today, because, Sam, it was a very busy day.
It was. Look, we got a bunch of data out this morning, Marley. Nothing particularly new or alarming. It was generally a continuation of this sort of low hire, low fire environment that we saw throughout the most of 2025. So let's start with ADP. We got a headline reading of 41,000 versus the 48,000 that the market was anticipating. So slightly lower. So hiring in December was, as I said, lower than those expectations, but the gains have been led by education and healthcare. Now, I spoke to Kevin Gordon earlier, who was pointing
pointing to the uneven labour market, talking about how there are pockets of the labour market that are in recession, like manufacturing and the youth, which has been offset, though, by services jobs. Then we also got jobs. The number there, 7.146 million job openings in November. So a little bit more backwards looking as far as that data print. Softer than expectations as well and lower than October. Although a bright spot was that the layoffs didn't rise, but more people quit on their own terms. Now, we also got ISM services. 54.4 versus
That's interesting.
52 estimates, so that is comfortably above the boom or bust line. That's the 10th month of expansion now. Remember, that is the 50 line, which separates it from contraction. Employment expanding for the first time in 7 months. That's encouraging. The other bright spot, prices paid coming down, but still that gauge has stayed over 60 for more than a year. And just quickly also catching my attention in the last hour or so were these two announcements coming from the Trump administration around home ownership and also these defense dividends. We are seeing moves in very much some of these asset managers, REITs, and defense and aerospace companies as well, Marley. But I'll send things over to you and Jenny over in Chicago with some of today's top movers.
Thanks so much, Sam. And a perfect segue, actually, for our conversation with Jenny Horn joining us now to break down some of those top stories. Arguably, the top story is the one Sam just highlighted, some of these developments in housing, not just the announcement from the Trump administration, but also the moves that we're seeing in some of these housing companies, these builders particularly, major moves to the downside today following a series of downgrades.
Yeah, I mean, the street, let's say, like pretty safely, broadly speaking, not a fan of the home builder stocks right now, but definitely helps that President Trump and is making some commentary regarding the U.S. state of the housing market, saying that the U.S. should be barring large institutional investors from buying these single-family homes, arguing that corporate ownership has helped push housing further out of reach for everyday Americans, saying on Truth Social for a long time that buying and owning a home was considered the pinnacle of the American dream. It was the reward for working hard and doing the right thing. But now, because of record high inflation, that American dream is increasingly out of reach for far too many people, saying that people live in homes, not corporations. So private equity giants and real estate investment trusts, as well as other large institutional investors, have amassed pretty sizable portions of portfolios of these single-family homes over the past decade. Many have argued that these investments have reduced housing supply for would-be homeowners and helped drive up prices. Of course, coupled with a rising interest rate environment, which has been the case for years. Now we're seeing some of that reduced, but that has been, frankly, what's then really dried up that demand and that overall just availability for first-time home buyers. But Innovation Homes, or Invitation Homes, which is the largest business single-family homes, fell about 7%. Blackstone, which is an investment firm, of course,
business debit card,
single-family homes, also dropped more than 4%, as well as Apollo Global Management dropped about 4%. So those moves are being felt more by some of these private equity type of companies. But Trump did say that he has plans to outline such additional affordable housing during his speech, at least at the World Economic Forum in Davos in about 2 weeks. No further details were given, though. So this is not the first time he's made big claims. To follow through on this, but I think will be more meaningful for these actual home builders that right now actually have had a decent start to the year. Now, outside of course, today, it's only been, like 3 sessions into 2026, but we have seen actually the iShares U.S. Home Construction ETF trade a bit above the S&P 500 so far this year. It's very early to say, but today, of course, seeing a bit of a re-rating of price. But this news would actually be great for not only first-time home buyers, but also just the home builder stocks in general, which have struggled with that pent-up demand, but a lack of supply.
Yeah, certainly, and the prices aren't helping. Hovering right around $430,000, the average median price
for
in the
this is
United States for an
January.
existing home. So very, very expensive here. But let's talk about Intel as well. Intel making a move to the upside. They have given back some of their gains today. We're up close to 9%, now up a little bit more than 6%. But coming up with an announcement from CES, not any significant announcement really, but a nice move to the upside nonetheless.
Yeah, I mean, I was shocked to see up 9.5% this morning. And again, we pared back some of that strength. But following these CES chip unveilings and also just analyst really favoritism for Intel as of late. I mean, investors have been zeroed in on their 18A manufacturing ramp, which is a pretty core plank of their turnaround story. And the near-term check right now for early demand and that product rollout for their new Core Ultra Series 3 laptops, that will be later this month. So they will face some more critical tests on the lower of these products, frankly. But I mean, shares have seen a pretty sharp swing. We know that the stock, of course, has seen I mean, trading as low as 39.85 and as high as 44.55, so we're volatile in this name. But the move just put attention on their real attempt to prove they can build these advanced chips at scale. After years of delays, lost market share, I mean, we've seen more and more enthusiasm, especially as traders have treated a lot of the announcements we've seen at CES as this overall barometer into AI health. Intel's also been targeting this new handheld gaming type of platform with their new Panther Lake. They are ramping up their gaming ambitions by enveloping this new
6940s
for handheld gaming devices. So the Panther Lake processors, which if you can recall were unveiled last year, have been unveiled with some more added capabilities specific to gaming. I think it's an interesting move because frankly, I'm so critical of NVIDIA. NVIDIA's gaming portion of their business has been the biggest underperformer. I mean, still not underperforming, but just relative to like data centers. I think it's interesting that I was reading an analyst note so focused on gaming for Intel when gaming has not been at all a boom. I mean, really a bright spot for top line growth. But hey, that has at least been unveiled at CES, and we know it's been like the battleground for announcements at CES. And Intel, from what I've seen so far, has been perceived as one of the winners, really, of what's been announced, whereas AMD has been left in the dust a little bit.
Yeah, we certainly saw a downside move from AMD after we heard the commentary from Lisa Su, which, you know, seemingly positive commentary and not unexpected, but we did see them push to the downside. But like you mentioned, you know, we got this note from Melius Research upgrading Intel following this announcement that their, you know, new processors are about 77% faster when it comes to gaming. Of course, gaming mentioned again for Intel, but, you know, time for them to prove that their products are working and they're going to be a part of this AI laptop, you know, conversation that keeps coming out of CIS, this focus on AI computers and if that's the next upcycle or super cycle that we might see. But I know you love that word.
Super cycle. You always have to throw one in there.
I do. I have to toss one in. Not a super cycle for Eli Lilly, though, but there are rumors of an acquisition that could help them diversify their portfolio a bit.
Yeah, I love to talk about Eli Lilly when we're not talking. I mean, frankly, I love to talk about the weight loss drugs, but I like to talk about the diversification of that pipeline. So the shares is trading higher after a Wall Street Journal report suggesting the company is nearing this deal for Ventyx Biosciences. And according to the journal, they are in these advanced talks to acquire the company for more than $1 billion, citing, of course, those familiar with the matter. Now, Ventyx, which is currently based in San Diego, had a market cap of just over $500 million through at least Tuesday afternoon. Eli Lilly, just for context, has a market cap of roughly $1 trillion, so very different sized companies, but Ventyx does specialize in the oral drugs for inflammatory diseases like Crohn's disease, rheumatoid arthritis, and its drug candidates have also shown promise in these neurodegenerative conditions like Parkinson's disease, as well as certain heart-related conditions. So right now, I mean, we're currently seeing them in the mid-stage testing phase for cardiovascular diseases, but Ventyx is focused on therapies that target various protein complexes, which do actually play not only a critical role in inflammatory and immune responses, but also in obesity. So it all comes back to, I mean, the GLP-1s. Not to say this company is a GLP-1 by any means, but I do think adding another layer of diversification. For so long, a lot of these drug makers have been unfortunately siloed with, like, they'll be basically associated with whatever treatment is hot on that year, like COVID, of course, those treatments. Then it was the GLP-1s. I think it's important to remember you cannot be a company based on just one specific treatment, and this is a good reminder. And hey, Eli Lilly actually over the last 12 months, up 43%, performing quite well relative to the broader healthcare space.
And seeing a really nice move today, too. A lot of the time when you get these acquisition announcements or rumors of when you see the purchaser move to the downside and the acquiring target move to the upside, Ventyx certainly up to the upside. They're 37% higher on the day, but Eli Lilly up almost 4% right now as well. Our last one, not going to see any.
There's the knife right on me.
About big banks. Wolf put out a pretty strongly worded note today saying that they are moving away from the money-centered big banks this year.
Yeah, downgrading our major banks, JP Morgan, Bank of America, US Bancorp, and M&T Bank, all to pure perform from outperform, no price targets given, which I always find to be an interesting move, but part of a broader note that they titled Banks, Brokers, and Alternative Managers, saying that most buy-siders expect the Money Centers group to continue to outperform in 2026, but their take is right now less sanguine after the Money Center group rallied nearly 40% last year. For JP Morgan, they see modest upside to numbers, but a valuation that is already full. For B of A, they say the downgrade is tougher on valuation, but they see a risk to the forward estimates as this net interest income tailwind is now, in their opinion, fully baked and expenses should surprise actually negatively. But for the other two banks, the downgrades do reflect these limited catalysts and multiple re-ratings above the long-term multiple averages. So to me, this sounds like a valuation call. They're basically just saying, look, JP Morgan is right now more favorable for a risk and reward standpoint, or perhaps just, relatively fair valued. Everything else could actually see some downward revisions. But we will get the critical test when we get earnings, which thank goodness will really be earnings next week. We do get JP Morgan Tuesday before the open, as well as Wells Fargo, Bank of America, Citigroup Wednesday morning, Morgan Stanley, Goldman Sachs Thursday morning, and then U.S. Bancorp, which of course
right when I got in
the following week. So we do have finally some bank earnings to parse through, as that will be the unofficial kickoff to our next earnings season.
And you just mentioned two of their top picks for 2026, Wells Fargo and Morgan Stanley, are favored by Wolf, not on their downgrade price.
Which is an interesting take that I respect. So we'll get those numbers at once, which I appreciate.
Thank you, Jenny, for highlighting that and also giving us an earnings preview of what to expect for next week. I do want to send it back to Sam in New York, though, for a look at what we have coming up for the rest of the show.
Well, Marley, we'll be joined by the team from the NASDAQ to discuss ETF trends for 2026 and what innovations you should have on your radar in that space. Market on Close will be right back.
Hey, investors, you know the market moves, and Schwab is here to help you move with it. So, whether you're buying, selling, holding, or planning, whether you're ETFing or 401k'ing, saving, spending, or even retiring, you can count on Schwab for market insights, live support, powerful trading platforms, and 400 branches. All at your service, all so you can invest your way. Sounds nice, right?
I'm Nicole Petalides, live at the New York Stock Exchange, and this is the Watch List. Your midday view into the trends driving the markets with a sharp focus on technology, innovation, and companies leading the next wave of growth. Big movers, real-time interviews, and insight from analysts, founders, and market voices you trust. The Watch List, 2 p.m. Eastern, only on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive
More
learning
drama.
at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
It's going to be a late day run.
Real-time access, data-driven analysis, from U.S. equities to global macro matters. Schwab Network connects the dots. Watch live, subscribe free at schwabnetwork.com.
Welcome back to Market on Close. I'm Sam Barnes on the floor of the New York Stock Exchange alongside Marley Caden in Chicago. Let's just check in with where the market stands, because we did see some new all-time highs this morning at the open before we saw the Dow retreating. We've got the S&P 500 that's really just been range-bound. We are underwater right now by the tune of 0.2%. Of course, they're coming off its first record yesterday. And, of course, the Dow Jones climbing above that 49,000 level. Many are wondering when we'll get to 50. But for now, it's the NASDAQ that really seems to be pulling ahead as, of course, we continue to see technology taking the cake here as far as the winners here, the usual suspects, of course, companies like NVIDIA, although We are seeing more of a rally in softwares today, interestingly, than chips. We're actually seeing some of the memory names coming off after a really, really good run and such an outperformance yesterday. It is an update for the names like Intel, but we do have AMD, for instance, on the back foot today as well. So let's just take a look at some of the futures products right now, because we've had a lot of data to chew on earlier this morning, as I mentioned, and ran through. Nothing too alarming, really just confirming the trends that we saw throughout the most of 2025. Looking for a sort of more cleaner picture, obviously, from the jobs data we'll be getting on Friday. So for now, we've got the US dollar holding steady there, just fractionally higher at 98. We've got crude oil on the back foot today, of course, given some of the headlines around Venezuelan oil and the Trump administration's announcement there. We're at $56 a barrel. Bitcoin is lower today after that nicer recovery, that rally we'd seen in recent sessions. So we're down about 1.5% on the cryptocurrency at levels of 91,000 and change. And then the 10-year yield, which has sort of been flip-flopping around 413 to 416. We're at 415 right now, where we've really been stuck and range-bound, given, of course, the data we've been getting over the last couple of months, and many expect this to continue to be the case. But for now, I'll send things back over to Marley in Chicago.
Thanks so much for Sam to that update here. Now, joining us in our Chicago headquarters is Jillian Delsignore, the head of retail and wealth strategy at NASDAQ Indexes. Jillian, Happy New Year to you. Great to have you back with us. Last year we're here, we talked about the explosion of ETF launches that we saw in 25, and I asked you about whether or not, how many of them you thought would survive through the end of the year, and you said it's actually a metric that we track. So I'm going to pick up our conversation right where we left off and ask you, about the open to close ratio and what it's telling us.
Absolutely. And so it's funny, I was thinking a lot about this, obviously, as I was preparing, and I think it's important that we unpack. So yes, we track the ratio, but if you think about one of the numbers, the opens, is dramatically higher than it's ever been before. And so I think it's important to unpack that number to sort of see what's been happening under the hood. So in 2025, we had over 1,000 launches, which we've talked about. That is 100% higher than 2023. You go kind of 500, 750, 1,000, right? 2023, 2024, 2025. 85% of the launches in 2025 were active. So significant explosion in active products. We did see a higher closure of active products as a result. If you look at if you again look sort of at that 1,000 number, over 100 of them were buffered ETFs, and almost 300 were single stock ETFs. So we're continuing to see this active number be a bit skewed, right? If you look at the delta between 2024 and 2025, that about makes that up between the buffers and the single stock ETFs. We also saw over 100 new issuers come into the market between 2024 and 2025. So what does all that mean? It means that we continue to really innovate and push the limits of the ETF wrapper. You're naturally going to see closures. We're standing up to reach investor demand. Some of that is not necessarily going to ring true with investors. So I do think that the closures that we're seeing, which have remained fairly steady, so the ratio is changing, but largely because the opens are changing so much. The closures have actually stayed pretty steady year over year. Higher increase in the active closures because there's been such a significant raise in those launches. But I do think it's continuing to be very healthy for the industry. You are seeing, because there's so many new issuers, you're not necessarily seeing a lot of the closures from the established players, right? The Dimensionals, the AllianceBernsteins, the JP Morgans. Yes, in some cases, but more of the smaller issuers who don't necessarily have distribution or name recognition are the ones that we're really seeing start to close. So I think for investors, it continues to provide them with significant opportunity for new investment ideas, but certainly to keep an eye on sort of the underlying issuer and the strategy before thinking about the investment itself.
So if the closures are staying relatively steady, but we've seen these launches nearly double over a 2-year period, what does this suggest about the issuers? Are the ones who are surviving being more thoughtful about what they're bringing to the market? Or are we just seeing a mix of those racing to get an ETF out there versus some who are being thoughtful and only the best and brightest succeed here?
It's such a critical question. I've sat in the distribution seat for 26 years. It's critical to success. So I think, if you look at, again, over 100 new issuers, brand new issuers have come to market in the last 2 years. It's a wild number. And so I think you have to think about, who are those brands? Do you have a brand? Do you have distribution? Those are going to be critical components to success. Yes,
223
matters. There's a lot of products that are coming out that I
well,
would argue
this is
really
the bottom or nothing
not
here.
Investor problem, right? They're an asset manager problem. They're a problem looking for a solution. And so you are going to see a lot of closures in that case. But I do think that you're going to see a lot of the larger players.
Who is this
survive.
nut?
You are going to see a lot of these smaller firms. They just can't sustain low assets for as long, right? If you're at JP Morgan and you launch a product and it sits at $50 million for 2 years, you can sustain that. If you're a shop that only has one ETF, you can't sustain that. So I do think it's going to be important for these managers to reach critical scale out of the gate in order to survive.
And when you look at the 10-year and the 5-year averages, probably the 5-year may be more important here because it aligns to the pandemic. You know, are we in what you would describe as a fundamentally different ETF era now than we were pre-COVID, or is the world just correcting itself post-COVID?
I think it's interesting. So I think we are in a bit of a different world, largely because of the adoption of active. I know we keep saying it, but it's such a huge driver of growth. 85% of launches last year, over 800 products that were launched were active. Again, there's a skew, and we need to keep an eye on that because 300 single stock ETFs came to market last year. 300 aren't surviving, right? So I do think you could see a spike over the next year or so in closures of those products because investors just aren't going to drive themselves towards everything in that realm. So I do think that post-COVID you did see a rash of closures. There were a lot of thematics that launched during COVID we probably all remember that were taking advantage of the theme, work from home, stay at home, all the things we were seeing, right? So you did see a spike in the open close ratio after 2020 into 2021 because of that. I do think we're seeing a bit more of a stable closure rate over the last number of years, so I do feel like we are in a bit of a different era now.
And as we look at, you know, active strategies, and we keep mentioning this term about active being so important and being so popular, and also we talk constantly about retail investors driving a lot of the selection. You know, as we look at them driving the product development and trying to appeal to these retail investors, how is it changing the types of ETFs that we're starting to see come to the market, in addition to seeing a lot more active versus passive strategies?
I think for the first time ever, you are seeing issuers launch product that is directed just to retail. A single stock is an example, but not exclusively. You are seeing products that are coming to market with that audience exclusively in mind, which is a first. You used to historically see, okay, I'm going to start with the financial advisors, and then I'm going to gain some scale, hit the institutions, and retail was sort of like the icing on the cake. But now they really do drive significant flow. And we saw that in 2025. And so there are issuers, not all issuers, but some issuers who are specifically driving their product launches to that marketplace. And again, it's not just your meme stocks and single stocks. Retail investors, as we've talked about over the course of the year, they're much more sophisticated these days, and they're looking for portfolio tools as much as anything. And so issuers are standing up to meet that need.
Jillian, it's always a pleasure to have you with us. Always so insightful. We love when you come, especially with answers to questions that we didn't get to cover last time. So we appreciate you picking up where we left off. That's Jillian Del Signor from NASDAQ Indexes. And I do want to send it back to Sam in New York.
Thanks for that, Marley. Well, coming up next, we'll turn our attention to commercial real estate and what trends we should be watching for this year. Market on Close will be right back.
New low. Yes. I'm crazy. Nothing.
Opportunities don't stop when the market day ends. So neither do we. Schwab gives you round-the-clock access to over 1,100 of the most popular stocks and ETFs, plus a wide variety of futures markets. all with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
I'm Diane King Hall on the floor of the New York Stock Exchange. When markets react, we are live with analysis that matters. Watch now, only on SchwabNetwork.com.
Sometimes, you know, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Welcome back to Market on Close. I'm Marley Caden here in Chicago alongside Sam Bottas at the New York Stock Exchange. We have an update in this Warner Brothers Discovery saga. It has once again rejected Paramount Skydance's bid to acquire the whole company, and it continues to call Paramount's bid inferior to its previously announced deal with Netflix. Paramount Skydance's offer was for $30 per share with guaranteed backing of billionaire Larry Ellison, but the company says they have concerns about the company's ability to finish the deal, to close that deal, what sort of financial implications that could have for Warner Brothers Discovery and its shareholders, and contends unanimously that the Netflix deal is better for the company. So that's it. Let's take a look at how all three companies are performing today. Warner Brothers higher on the day after a meteoric rise with the announcement that they may go up for sale. Then we've just continued to see them move higher. They're up 0.4 right now at $28.58. Netflix was slightly lower when this was first announced, has since reversed course, not in the green by much, but up about 0.1% right now. Paramount Skydance, though, doesn't appear to be giving up, hasn't publicly commented yet, but trading down 1.4% in the wake of another letter issued by the board of Warner Brothers Discovery saying that they unanimously support Netflix's deal and do not want to accept the deal from Paramount Skydance. So that's the latest in the saga. Sam, I'll send it back to you in New York.
Thanks so much for that, Marley. Well, joining me now here on the floor of the New York Stock Exchange is Liz Hart, President of Leasing for North America at Newmark. Thank you so much for joining me here today.
Thank you for having me.
And we've got your feet on the ground here today because you spent a lot of time in a plane going around, you know, obviously checking out different parts of the country and just getting a bit of a pulse check on what is happening. So just give us a sense of what you're seeing.
Well, I think it's a very interesting time starting into the new year of 2026 because 2025 was quite a pivot year for commercial real estate.
Okay.
And we're heading
Being
into
very
2026
stubborn.
with quite optimism. It's a year that we think there's going to be a big recalibration in commercial real estate. We're expecting 1.5 billion square feet of pre-pandemic commercial real estate to roll, to renewals to come up. Okay. And when we look at the demand, what we're seeing is 72% of those tenants are looking for the same or more.
I got out of this one. I took.
Quite different than what people are thinking of.
We look at it now.
It's seeming quite optimistic heading into the new year.
Yeah, because when you hear about commercial real estate, I mean, you talk about this whole, you know, sort of trend of people working from home and it's really struggling, but there's a lot back in there. What is the catalyst
let the air out of the tires
that you talk about and which backs up your confidence for a year of more sort of normalization?
Well, I think there's three things to talk about. First, the trophy sector. The trophy sector's been a great performer here in Manhattan where we're sitting today. Sub 5% vacancy. So really strong performance and double the amount of demand as there is availability. So you can expect some rent increases in that sector for sure. From a sector perspective, the technology industry, big growth sector last year, an expectation that it's going to be the same. A lot of those AI companies that are driving that growth. Several companies that have only been in existence for less than 5 years that are already looking for over 100,000 square feet. And from a geography perspective, really, you know, the South has been quite a performer.
Interesting. So if 2026
You
is
might give it one more shot.
What is normal?
Well, I think what normal really means is there is probably no normal across everything. It's going to be different.
The 6930s.
So you definitely want to break that apart and look at the specific sector that you're talking about versus having everything be the same. Like, you know, it's very hard to move the bottom of the market. Certainly, that's been something that's been harder. So if you look at the retail sector as an example, if you have space that's been on the market, a lot of the, you know, 40% of the space has been on it for over 24 months. So when it's hard to move, it's very hard to move. But at the top end of the market in retail, I mean, 95% of malls or Class A malls are occupied. So, you know, top end performance performing very, very well. Bottom end still struggling.
Look, the consumer is still spending, and I think a lot of the mall's demand is coming from the experiences that they offer. At least that's what some of the CEOs are telling me. With respect to the rate of the return to office, I'm hearing from your industry they're looking at about 90% as far as that return rate is concerned. I mean, do you have a figure on that? Are you seeing some encouraging signs? Are you seeing a shift in that trend?
Yeah, I mean, I think what 2026 is where we are now. I don't think we're returning anymore. I think that we're at a stage of normalization. And what we're seeing is that most companies are over 3, often 4 days per week in the office. And we think that that's what you were before. I don't think many companies had people in every single hour of every single week, even before the pandemic. And so we're feeling very, very optimistic. But, you know, even some of those San Francisco companies, I was talking to someone today who they're expecting their companies in 6 days a week, if you could even believe it. So it just depends on who you talk to. You know, some are more and some are less, but many 3 or 4 is the average.
Okay, and as far as your industry being very sort of rate sensitive, you know, we got 3 rate cuts in the system last year. You know, I mean, people are talking about 1, 2, maybe even 3 from the Fed this year. I mean, how are you seeing that as far as helping things along right now?
Yeah, I mean, there's certainly a certain amount of product that would help significantly, because we do have a certain amount of loans that are coming due that were pre-pandemic loans especially, that are going to help, especially that lower end of the product. So we would welcome some rate cuts that would help that product going into next year, particularly in the markets like, you know, Seattle would be a good example of this, where there's a significant amount of loans coming due and that demand is coming back, where it could help some of that product move and reprice.
Okay, so San Francisco, perhaps talking about tech in that particular area, but I mean, just across the country, where is hot right now, in which sectors?
I mean, definitely tech is the hottest sector, and San Francisco is the center of that, Silicon Valley and San Francisco. But New York, where we are right now, I mean, that's also become the second hotbed for talent, for technology. Also seeing it happen in Boston, in Bellevue, a little bit in Seattle, more in Bellevue. That's happening as well. A little bit in LA and Chicago, and Atlanta as well. Dallas, too. I shouldn't forget Dallas. Dallas, a lot of tech has gone into Dallas.
Right, interesting. And then obviously the adjacent to that is what we're seeing as far as all the data centers. I mean, what are you seeing on that side as far as, you know, obviously what has become a really backdoor trade when we talk about markets is industrials and everything that's going behind the artificial intelligence boom. But what are you seeing as far as the commercial real estate perspective is concerned with that rollout?
Yeah, we would expect that powered land and data centers will continue to be a trend throughout 26 and beyond, certainly. And manufacturing, too. I mean, industrial, big block leasing and industrial, so that's 700,000 square feet and above, up 63% at the end of last year. So that's a very, very large increase. And that's really just, you know, supply chain stabilizing, manufacturing, Mexico becoming our largest trading partner. I mean, those intermodal cities like Phoenix, as an example, seeing lots of good leasing demand there. So I think it's going to be a pretty strong year for industrial as well.
Yeah, it certainly seems to be the case. And then retail, obviously. I mean, I know you touched on that, but what are you seeing as far as the demand out there for retail space? I mean, as I said, I've spoken to a lot that are in the business of this, and they do say that it's really about the experiences. But is that continuing to gain traction? Because we always talk about this sort of K-shaped economy, and there seems to be some sort of anxiety around, you know, just how sustainable the consumer trends really are.
Yeah, I think what we're seeing is we're seeing great performance in the Class A malls and experiential retail, as you mentioned, and then we're seeing a trend around wellness as well. So anything around the wellness and fitness. I mean, I guess that's a very on trend for the beginning of the year as we have our resolutions, right?
That's right.
And so we're expecting that to perform quite well as well.
Yeah, new year, new me, and pickleball courts. I've heard a lot
all
about
of that. Lots of pickleball for the year.
Yeah, that's way too cold here for pickleball.
Same.
All right, Liz Hart, thank you. It's been an absolute pleasure having you here on the floor. That is Liz Hart from Newmark. I'll send things back over to Chicago with Marley.
And thanks so much to Sam and Liz for that great conversation. Coming up next, we've got Options Corner. Rick Ducat will join us here in our Chicago studio to take a look at the options activity on Micron after it touched yet another all-time high today. That's next on Market on Close. Kick off the morning with the data and the decisions moving markets. Morning Trade Live breaks down the macro moves driving the price action, from Fed policy to global growth to inflation prints and geopolitical risk. Smart, fast, and always live from Wall Street to your screen. Morning Trade Live, where the markets meet the macro, weekdays at 10 a.m. Eastern on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Do you like using charts when analyzing your stocks? Our technical analysis webcast series breaks down different charting techniques like trend analysis, price patterns, moving averages, oscillators, and much more. Best of all, you can ask questions directly to an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
I'm Kevin Green, and I track options flow daily, identifying who's buying, who's selling, and how it's going to impact the markets. Watch live on Schwab Network at schwabnetwork.com.
Trading at Schwab is powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals, you can spend less time searching and more time learning. Trade brilliantly with Schwab.
Welcome back to Market on Close. Shares of Micron slightly lower today, but did hit a fresh all-time high earlier in the session. The company announced today it will break ground on its $100 billion semiconductor mega fab in New York on January 16th. That would be the largest manufacturing facility in U.S. history. Now it's time for Options Corner. Of course, we're featuring Micron today, an all-time high yesterday, another one intraday today. Joining us, Rick Ducat, our lead market technician, to take a closer look at Micron and some of its recent performance. So when we talk about Micron, as it compares to the broader market, obviously I can see from the chart, it's had a pretty significant move to the upside.
Right, there's a reason they're building the largest manufacturing facility ever, because of the insatiable demand that we've seen in these storage names. I mean, the outperformance is very obvious here. But when you look at it compared to the other chip makers, it's kind of funny because Micron is actually the laggard of the storage maker names like Seagate and Western Digital here. They're up even more versus the CPU, GPU makers are having much more modest gains here. Still pretty funny to call these modest gains, but everything's relative. So we can see as well that we had some analyst moves. UBS upgraded their raised their price target to 400 from 270, 400 from 300, excuse me, and kept their buy. Piper Sandler raised it to 400 from 275 and also kept their buy. The Piper Sandler note said Micron is extremely well positioned at least through the end of 2026, noting supply is already effectively sold out with little ability to add capacity. So that's kind of the theme I just keep seeing over and over and over again. Insatiable demand, not enough supply. And here we are trying to scramble to build these facilities.
Yeah, and certainly, well positioned when you're one of the companies that supplies the thing that's in demand like Micron is. As we've seen it stack up against competitors, and you say it's all relative, but we're looking at these triple digit, specifically at Micron, and its setup coming into the new year. What are the technicals showing us?
Right, a very sharp rally here. Heading into earnings, it was looking like kind of a rising wedge type shape here, where we had increasingly anxious buying activity with a more consistent ceiling, but the upside breakout came after earnings when we pushed above this level here, near about 270 or so. But from there, you could have drawn this short-term white channel here, but really it did not hold on for too long here. We pushed to the upside with some ferocity here during the past couple days here. New intraday highs today, but not really seeing on pace for a higher close yet. A Harami candle could be being formed today. Our small red candle completely contained within the previous day's larger green candle. In terms of the real bodies, at least, the distance from the open to the close, you can see right here. Moving averages, not too much help in these situations. The very short-term 5-day EMA could be supportive near 323 or so, but even our monthly EMA has been far outpaced at this point. RSI overbought, still continuing to make relative highs along with price during our up days here, still remaining above that 70 threshold as well, despite the decline that we're seeing today. volume profile, our volume heavy areas. One comes in right here during this period of consolidation near about 240. Another node down here at these lows near 190. Those seem pretty darn far away at this point here. Not really too much else to show in terms of clear levels, but notice the very heavy trading activity, the high number of volume spikes above the 50-day moving average of volume here that suggests strong conviction on the part of traders.
Yeah, and 190 certainly not anywhere near the 338 that we're seeing today, even as it's moved off of those highs. We're about 1.5% lower. But in terms of the volume you mentioned in options action, are we seeing, is it a normal day for Micron? Are we seeing increased trading activity?
Just about average, according to the sizzle, almost exactly one. It was 0.99. We can see that the 55% calls today, 293,000 options traded roughly total. Our most active month in terms of the open interest, January 16th, as is kind of typical for many stocks here. Our range during that period, about 8.2% plus or minus here. So that would be coming in right near 363 or so that would be about our plus 2 standard deviation channel. So some technical resistance could roughly line up with that upper edge of that boundary.
All right, and were there any notable trades that you saw? Whenever we seem to hit these records, I feel like there's always one surprising or big one that we highlight.
There were several big ones here today. I think the biggest dollar amount that I could find, minus 600 June 18th, 240 calls at a 122.65 credit. The option was up about 250% in only 13 days. Probably a closing trade, though, because they'd be selling so far in the money to open otherwise. A $7.3 million credit received. Not really clear how much the opening trade was for, but some really big numbers taking advantage of these explosive moves to the upside.
Yeah, explosive moves, even with the slight move to the downside that we're seeing from Micron year to date, which I should note is just 4 trading days, up more than 18% for Micron. So thanks to Rick Ducatter, lead market technician, for being with us for Options Corner to take a closer look at Micron Technology and their severe move to the upside that we've been following. But I do want to send it over to Sam and find out who we'll be talking about with George Tillis for Overlooked Stocks.
Well, sticking with the chip theme, Marley, George Tillis.
She's having such a fun time.
Electronics heading into the close. He'll break down the news on that company and what you need to know about it coming up next on Market on Toes.
SPY almost hit my support. 689.24. We have 15 minutes
Whether you're an
left.
experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach.
Very good.
It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
I'm Jenny Horn. We go beyond the headlines, tracking the trends, sector moves, and fundamentals shaping the markets in real time. This is Schwab Network. Subscribe at schwabnetwork.com.
How's it going?
First day, so
Sometimes, you know,
next. Try it again.
you could have done better.
Boom, boom.
Same goes for where you invest. Level up and invest smarter with Schwab.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh.
Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties.
Carl.
Schwab.
Schwab.
I had that one good play in there.
Stay connected to the markets with Schwab Network.
Tune in 24 hours a day, 7 days a week on schwabnetwork.com.
And on all your favorite streaming services. Schwab Network. Available anytime, anywhere, on any device.
Welcome back to Market on Hose. I'm Sam Butler. the New York Stock Exchange. It's time now for overlooked stocks. So we're watching shares of United Microelectronics that are rallying today after releasing some December 2025 sales data. So I'm joined by George Siller, senior markets correspondent, for the details on this one. So we're up about 10%, $8 and change. Just talk us through these sales numbers, why it's so significant.
Well, I think the company's significance is tied to the semiconductor stack in the realm of the foundries that are performing exceptionally well. I mean, if you look at companies like Taiwan Semiconductor, Intel is actually catching a significant bid as of late. And one of the things about UMC is it is a Taiwan semiconductor foundry company. It's actually quite a bit smaller than Taiwan Semiconductor or TSM. They do manufacture and sell integrated circuits that support the design and for mobile and wireless communications, wearables, data processing, as well as the automotive end market. So they seem to focus a little bit more on the what are called long cycle specialty products like wearables, for instance, versus the advanced node products at Taiwan Semiconductor, which is the primary manufacturer foundry for NVIDIA's chips supply. So they are in the different aspects of the semiconductor stack. Their nanometer nodes are not necessarily as technical or advanced like TSM's are, but nonetheless, they've got a very diverse customer base, which includes companies like AMD and even Broadcom. But they did report, essentially, not necessarily a quarterly report, they actually gave unaudited guidance in terms of their full fiscal year for 2025. They actually denoted only 2.5% increase in sales, which I suggest is actually enough to actually push the stock to the upside today, nearly 10% based on this news. I think it comes down to this name being tied into the group, which includes Intel, which is having a nice day, as well as of late, you're starting to see some big pickup this year, the sort of January effect in TSM and even some of the other lithographic manufacturers like ASML.
Yeah, it's interesting because, as you mentioned, I mean, this stock is rallying, obviously, off the back of some of these sales numbers. You've got Intel higher as well. A few of the chip names are up, but broadly as a group, down today off the back of what has been a pretty stellar three-day run for this entire sector. When you look at this sort of index as far as semiconductor chips, I'm just wondering, what this grind
10 more minutes. Here it comes.
Say, obviously this is an overlooked
Okay, what are they?
It is comparable to TSMC as far as
being a company,
so I suppose it sort of fits the profile there. But what does it tell us about what other companies are doing that perhaps don't have the sort of same profile as some of the other big names that we talk about?
That's a good question.
Well, I mean, the market's very clever, Sam. So
it is?
A narrative and a thematic aspect to what's happening. I think that UMC is coincidentally reporting their fiscal year top line sales. Again, these are unaudited. This is basically
the market's very clever, she says.
That's tied into what I think is going on with Intel, which again is a re-evolving foundry company. So again, some of the majors are down today, but some of the periphery names and
okay, Jimmy's going in.
Even Intel, if that makes sense.
The 69.25s.
Today, I do think at the end of the day also is the market is rewarding stocks that are not in the.
I actually got a real good price
right now, and that's also thematically speaking why we're seeing some stock price action
right on the bottom of that 9 right there.
Like UMC,
and it instantly went into a hammer.
If you look at the last 5 years of this name, the growth really hasn't been there. And if you look at the price action,
just like that,
it really hasn't done much. It's been down, but it doesn't necessarily mean it hasn't made money. They have, but one of the factors involved in this stationary price action is their dividend policy. They've actually paid out about 48 cents of their earnings in dividends. Now, if you look at the fiscal year 25 EPS on an adjusted basis of 52 cents, that's essentially over 80% of their income in dividends. So this company seems to be a dividend play on foundry. If you ask me, that's just my view of it. If you look at their cash position relative to market cap, it's $4 billion. Market cap at around $20 billion, roughly speaking. So that's a significant portion, or about 25% of the market cap in cash. Doesn't have a lot of debt. Revenue is nearly $8 billion, and their net income on a trailing basis around 1.4 billion. So it's more
Bring
of
it.
a value-oriented and income-oriented tech company, which is kind of unique in this environment because their growth rates aren't really robust. And in fact, just look at the numbers, rate of change they reported at 2.6% year over year for 2025 versus 2024. Nothing meaningful, but nonetheless, again, I think there's pickup in this name because of the thematic narrative that I talked about just a moment ago as well.
Yeah, there certainly seems to be a thematic narrative, as you say, and many have been sort of talking about the fact that 2026 would be more of a case of who are going to sort of emerge as the winners and the losers here, maybe looking at, you know, others in the space away from the big names that had been working last year, even looking at some of the sort of more AI adjacents, the back doors into this whole AI trade as well. But I'm just wondering, you know, as you mentioned, as far as the overall performance is concerned, I mean, I see over the course of the last year, I mean, it's up 35% with this move today, but you know, what are the analysts saying about this? Because I mean, you're not a huge amount of coverage as far as the sell side is concerned, but I am seeing that some of them are sort of on the fence, unsure. There is a couple of underperformance sell ratings there too.
Yeah, that's the thing. I think the analyst coverage is rather mixed in this name, just based upon the earnings growth and sales growth. If you look at the estimated EBITDA growth for the next fiscal year of 2026, they are only expecting around 4.75% consensus-wise. If you look at the sales growth, 3.6%. So again, the nature of their products also speaks towards the long cycle specialty areas of the semiconductor ecosystem. You know, wireless communications and wearables.
No.
Markets. The automotive
150,
market
come on.
is rather competitive. You've got NXPI, you've got Skyworks, for instance, as major competitors to UMC. I just think that this is not a growth story for UMC. You're seeing a nice pickup today in price, breaking out to new 52-week highs. It certainly could continue there. But I think this is more of an income play, to be honest with you, based on the dividend policy. And then also, like I said, the reason the stock hasn't made any tremendous move in the last 5 years is they're paying out the majority of their earnings and dividends. And so if that's the case, the money's moving off their balance sheet, and so it's not necessarily being accretive to existing shareholders from a capital-intensive basis, but it is from an income divestiture basis.
Makes sense. All right.
God.
Thank you so much for getting us across this one today. Trading higher by 10% right now, United Microelectronics. Really appreciate it. I'll send things back over to Molly in Chicago.
Thanks so much to Sam and George. We are nearing the end of our market session. That means we'll be bringing Alex Coffey in to join us to break down today's action. That's next on Market On.
Well, that didn't work. I was kind of thinking we were going to have this little upside, but it turned around and pulled back.
Data-driven analysis from U.S.
So
equities
that's a
to
loss.
global macro matters. Schwab Network connects the dots. Watch live. Subscribe free at schwabnetwork.com.
Opportunities don't stop when the market day ends. So neither do we. Schwab gives you round-the-clock access to over 1,100 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
I'm Alex Coffey.
And I'm Jenny Horn. This is Next Gen Investing, where we track the trends shaping tomorrow's market.
From tech to energy, crypto to consumer, we focus on what's driving investor sentiment right now.
Clear analysis and forward-looking market coverage every trading day.
This is a make or break level for this stock.
And that could certainly be a short to near-term catalyst.
Next Gen Investing, 1 p.m. Eastern.
Only on Schwab Network.
Sometimes, you know, you could have done better. The same goes for where you invest.
Well, there goes that. I expected we'd probably have a little bitty bounce to the upside, but it didn't work. No. Less than a minute. Tonight's Wednesday night, ladies' night. Let's get ready to go ding, 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 ding. All right, later dates, YouTubers.